The pre-open rates are trickling in, and we'll get to that in just a bit. For the timing, let's get our technical experts on the show. Mitesh Thakkar as well as Sudarshan Sukhani join us on the show. Hi, gentlemen. Good morning. War to wash. There's a bit of a fear with regard to these rate hikes. So the markets could start off a little bit softish, 50 points down. But the trend has been up. Sudarshan, what would you do on the index first?
Yeah, good morning. Well, we've had markets move sideways for the last 2 days, and sometimes a sideways move substitutes for a decline or a correction. I think the markets are telling us that they are willing to be at these current levels at least. So the trade is to go and buy the Nifty with a tight stop somewhere around 23,800. Take the long trade, but again, it's not a day trade. It's something you have to carry on.
All right, something that you have to carry on. That's a long trade. Mitesh, your call on the index, and what are the stocks that you're recommending today?
Good morning. So I think there are a few positive things which have happened in the charts in the last few days. We've been maintaining that we might head towards 24,100 and then 24,350, 400 and then 24,600 odd levels. But in the last 4 days of an upmove, I think a lot of indicators have turned positive. The moving averages have given positive crossovers, which means that the overall bias now should be definitely on the upside. Any decline, 50 to 100 point kind of decline should invite some buying. And aggressive buying in case you get levels close to about 23,900. I suspect we might not get them, but yeah, for the time being, the idea is to buy on declines is the kind of strategy which we'll deploy. And the targets I've already mentioned. On the stock side, I have 3 buys and 1 sell call. On the buying side is BEL. Different stocks had some kind of a breakout on the upper 2 hourly charts yesterday, majority of them. And I've chosen BEL as a buy. Keep a stop at 413, look for targets of 432. Then also a buy on KFinTech, which I would recommend buying with a stop below 882, 881. Look for targets of 930 to begin with. Crompton is a buy with a stop at 270 for targets of 288 and 1 sell call. That's BSE. The short term, the immediate charts, the 2 hour charts have slightly turned negative, so profit booking could happen here. So BSE is a sell with a stop above 40.50 for a first target of 3,900.
All right, take that point. Those are a couple of stocks. Sudarshan, your stock list?
Well, Astral is a buy. Astral buy with a stop under 1530. Cochin Shipyard is a buy with a stop under 1480. Coforge is a buy with a stop under 1430. So I have 3 buys. And Marico is a short sell with a stop above 825. But I would prefer to focus on the buys today.
All right, take that point. Thanks a lot for that, Mitesh and Sudarshan. We'll come back to you in just a short bit. But with that, let's put the spotlight on the NBFC sector. IIFL Capital remains bullish on large players, saying West Asia war risks are largely priced in. They, however, see growth moderating due to cautious MSME lending and slower vehicle finance. That's largely because of perhaps, a growth slowdown. So to discuss all of this and a lot more, we do have Viral Shah, who's the Senior VP, IIFL Capital, joining us in the studio. Thanks a lot, Viral, for joining in. Welcome to our studio once again. On the NBFC space, a lot of people believe that maybe this next leg of rally that comes by would be more NBFC focused than band focused, because obviously they get better borrowing costs coming in because of everything that has been announced by the RBI. Would you be in that camp? The second part, however, is on the credit growth side. How's the environment looking out there?
So, Mangalam, thanks for having me. On your first question, if you look at the macro situation, macro situation is now completely turning on its head versus what it was a month back. Crude is below $80. Rupee is strengthening. RBI is in no hurry and rush to basically raise rates. This backdrop is positive for NBFCs, especially the large ones. In fact, a month back, we actually gave an anti-consensus call that most of the downside scenarios are priced in, may not be fully to their full degree, but there's also an upside scenario of the precise environment that we are currently seeing. So I think part of that, the easy trade has happened. Having said that, we are nowhere close to where I would say one can say that the rally is a bit more stretched, especially for NBFCs. I see that there is room for now earnings upgrades of at least 3 to 5% further for NBFCs, especially coming from the cost of funds, which earlier we were anticipating to rise. It is not going to play out. And the second point, more importantly, is the valuations. When we look at the valuations for the large NBFCs per se, you'll be surprised to know that they are actually trading at similar multiples like your large private banks. When you adjust it for growth, because NBFCs, especially the large ones, give you the higher growth, they deserve a higher multiple. So when you adjust it for the growth on a PEG basis, you will see that the multiples are similar what it is for a large private bank. So of course, to answer the first part of the question, it's not say NBFCs over the large private banks especially, it's both of them for us right now.
Got it. And on the credit growth part, because a lot of the earnings upgrade you said would come from perhaps cost of funds, but is the credit growth environment supportive enough? We haven't had rains yet, and how is borrowing likely to be?
So, see, on the credit growth front, clearly when we look at the banking system data that Rikin puts out, we are seeing very clear acceleration in growth for the banking credit, right? Part of that is the credit substitution from the capital markets. But at the same time, I think versus what we were expecting and anticipating, say, a month, 2 months back, I think it's unlikely for us to see, say, a downside scenario of growth playing out versus that. For us to have upgrades, I think the monsoon has to definitely play out and support. But very intuitively, we have actually put out a report today morning, which actually shows that the underlying asset quality trends are actually holding up quite well across NBFCs. So even if there is a headwind, we are entering this scenario on a much stronger footing.
Okay, all right. Good to have you in the studio, Viral, and thanks a lot for coming down. The initial point you made on crude oil prices cooling off, there is some excitement in the CV space. But there is not too much correlation between CV and the crude price and cooling. In fact, you're saying that utilization levels on trucks, that's more important. Tell us how that plays out. And from the vehicle financing space, what do you like most?
Sure. So this is one of the analysis that we put out over the last 20 years. When you look at, say, the diesel price changes and you look at the asset quality trend, say, for a Shriram or a Chola, there is no meaningful correlation.
Okay.
What is the key determinant is what happens to the utilization. Basically, what it means is that if there is a demand for the truck drivers will increase the freight rates, which we have seen in the month of April and May. The freight rates are up by 2%. This has already recouped half of the increase in the diesel prices. Okay. So there is probably another 1.5 to 2% increase that, say, the truck drivers need to take for them to basically reach the levels where they were earlier. So it's not an alarming situation that people anticipate. And second is you don't need another 5-10% kind of an increase in freight rates to reach there.
Okay, important point then to note. So are you bullish then on the vehicle finance space? If yes, which segment and the stocks as I asked you earlier?
Sure. So I am, in fact, now, of course, vehicle financiers, some of them are very diversified, and which has been our call, the large ones, your Chola, Shriram, within the vehicle financing pack we like. Outside of that, of course, it's Tata Capital is something that we like. And then, of course, in the small and mid-cap space, we like basically the likes of your PNB Housing, 5-star, etc. So within VF, to answer your question, it's basically Shriram and Chola.
Rikin, just in terms of cost of money, for NBFCs, it is up to the 3-year sort of paper, which matters for NBFCs broadly?
Broadly speaking, you are right. It's the 3-year paper. For mortgage players, it's typically the 5-year paper that matters the most.
And how much of these rates fallen here?
So from the peak levels, the rates are now down by, say, almost 30 to 40 basis points. Having said that, mind you, versus pre-war levels, it is still basically 10 to 20 basis points higher. So there is still some more room left for us to go there. But I think in the trajectory that we are in, probably we may reach there sooner.
What about gold financiers? Because, gold prices have been fairly volatile. The gold finance stocks did extremely well when the gold prices were rising. Thereafter, they saw a bit of a correction as gold prices did correct. And now that there is some semblance of peace, these stocks are finding some favors once again.
So, see, as you were saying, 70 to 80% of the moves for gold financiers are determined by just gold prices. The volume growth is barely 2%, 3% at best. What we have been telling and advocating to clients is, for pure play gold financiers, the base case of, say, gold price not rising, forget about declining, is actually a negative outcome now. Because you have competition coming in from many of the other larger NBFCs. So from a competitive intensity standpoint, it's negative. Having said that, if gold price moves up by, say, another 10%, that doesn't matter for now. It may be a year or 2 years down the line. So key determinant is going to be the gold price and where it heads in that direction.
You mentioned valuations, which are now pretty much at par with banks, right? Private banks.
Adjusted for growth.
Adjusted. I mean, is that going to stay like that, you think? I mean, large private banks typically should stay, I would imagine. I mean, they've got access to cheaper deposits. I mean, lots of structural advantages, right? for banks as opposed to what NBFCs cannot do. You think I'm assuming that they should either one should re-rate or the other should re-rate a little bit from here. Private banks, people are waiting for a re-rating kind of an event at some point in the future. What do you think?
Interesting that you brought this out. We have looked at the data for the last, say, 10 years, 15 years. You look at the data, the NBFCs have been the market share gainers in the credit segment. Reason is, either their ability to underwrite a lot of the customer profile segments that banks are not willing to do. Similarly, of course, the liability franchise and advantage remains, which is where banks, by definition, should command a premium. But at the same time, what also matters to equity holders is the growth. You look at the earnings growth, when I look at, say, for the large NBFCs that I discussed, they are going to deliver an earnings growth of almost 25% CAGR over the next 2 years. Whereas for, say, the large private banks, this number is probably closer to around 15 to 18%. And all the large banks, including PSUs put together, this number is only 12%. So when I look at, say, a price to earnings multiple, the large private banks at, say, 15 times earnings are basically close to, say, around 1 time or 0.9 time PEG. Similarly, at, say, a 19 to 20 times earnings for NBFCs, they are also at 0.9 time PEG, the large ones. And what is different versus the earlier cycle that we have seen is the large NBFCs, they have now the advantage of parentage. They are no longer monolines. They are multi-product. So the cyclicality of all of them have reduced. They are going towards something what, say, banks have historically been more diversified in terms of products, customer segments.
Yeah, everybody's doing everything. There are no sector champions in that sense. That used to be 15, 20 years back, right? One line of business, but now it's like multi-line of business. Banks are also doing everything on the other side, right? Gold, etc. We've seen. Thank you very much, Viral, for joining us. Thanks for dropping by this morning. Appreciate your time here on CNBC TV 18. I think we've got about 30 seconds to go for market open, and we will have the first rate starting to come through any time. We've got about 10-point change lower on the Nifty, 24,074, the first, I think we have time to quickly recap things. Lupin, Corona Remedies, Anthem Biosciences. These are all names we've discussed from 8 o'clock in the morning. HCG is coming up with, I think, a slight downtick. Gravitas, Sham Metallics is up there with the strong guidance from last evening. RVNL, Railtel, there's Bosch Home, there's DOMS Industries, blocks there. So, yeah, I mean, all of this stuff will come up in just a bit as far as market open is concerned. We'll look at, of course, indices and then move from here. What do we have? 24,080 and Nifty Bank is 57,600, 700. It's actually banks are also, yeah, I mean, it's largely in the similar kind of line, right? 0.1 higher on the Nifty and about 0.2 odd on the Nifty Bank. Mid-cap index is up about a quarter. Small-cap index also in that range. Nifty heat map should come up on your screen, and I think we'll then pick up from there for broader markets. Is largely in the green. Trend, Tata Motors Passenger Vehicle, BEL, Shriram Finance are all higher. And some of the tech names, actually the top 4 losers on Nifty are all tech names. Infi, HCL, Tech Mahindra, TCS are down. 12 points to show for it. This is, of course, just the open this Thursday morning. Mangalam.
Well, a bunch of mid-caps are on our radar right now. We start with some of the order wins. We have HFCL, a near 2,700 crore order. The stock's opened fairly in the green. We have RVNL as well, a near 1,000 crore order. That stock's doing extremely well too. This morning there is, some traction in the spirits companies, and that's largely because now we know that the India-UK FTA will, take place with effect from July 15th. So there is a date to that. Obviously, everyone on the street knew about this happening, but now that there is a date, it's a positive more for the spirits companies than the beer companies. So which is why United Spirits is higher. Looking at Radico Khaitan this morning, along with something like a Tilaknagar Industries and Allied Blenders as well. Then the big mover from the broader markets has been Kirloskar Ferris. It's a near $13.5 million contract that the companies won for supply of basic grade pig iron. That stock's up 9% at open. A lot of these textile players doing well too. It's the India-UK FTA trade, which is, aiding their cause. So SP Apparel's up 6%, Himmat Singh Ka Said up around 5% as well. And then we do have New India Assurance, obviously one of the larger shareholders of NSE out there as compared to their market cap. So that stock too, higher by about 4% this morning. In terms of news coming in from, the bulk deal data, obviously Bosch Home and Anthem Bio are the ones that we'll be tracking. The Nifty is flitting between red and green right now, but the mid-caps have an upper hand right now, at least as far as the open is concerned.
Well, tech-related names have cooled off today. So you have Infosys that's down close to around 2.5%. You have Wipro as well that's down close to around 1%. IDBI Bank, well, that one saw a big run yesterday. That's coming for some profit taking. That's down close to around 3.5% in today's trading session. In terms of the Vedanta group companies, Vedanta Iron and Steel, that's been moving from circuit to circuit. One argues that maybe, in fact, replacement cost is higher in comparison to what it had listed at. So that's why we're seeing this. Volumes are massive on that particular one, up 5%. Let's put up Vedanta Aluminium. We had a couple of brokerage notes actually that had come out, Kotak as well as Citi. Both of them positive notes out there. For the time being, the stock is up close to around 1.3%. Yesterday, we had explained that, when it listed around 530 plus, then it listed at 7.5 times, which is expensive for a metal stock, even considering that things are going to look up for the aluminium sector in the near term. But it corrected to around 445 rupees, and from there's been some kind of buying. So two brokerage notes helping its cause. Shyam Metallics, its stock had opened up in the green, but on not very large volumes. So that stock as well should come up for you on the screen. What else? Bharat Coking Coal is up close to 3%, decent amount of volumes on that particular name. On the downside, you have Pine Labs that's down 1.5%. Net, Nifty more or less flattish, broader market seeing some traction, and the Nifty Bank continuing to outperform with a gain of close to around 200 points.
Well, it's not a bad-looking screen. It's kind of unchanged right now, making up its mind which way it wants to go. But most of the action, of course, has been in broader markets. And that continues to be the case. Paras Defense is up about 2% or so, 1,311 or so on this one. Astra Micro is up about 1.5%. So some of these smaller defense names continue to do well. MTAR, of course, has got a foot in the door in that space as well, 2.5%, but that's been, of course, an absolute rocket ship. MTAR is at a new high. Occasionally, you see these violent pullbacks on MTAR, 10%, but then, it picks right back. Azad Engineering is up about 2.5%. RR Kabil is up about 3.5%. So there's a clear trend, as we've seen. Premier Explosives, Bosch Home Comfort, Shyam Metallics, I think we mentioned. Viatech Vabag is up about 2%. It's that industrials and / capital goods kind of space, right, where there is immense interest, and it's kind of sort of in many cases taken valuations to very high levels. Of course, value in the eyes of the beholder and all that. Well, Pankaj Tibrewal is with us, founder and CIO at Ikagai Asset Managers. Pankaj, good morning. Good to have you with us here. Thanks very much for joining us. You've some of your calls have worked out beautifully, Pankaj. And I need not, for regular watchers, I think they know what I'm talking about. Some of the individual ideas we've discussed over the last 6 months, and they've done well. My first question, Pankaj, is, in industrials, capital goods, those kind of areas, right? There's been, do you find too much exuberance? People trying to connect, somebody supplying one box to some hyperscaler somewhere and stock goes up 50%, 60%. We've seen lots of that kind of action, right? I'm not dissing the broader move because it's supported by earnings growth, etc. But just the valuation at which this broader complex is now trading at, Pankaj, what's your sense?
Yes, Prashant, you are absolutely correct. In certain pockets, we need to be careful because valuations have moved to a level where slight miss on earnings could lead to significant derating. And don't forget that these are B2B businesses and they depend on few customers for their order and growth. No doubt, last 12 to 18 months have been very strong for few of the names, but we should be careful in terms of valuations. On the other hand, there are many pockets which are showing incremental positive changes. Valuations are reasonable, and incrementally the growth is picking up. I think there are lots of opportunities in the broader market space, Prashant. And even in the last quarter earnings, you saw that BSE 500 earnings grew at about 15%, though the large cap earnings grew at about 9 to 10%. And money is finally chasing where the growth is coming across. And you look at this calendar year, Nifty is still down by about 7.5%, but the mid and small cap index on a blended basis is up by about 4 to 5%. So there's a significant delta which you have got. And a lot of people are saying the market is not moving, but the real move is happening beneath it and bottom-up stock picking is getting rewarded. And our belief is that this could be the trend going forward in the next 12 to 18 months, the way we spoke in March, when there was peak pessimism across. And we said that you can see the glass half full or glass half empty. And same stance continues to be today. And there are significant changes I could see which is happening at the ground level, which will aid many sectors going forward in terms of profitability. And we can discuss as we move ahead today.
Yeah. So why don't you kick that off with those specific areas? You know, one theme for you has been chemicals, and I don't want you to. You can talk about what's on your mind, Pankaj. But you know, one additional thing which has happened, which I guess is a tailwind for a lot of sectors, is the appreciation in the Chinese currency relative to the rupee. Right? That I think has been now meaningful. So perhaps a bit of I don't know if it's competitive advantage, but maybe less disadvantage. In many, and these are these may be areas which are low value add. I mean, abrasives, for example, is a sector which comes up in conversations. There are others as well. So just talk about what's on your mind. Those pockets where there is strong growth and money to be made.
So Prashant, if you look at the context, I think there are two very important things we should not ignore. Since March 2025 till date, we are the second worst performing currency globally. And the worst is obviously Turkish lira, and we are not Turkey. How do you think about from an opportunity perspective? There are two opportunities brewing. One, from an export competitiveness perspective, you look against our currency versus Bangladesh, versus Vietnam, versus China, whom we were competing against in most of the products globally. And the depreciation against these currencies are very meaningful, between 10 to 20%. What it means is when we are meeting companies which have a very strong moat, they are saying we are getting reverse inquiries from countries where we have never exported. Because Chinese were dominant or Vietnamese were dominant, XYZ. And there we are seeing very strong opportunity brewing up that spans across auto ancillaries, that spans across engineering products, EMS, chemicals, and textiles. And just to give you a context on textiles, when we speak to most of the garment makers, they are saying the situation has completely reversed in the last 3 to 4 months, post the tariff 50% going off, and they are completely overbooked for the next many quarters to come. Similarly, on chemicals, we are seeing the same. The second part to this context is the import substitution. Last 3 years, you speak to any companies which were dealing with Chinese imports, they were saying they were creating havoc. They were selling products which is below the cost of production for Indian manufacturers. Three things have happened. Yuan has appreciated by 18 to 20% against UN rupee. Logistic costs have doubled. And the third part is that Chinese government have removed the export rebates from 1st of April. And these are meaningful numbers because the global trade happens between 5 to 10% net margins. And when currency moves by such amount, you look forward for import substitution within your country. And many sectors, again, appeal on that, where domestic manufacturers are seeing incremental demand momentum picking up. And they are seeing that the domestic users are moving more towards the domestic sourcing rather than looking at importing from China. And also China is vacating the low-end manufacturing. It's a fact when we speak to people who are very close there in terms of ground, they are seeing that Chinese government wants to vacate the low-end manufacturing and focus on high-tech, EVs, defense, and AI. And hence, India has the right to win this time around. And if we don't, probably we'll be missing the biggest opportunity on manufacturing. And the third point, Prashant, to collaborate with that, we looked at 3,000 companies which reported their numbers on the CAPEX side. It's a very, very interesting data point. The overall CAPEX growth in the country last year was about 9%. And split it between PSU and private, PSU grew at about 4-5%, private grew at about 11%. And within that 11% of private, if you remove Reliance, X of Reliance, the private sector had a CAPEX growth of 16%. Let's not stop there. Let's look at the breakup again between large cap, mid cap, and small cap. Actually, the mid and small cap companies had a CAPEX growth of between 15 to 18%. That means a lot of these companies outside the top 100 are taking risk. They are expanding their capacities and gross block over the next 2-3 years and the last 2-3 years across the wood panel space, tile space, chemicals. You have seen renewals, steel, metal, power. All across these sectors are seeing significant capex momentum. And I think wherever people are putting more capex, you will see the revenue momentum also coming through over the next few years. So our belief is that track those sectors, track those bottom-up companies, and look out for companies where gross block is increasing or has increased, and now the asset sweating will start. So I see that a lot of opportunities, good promoters, good entrepreneurs are there. And probably from here on, the time and the price correction has happened for the last 2 years. And probably we should see a stock-specific driven market approach going forward as well.
Right. Pankaj, I remember sometime in the middle of last year, you also shifted focus into some of the underperforming spaces, and that included the likes of consumption themes. Where do you stand on that now?
So the ground feedback still continues to be constructive on consumer discretionary. And we were speaking to a few of the retail guys in the last 10 days. And the feedback has been that the momentum is still continuing. Only the cost pressures have started hitting them because it started with crude, then the crude derivatives, and then the alternate of crude derivatives, and now flowing into food. So there is some kind of a cost pressure across the board. And if it continues the way the crude has been for the last 3 months, there could be some demand slowdown and demand destruction which can happen. But as we speak, I think across the discretionary space, we haven't seen any major demand destruction as we speak because the fuel prices haven't been passed on completely to the retail consumer. So consumer discretionary continues to be a good theme. And one major place where I have a disconnect with the street today and where I believe that the street could get completely surprised on the positive is the revenue growth. And when we look at the revenue growth assumptions by the street across various sectors, they are not taking into account the price hikes already announced by the companies. And hence our view is that the revenue growth after a long time can move into that 15-16% range, which corporate India hasn't seen for the last 12 quarters. And March quarter was the first quarter where non-BFSI, which is 404 companies out of the top 500 companies, have reported 13% top-line growth. And that was only 20 days of the problem on the war side. And I think now the price hikes have been passed on. And even if you take a minimum 6-7% volume growth and 8-9% price increase across the sectors which has happened, I think revenue growth could be surprising on the upside starting first quarter. Yes, there will be pressure on margins in the first quarter because of new raw material costs seeping into the supply chain. But over the next couple of quarters, I think that should normalize. But corporate India loves inflation. If you go into the past history, some inflation of 5-5.5% is excellent for corporate India and the leaders of the sector. And they keep on getting market share. One common commentary which we are hearing from across the leaders of the sector is that smaller guys are having trouble getting working capital credit, managing inventory, managing supply chain. And the leaders of the sector are actually gaining market share from those smaller guys, which have mushroomed over the last 3-4 years when there was deflation into the system. So I think very interesting times. And I think if we can pick right sectors, right stocks, I think that could be rewarded. And unfortunately, FIs are looking at only Nifty. And probably the real action is happening beneath that in our view.
Pankaj, very quickly, in the past, you've been contrarian at various timelines, and you've been pretty spot on, right? In March, there was peak pessimism. You were telling us, track the broader market, see the earnings are improving out there. There were some metal ancillaries that you picked, which have done quite well as well. And various other spaces, we were worrying about the rupee depreciation. You said cite the winners. What about tech? There is a lot of pessimism out there. Growth is not going to be much out there. The rupee has depreciated a little bit. But in terms of valuations, will you be interested in tech or still that's a no-go?
So tech, I think you have to approach it on a very stock-specific basis. I think there's definitely a tactical trade which is there on the tech. But over a 3-5 years, can the growth meaningfully escalate? My answer would be no, because I'm not of the camp on the extreme side, which is saying that terminal value becomes zero. And a couple of months back, we had a very detailed session on that, where we talked about how the market is saying that on the extreme that terminal value is zero. We are not of that camp. Growth could be slow, and hence valuation re-rating looks to be a little difficult proposition as of now today. But in that segment, we believe there could be certain companies in the mid and small cap space where growth still can be decent in the mid-teens, and there where I think the markets will navigate. So in tech, I think we should have a very stock-specific approach. We owned one stock which was a bank-led software company. In March, it was beaten down. It was available at a very crazy valuation, a part of the a large global conglomerate. The IT index went down, and that stock is up 45-50% after reporting very strong numbers. So I think those kinds of opportunities we have to spot where AI or maybe the theme may not impact their core business. And actually, they are also at the forefront of implementing those propositions at their client place. So there are few opportunities in the IT space, but as a complete blanket, it could be a tactical trade, not a very structural trade, which I would go for. I think the contra trade today could be a private sector banking ETF. I think nobody is talking about, people have given up. Last 5 years, no return in most of the private sector banks. But if FIs slow down a bit on their selling, I think the banking private sector ETF could be a major driver of the, going forward. Valuations are in your favor. And I think earnings growth will pick up this year across most of the private sector.
This quarter,
I think that could be a contra trade for this year.
This quarter will be a washout, but I think earnings growth will pick up. That's interesting, and I'm glad you said it. So contra trade, private bank, a group of private banks, right? Like an ETF kind of a thing will do well. So 10 seconds, Pankaj, just to kind of wrap up the conversation. Areas to focus on. You've given us leads. So just repeat them, just areas where you are most, you're looking for ideas. Yeah.
So the areas are chemicals. You are talking about textiles. We are talking about auto ancillaries. We are talking about engineering goods. We are talking about private sector financials.
Sure.
And certain pockets on metal side, we still continue to own hard assets. And don't forget, home building products. I think you will see incrementally very strong momentum on tile players, wood panel space, the entire PVC pipe makers. So that entire home improvement space is also looking exciting as we move ahead.
Pankaj, a great conversation as always. Thank you very much for joining us. It's a pleasure having you here on
Thank you,
CNBC TV.
Pleasure always.
Nigel, I think we have Federal Bank Management with us.
Well, that's right. Let's get straight to Federal Bank. They've launched the FCNR Max Deposit Scheme in US dollars for NRIs. They're offering 6.25% on 3 to 5 year tenures. To discuss this and more, we're now joined by Mr. Harsh Dugar, the Executive Director at Federal Bank. Hi, Mr. Dugar. Good morning. Thanks a lot for speaking to us here on CNBC TV 18. Now, with the NRI deposits already above 1 lakh crore for you and the FCNR rates at around 6.25%, do you see RBI's FCNR measures creating a 2013-like kind of opportunity? And for Federal Bank, how much are you factoring in, sir?
Now, I'll draw some conclusions from 2013 and today. First of all, if you look at 2013, that time we attracted about $26 billion in terms of deposit and $8 billion in terms of debt during that phase. But if I look at it as a percentage of my deposits at that point in time, which was about 2.5%, and a percentage of Forex reserve, which was about 10%, if I do the same parallel in today's world, this actually translates to about $70 billion for the system as a whole. Having said that, let me caution a bit. Last time around, the differential between US dollar rates and Indian rates was about 5 to 6%. And this time the differential is about 1.5 to 2%. So it may not attract that kind of flows, but people are largely expecting about $40 to $50 billion coming in, which would be roughly about 1.5 to 2% of the total deposit base for the country.
Right. And for you, sir, what are you factoring in? 40 to 50 billion. How much of that could you get?
So we would like to obviously garner a higher share.
Have a number, sir, in 2013. How much did you garner as a percentage of that total 33, 34 billion?
2013, the number was quite low at that point in time.
Let's
but
look
this
ahead
time
then.
We're looking at a sizable amount coming in through this. So I'm not quoting a figure to it because as of now, we are still seeing how it is, but we are quite optimistic about it and looking at some large numbers over here and pull our weight more than what we have as a share of deposit from the system.
Right. No, when you say sizable numbers and a large figure coming in, I just want to understand a range, and I'm not asking you for the exact dollar figure because that's obviously, one, internal. Secondly, it's hard to predict as well. But a broad range would work as well. Are we looking at, say, $1 billion, a little less than that, a little more than that,
Around
2
that
billions?
range, we should look at that for sure.
$1 billion at
Around
least,
that
right?
$1 billion. Yes, we should be looking at that. But
If I-
like I said,
if-
it will also play out as to what other banks are offering, because we are also quite cognizant of the fact that we don't want to offer pricing which doesn't make money sense for us. And yesterday, RBI has removed the cap. And if there is a pricing war and it results in, because as of now, this cost saving is about 3% in terms of the hedge cost and about 35 to 40 basis points in terms of CRSLR cost. But if the cost goes up substantially by higher rates, you wouldn't want to participate in a price war, is what I'm trying to say. So $1 million would obviously be a safe bet to indicate.
Harsh, there is a circular from the Reserve Bank yesterday, right? Which says that they are the interest rate ceiling applicable to fresh FCNR deposits is temporarily withdrawn with effect from June 17th. For the period of this, which is 30th of September 2026. So this is you're accounting for. I mean, I think it was restrictive before this, right? Now I think it frees all of you up.
So what RBI has done is they've removed the cap till the time this FCNR campaign is being run. As a result, the 350 basis points and 250 basis points cap is not applicable for deposits mobilized till 30th of September. Now, what it will result is obviously in helping banks offering higher rates.
Yeah.
But we are also mindful of it, Prashant, that it should not result in the cost being higher than the rupee cost of deposits.
So
Yes, even when the cap was at, you could have given 7%, we were offering 6.25. So to us, it will not make a material difference.
I see.
But to some banks who were offering at 7% and were capped at the upper end of the RBI cap, but then they will have the ability to maybe increase it by 25 or 50 basis points.
So just explain it to us simply. How will it work? It'll be the SOFR, the overnight Singapore rate plus something, right?
Yes. So the SOFR plus 350 was the cap. SOFR was about broadly about 365, so it comes to about 710. So some banks were offering at 7% levels. Now with the cap not being there, technically I can offer 7.25, 7.5 also. Okay. So what I'm trying to highlight that we as a bank, even when the cap was there, we were not going closer to the cap. But some banks had given rates which are closer to the cap. So the banks who were basically constrained of giving higher rates because of the cap, today won't have the constraint. But as a federal bank, we do not believe that we will mobilize deposits at a very high cost, because obviously it will affect my NIMs and our cost of funds. So we wouldn't want to do that part. So as of now, we are still looking at 6.25, and let's see how the markets play out and how other banks offer is when we'll take a call. And as of now, the situation is still evolving as to how we can, because some banks may start upping the rates. So it's a factor which needs to be seen as to how it evolves.
And there are no limits on leverage, right? Here. So we've heard like 15, 17, 18 times leverage being offered. That is that correct?
Yes, your sources are the same as mine. I've also been hearing the same thing, but I really do not know as to what can be done.
Has to be, right? I mean, otherwise, NRIs don't have $70 billion to bring in. It has to be leverage, right?
Yes, so they would borrow. So the NRIs can, from friends, family, and banks, borrow and put deposits. So that's an option which is available. But yes, people do expect to leverage on that part, because it does make sense, because it gives them a higher return. It's trading on the equity.
Yeah.
All right, Mr. Dugar, the other measure that was announced by the RBI is that they'll absorb part of the hedging cost on ECBs. I'm not sure, but what is the current ECB borrowing that you have? What's in the pipeline? Do you think that you can mobilize a fair amount of money by this route?
Yes, so we are keeping the options open as of now. So what RBI has done is they've given a concessional window for covering or hedging the ECB at a concessional rate hedging cost of 1.5%, which otherwise would have been closer to 3%. So you have 1.5% lower cost on that. So we are assessing how much we mobilize as deposits, and we still need to fund our advances growth. Then we would be looking at raising some sources. So we have enabling provisions to raise ECBs or bonds. So that provision is already there. So we will assess the situation. At this point of time, it also depends how much of deposits we will mobilize, because like I mentioned earlier, there is a likelihood that the deposit growth in the system will be about 2%, 1.5% to 2%, which will provide the necessary liquidity in the system as well. Okay, so if that is adequate, we may not need to do it. But if we yet need to fund our advances, that option is available at a concessional.
Okay, very quickly, Mr. Dugar, before we let you go, gold prices have corrected. Gold as a percentage, I think, of your book was in mid-teens. You can help me out on that number, but how do you see that portfolio grow? And also quickly, if you could comment on the MFI business, because that for you was showing some traction. I think on a sequential basis, it grew by 7 to around 8%. So how is that book shaping up? And, this fear of El Nino, could that be a span in the works?
Okay, so that's three questions. Let me start off one by one. First is on the gold part of it. Yes, we are quite bullish on gold. While prices have corrected, but as a business model, we remain committed to doing that part. I think we are one of the larger banks playing in this business, and we think we do understand the gold business, and we have checks and controls in place to ensure that the LTV and hence the portfolio is protected. So that's number one.
What's the LTV,
do I
sir?
see a potential? Answer is very clearly yes. We do see potential in that, and we are gunning for reasonably high growth in the gold loan business. The advantages of gold loan business is the capital requirement is almost nil. The slippages and GNP costs are almost close to zero, and the yields are reasonably decent. The only challenge over there is operating cost tends to be higher because it's operationally intensive business. But having said that, it's a business which you would like to grow, and we are seeing significant traction on that, and especially after the RBI circular last year, which allows income generating products also. So we have launched those products as well. Coming to MFI.
Yes.
MFI, yes. What we had said last time also, we are cautiously optimistic. So we're looking to grow the book. The new book, which we have been putting up since the last financial year, has been showing better collection efficiencies and lower slippages. So we are quite optimistic about this business. First quarter tends to be a little bit lean in general for the MFI industry for various reasons. But we do see traction in this, and we would like to grow this business now in this current financial year, given the fact that the challenges which we saw last year seems to be behind us.
Got it. Harsh, sorry, you want to wrap it up? Yeah.
No, please.
Okay, no, I was wrapping up. So if you want to add something,
that's about it. That's from my side. So that's fine.
Yeah. Thank you very much, Harsh. Appreciate you coming on and patiently explaining all of that to us and our viewers. Thank you for joining us. Well, I think we'll take a quick commercial break here. We're going to take on the other side, we'll talk about NSE, India's largest stock exchange, and it's filed for its IPO DRHP. We'll discuss this with someone who's headed an exchange in the past, who's sort of overseen the growth in India's capital markets. So Mr. Mrugank Paranjpai is going to be with us, and we'll also have an analyst view coming in, Mohit Mangal from Centrum Broking on the other side. Stay tuned. Okay, the NSE IPO papers have been filed with SEBI. Let's a conversation going. We have Mrugank Paranjpai, non-executive independent director at SBI and former managing director and CEO at MCX. Mr. Paranjpai, good to see you on the telly after a long time. Appreciate you joining us. Mohit Mangal is vice president at Centrum Broking. He's someone who's tracked that space for a while. Gentlemen, appreciate your time here. Mohit, thanks for joining us here. Mr. Paranjpai, let me start by asking you a simple question. What is a palatable valuation which draws maximum interest?
No, sorry. So I think you're well aware, I'm an investor, both in a personal capacity. I'm also on the board of SBI. So I don't think I'm going to get into any of the valuation. That's more for the bankers, more for the markets to decide, and people like you and the analysts. So there are no comments from my side on that.
So I had to give it a shot. So what should we? How do you see this? I mean, it's going to be it's a big event, right? Capital markets, financialization. These are all themes which are well discovered. They are some would say in a way mature themes. They're well understood by investors. But there are also secular themes which are growing very well, and NSE really sits on the top of all of it. So a marquee event in that sense?
Yeah, so I would add two things to this. I was just watching your earlier panel where you were talking about how much we expect to mobilize in the new ongoing scheme because of the liberalization on the interest rates, leveraging, etc., which may happen with foreign inflows on deposits. Can you imagine that one single stock like NSE, with the amount of foreign holding that it allows, can actually draw in close to the amount that we talked of in the entire deposit mobilization? Maybe $40–50 billion of FPI investments can just come in purely because of one stock of NSE. So I think as a country, we should feel very proud that at a time when we need foreign reserves, at a time when we need foreign inflows, we are able to offer to the world a stock which is marquee, which actually offers everybody to participate in a phenomenal economy, and which actually then gets in much more flows into the country. And the second thing, what it does is that, again, as we know, Indian institutions were built by other institutions. The SBIs, LICs, in those days, the IDBIs, everybody invested in upcoming companies. All of their capital gets unlocked, and they can put back that capital to similar use. So again, we can create the next NSE, the next SBI, the next LIC with the same money that is getting unlocked. So I think two very significant events. And at a time when I think we were all looking for more foreign inflows, I think we couldn't have looked at a better offering in the market, which will come through.
Yeah. Typically when something like this happens, does it take liquidity away from other capital market players, or this draws in existing investors in that space? I mean, how does it? What do you see happen?
Oh, I would say, especially with a stock like NSE, which will draw lots and lots of foreign investors, I would expect a lot of sovereign funds, all of that sort of long-term and very, very strong capital flows coming in. So it's not going to take away. In fact, to a lot of people who've been suddenly saying that, hey, India's lost the flavor, etc., we might be able to add back and get the capital allocations coming a little more towards our side with something like this. So I don't think it's going to take away. It's going to absolutely add.
It's going to absolutely add and not take away. Well, Mohit is also with us. Mohit, you'd be in a more open and better position to answer what should the valuation be. What's your sense, Mohit?
Yeah. Thanks for having me. So we kind of remain very constructive on NSE. I think there were media reports of about 5 lakh crore valuation, and I think that's a kind of a decent valuation, because if I look at mid-teen growth in the earnings over the next 2 years, the valuation would be 40 times on 27 earnings and 36 times on 28 earnings, which I think a company who has sustainable EBITDA margins of over 70% can kind of command that kind of a valuation.
36 times FY28 earnings.
Right.
And how does it compare to others which are already listed?
So if I compare that with BSE, BSE, if you look, has given around 50% returns over the last 1 year. It is kind of trading at over 43, 44 times on 28 and 47, 48 times on 27 earnings. So if I look at 5 lakh crore valuation, there would be around 10 to 15% discount to BSE.
I see. 10 to 15% discount to BSE. Will this be, the last question which I asked, and you would be in touch with investors, etc., across the board in this space who've participated and done so well. With BSE, and BSE has been such a stellar outperformer for investors, and I mean other capital market stories as well. How are they viewing this event, Mohit? Just as because it's a large-sized issue.
Right. So they are very, very constructive. They are looking for this IPO. So obviously we could see a lot of participation from global as well as the domestic investors into NSE. So definitely an event that is something that everyone is looking forward to.
I see. Mr. Paranjbhai, the exchange business is I dare say, well understood by investors, right? Where does typically you've seen this evolve? There are so many. There will be more products which will be launched. I mean, just see what's happening in the US, right? The level of complexity, maybe financialization at India, at our level of per capita is already very high. So maybe that is not the right metric to compare, but just the level of products which are offered in a market. Are we going that way? Is that essentially going to open up new markets, new product segments, Mr. Paranjbhai?
Absolutely. I mean, I feel very confident that with the sort of exchanges that we have, where there is excellent participation, great surveillance and controls, and we have excellent risk control as well. I would expect longer term products to come in. I would expect institutional participation to grow. So I think this really is, again, something which I think is a great long-term play. India has two vibrant exchanges. Both of them are doing very well. And I'm sure this event is really going to add to the whole market cap scenario, as well as to the opportunities that people have in the Indian market.
This entire thing around derivatives and all of that, right? Which, of course, I mean, and options, etc., is such a large part of this superb growth that we've seen across exchanges. Does that come up as a, not dampener, but does it remain a question mark in terms of what will regulation do to that segment? Will we see more of it?
I think, we've seen some very, very welcome steps from the regulators in the last couple of months. We hosted the SEBI chairperson also at a recent seminar at the IMC, and I think they were very clear. They have done what they thought was required in terms of ensuring that there is a little bit more control and a little bit more discipline in this market. And I don't think they want to really regulate flows anymore. They would like the market to decide where they want to invest, and they would like the market to take those opportunities. So I don't think we are going to see much more of what we saw maybe a year and a half ago. And I think we've seen those changes already take place. So I'm not expecting too much more in terms of stricter regulations or dampening of these markets going forward.
Okay. No, that is important in that sense. And we will continue to talk about this. The DRHP, we were waiting. Our team was in office, and I think it finally got filed late into the night. So we will be putting out details, interesting details, etc., from that DRHP through the course of the day. And we request both of you back on the program. Mr. Paranjbhai, thank you very much for joining us. Mohit, thank you very much for being here with that quick comment as well. So that is the sort of NSE DRHP filing, which is now taken place. So markets, I think, just a quick word before we move further. We're up 50 points. So we're basically, I reckon at the day's high, 24,140 on the index. But consumption and retail, etc., back in focus. Mangalam, I think we have Karan with us. Karan, welcome to the studios and welcome to the program.
Indeed, we do have Karan with us in the studio, and there's so much to speak about. Yesterday, we had, that big surge in Trent. As we speak, Trent is at the high point of trade. We're seeing some traction back in a lot of these internet companies, which are spiking as well. So Nykaa was higher in trade. This morning, early to speak about it, but Alcobev is doing extremely well because, we have a date to the India-UK FTA. And amidst all of this, over the last week or so, DMart as a stock has been up around 8% as well. And Karan's actually initiated coverage. I don't remember the last time, there was initiating coverage coming on Avenue Supermarts in a while. So we have Karan with us. Karan, let's start with the retail space. What explains the kind of up move that we're seeing in Trent right now? Because the street is expecting, the enabling resolution of 2,500 crore rupees worth fundraise to come by sometime. Stocks done well from the lows, obviously still way off highs. Your call on Trent and also on DMart. I mean, I'm curious to know what made you positive on DMart at a time when everyone's questioning the valuations.
Yes, absolutely. Morning. It's a pleasure to be here. Good morning, everyone. I think firstly, if you talk about Trent, I think this has been one of our top picks in the retail market today. I think we've been pushing the stock since the last 2 to 3 months. The drivers for there is 2 to 3 drivers here. So I think the first part is on the store addition part. So I think in the quarter of Q4, you saw store additions doing reasonably well for Trent, both on the counts of Westside and Zudio, which could have been a negative surprise. Now, this kind of gives you visibility that the growth rates are very much here to stay, and growth rates could move towards 20-25% in the near to medium term, based on the visibility of the store growth and the new store additions that they're doing. That's the first trigger which is there. I think the second trigger which is played out is also on the LFL side. So I think LFL, 2-3 quarters back, you did see a decline, and that was largely because of Zudio. Because Westside LFL continues to grow at 5 to 7%. But given the base impact...
Like-for-like growth.
Like-for-like growth.
Like-for-like growth, yeah. So I think that's seen a recovery. I think that's also obviously been because of some bit of recovery in Zudio LFL, and obviously Westside LFL remains to be in positive trajectory. Third, of course, I think this company has been very resilient as far as margins is concerned. I think despite the growth rates converging from maybe 40% plus to 15%, we have not seen margins kind of come off. In fact, margins have improved over the last 2 to 3 years, and that's largely because of operating efficiencies in the business, right? And return ratios haven't been compromised in a very big manner. So ROICs of this company is still, more than 30% best in class as compared to peers because of the inventory turns and, so on and so forth. So I think very clearly Trent lost out on valuations over the last 1 year, largely because of growth rates. Margins and return ratios was not a concern, but now because of better store additions, because of some bit of revival in the LFL numbers, and some bit of acceleration in terms of the growth rates for the company overall, going towards 20% plus, and the visibility of this going to 15% being low right now, is the reason for the re-rating of valuation multiple for the stock.
DMart. Store additions, North India are still under-penetrated, 50% of the stores concentrated in Mumbai, Maharashtra. How sanguine are you on this store acceleration actually leading to re-rating and revenue growth coming by for DMart at a time when competition is very high from across the board?
So I think DMart categorically we have studied this business in 3-4 parts, and that's the reason why we believe we have a positive stance. This is not a compelling buy as such, because at every higher valuation there will be a struggle as far as growth is concerned. So we don't see a situation when growth rates can amplify towards 25-30% for a DMart, because quick commerce will scale up in non-metro, right, eventually. But just that the time frame of scaling up in non-metro is far higher as compared to metro. So metro markets, QCom scaled up in 3 to 4 years. Non-metro may take 5 to 7 years as per our assessment. So at every higher level of valuation, you will see risk as far as growth is concerned. So 3-4 parts here for DMart, why we are positive and we have a positive bias on the stock as such. One big reason, of course, is on the store addition part. So I think if you look at DMart, it's highly under-penetrated. So if you look at the companies like Walmart, Costco and other global retail giants, in terms of store per million population, we are a mere fraction over here. So there is ample opportunity for us to penetrate as far as store additions is concerned. We only have, DMart is present, only 50-60% of the existing stores are in the top 3 to 4 states. So I think in last 5 to 7 years, it's the first time that DMart is exposing themselves to newer markets, and North is a very big opportunity here. So I think there is ample expansion initiative here, ample store addition growth, which could lead to growth rate of more than 15 to 16% as far as store growth is concerned, and which could also support growth rates on overall revenue front. LFL, I think we have seen a decline, or maybe a lower LFL from 9.5% kind of a range towards 7.5-8%. That is largely due with quick commerce. Now, as I said, quick commerce, the pain from the metro markets is largely behind us. 40% of DMart stores are from metro markets. Now, if non-metro is going to take time in terms of expansion, we don't foresee a very big pain in terms of LFL numbers from 7% to 5%. It will rather remain sticky at current levels. So putting that into perspective, you get a 20% growth for the overall company as a whole. And margins have also come off because of quick commerce price wars. Now, I think going ahead, I think quick commerce price wars are largely behind us. So because we've seen Instamart, they are focusing on profitability. Zepto potentially will go for IPO. They'll focus on profitability. I think e-com players are not in a mood to do any kind of price war. They're also focusing on profitability. So margins are also going to remain stable and sticky for DMart. So that's the second thing which is there. Third, as I said, I think from a valuation standpoint, I think we've done a benchmarking of DMart's own life cycle of 15-20 years. What we have seen is that the growth rates has been the only problem for DMart, and margins. If you look at the working capital efficiency, if you look at return ratios, there's no significant negative impact over there, which is why we believe that potentially, historically, the company was trading at close to 75-80 times P, but that was because of growth rates, more towards 25%. And now if growth rates are going to hover in the range of 18-20% or 21%, we believe 65 to 68 times P is where the company could fairly trade in the next 1 to 2 years.
All right, Karan, good to have you in the studio. Always a pleasure to speak to you. Well, I appreciate your comments on Avenue Supermart and Trent. But let's get to the exciting space, right? Alcobev. Yeah, you got it right. I believe you made a trip overseas and you've got that deal going. The India-UK FTA will come into effect in the next month or so.
He went to Italy, so I think the UK guys came to Italy and then that's where they signed the deal.
I wouldn't rule out that he was in UK as well.
I was in UK before Italy for work.
So you signed the deal there.
So tell us, how big a positive is it for the alcohol beverage space? And it seems even on the domestic front, states what's happening with regard to Karnataka, various other states as well, it appears that big fear that states are going to be clamping down, that's receding a little bit. And some of these stocks have actually underperformed. And there is this outlier hope that BR opens up as well. Put all this together, particularly with the India-UK opportunity first, what kind of a tailwind is it for alcohol beverage companies?
So India-UK FTA, I think finally it's come, and that's good news. I think we've been waiting for this since the last 2 years odd. I think two things that can play out here. One is all the companies will see a positive impact as far as bulk scotch is concerned. I think bulk scotch is close to 5 to 6% of the COGS. And with cost over there coming down, we could see margin improvement in the range of 70 to 80 bps for most of the companies. Okay. I think some bit of this margin improvement is largely priced into the estimates because we are all expecting margin expansion for alcohol bev companies, including the likes of UNSP and Radico. As a first impact, that's broad-based. Second, I think the big delta will be for UNSP, of course, on the luxury scotch. Now, the fine-tuned details of this agreement are awaited, but if at all there is a duty cut in the BIO-BII segment, which is the red label category, we will see a sharp trend divergence towards upper prestige from the red label luxury category, which means currently luxury portfolio for UNSP growth rate is about 25 to 28 odd %, which will potentially go to 40% as per our assessment because they'll become very big in terms of upper prestige segment, which is a high volume number. So I think putting this into perspective, you will see amplification of growth rates for UNSP on volume front, which is currently at 4 to 5% today on a steady state, could probably go to 7 to 8% because of this UK FTA coming in, plus there's a margin benefit as well. So putting both these things into perspective, we believe UK FTA is a very big tailwind for the alcohol market.
All right, we take that point, and just to wrap the loop, you did speak about quick commerce earlier. The Zepto RHP is out, the DRHP is out. What have your readings of that been on the other listed players? You have a call there, and Nykaa did well yesterday as well. So what's your call?
So I think on Zepto, very clearly, their focus remains to be on deep diving into existing markets. The problem for Zepto has been the AOV. Their AOV is close to 35% lower as compared to peers. And in this business, wherein the cost of delivery is extremely high, you've got a higher fixed cost structure. You really cannot leeway in a very big manner if your AOV is lower. Your take rates also improve in a very big manner after your AOV going up. So I think AOV has been a problem for Zepto. In terms of order volume, throughput, orders per day per store, I think they are reasonably efficient as compared to peers. In fact, if you look at orders per day per store, they're even higher as compared to Blinkit. But I think it's a long haul for them. How will contribution margins actually, expand in a big manner? How will EBITDA losses converge in a big manner? Instamart went through this kind of a journey. But we believe that once they go for IPO, we do see some kind of rationale in terms of path to profitability because these kind of price wars can't sustain in the environment where we are right now, wherein the cost of capital is going up with global interest rates also increasing. So I think funding issues will happen for Zepto even from here on if they continue to burn in this manner. I think on Nykaa, we like the stock. We like the core BPC story. But I think the problem has been valuations. Obviously, valuations are very premium at 85 times FY28 P for core BPC, which may definitely sustain. But I think from here on, there is no big lever for improvement or earnings upgrades. I think the only vulnerable for Nykaa would be the improvement in margins. If core BPC margins improve by 200 basis points in the next 2 years, you will see upgrades for the stock. Otherwise, whatever growth rates on core BPC is largely priced into the expensive valuations.
All right, take that point. Always a pleasure speaking with you, Karan. What we'll do on that note is take a short break with the news that crude prices have taken a leg down once again, now below $78 per barrel. And that's exactly what we'll discuss after this break. Manisha Gupta joins in. Focus on the commodity space.
Welcome back. Well, we have the Sensex weekly expiry that will be playing out today, and that's why we'll see some bit of a volatility in today's trading session as well. So let's do a quick check then in terms of the options data. Remember, the Sensex is up close to around 100 points or thereabouts. But it's evident that there is call writing being seen at higher levels. Case in point being the 77,500 call. Take a look at the premium. That's come down by close to around 50 rupees. So you've got the direction right, but because there is writing at those levels, the time value of money as well is getting eroded, and you're around 300 points away from that strike. The next strike you're looking at is 77,400 mark. So again, you've got the direction right because Sensex is up close to around 100 points, but the premium on that one as well has declined. However, the confidence is that, in fact, this market is still uptrending. And the reason I say that is because the put writing is very aggressive. The 77,200 put, the premium out there has come down to around 120 rupees. At the start of today, it was around 250 rupees. So there is writing being seen on the put side. So just plugging in those levels in terms of the options data that we're seeing, as well as the technical levels, the resistance will come in at around 77,700. The reason I say it, because there is writing being seen at 77,500. And the next level you're looking at is around the 77,990 odd. That's because that's where the 100 DMA comes in at. So this 300-point range is going to be a crucial resistance. The reference point on the downside, going by the options data just for today's trading session, is around 76,900 odd. So that's the broad range you're working with. Volatility will pick up, particularly in the second half of trade. For the timing, I think we're going to have a day of consolidation within this higher as well as the lower level. But that's about the equity markets. As promised, Manisha Gupta is standing by. She's going to tell us all that's happening in the commodity markets. Manisha, take it away.
Nigel, thank you for that. I'm looking at the crude oil prices because yesterday, even during the day, we saw 2 to 3% of gains coming, but we closed on the lower side and Asia has started yet again on a weaker side. The markets have been reacting to the Fed, the statements that have been coming in from US and Iran, and finally that deal being signed. Of course, the more formal deal is going to be signed still yet again in Switzerland on 19th of June. But this is what has brought the prices on the lower side. We're trading at a 3-month lows, so much so that we've seen the prices decline by 15% in the last 1 week, and it's down by 28% in the matter of June itself. So very sharp declines coming in for the crude oil prices. Remember, we've come down all the way from 120 to 78, and $78 a barrel was a level that we had seen on 1st of March as well. So the prices clearly, after all of that volatility, have come back to those kind of levels. So what happens now? One, of course, this is leading to the end of the war. And then apart from that, it is about reopening of the Strait of Hormuz, and the US sanctions waiver on Iran oil would also go away. There actually are satellite imagery reports suggesting that 2 Iranian supertankers have crossed the naval blockade carrying 3.8 million barrels of crude. The names of these 2 tankers also have been given. One is Dona and the other one is Hero 2. That is what the Iranian tankers also are called. So now what happens next? From here on, it is all about the 60-day clock. That is what the street will watch out for. The back and forth about uranium, nuclear, whether or not there's going to be a toll on Strait of Hormuz. So there's a lot of discussion that we would be looking at within the countries in Middle East and, of course, between US, Iran and Israel as well. Interestingly, it is going to be about 60 crude vessels containing an estimated 120 million barrels of crude that is still around Strait of Hormuz that would now be available to the global markets there. And very importantly, this is the IEA statement that has come in overnight, which says that with the kind of crude that would be available to the global markets from Iran, from the Middle East, that would lead to a massive glut of 5 billion barrels per day in 2027. And that's exactly where the markets are taking cues from as well. And that also has led to a lot of banks and brokerages now lowering their forecast for this year and the next as well. Top of my list is Goldman Sachs. They're talking about $80 a barrel for the 4th quarter of 2026. But Goldman Sachs also says that for 2027, $75 a barrel is what they're looking at for as an average for next year. For this year, for the 4th quarter, Morgan Stanley is talking about $80 a barrel as well. So all of these banks and brokerages, which were talking about 90 and 100 and 110 and 20, have all lowered their forecast as the peace deal has gone through. Citi, of course, is the bearish of the lot. They're looking at $75 a barrel for the 3rd quarter 2026. By the time it's 4th quarter, they expect the prices to come down to $70. And for 2027, their average Brent pricing is at a $65 a barrel. JP Morgan also is quite bearish, $60 a barrel for the current year itself in sense of a target. And then you have Barclays, slightly on the higher side, $100 a barrel for this year and $80 a barrel for the next year. So clearly, we're talking about anywhere between $80 to $60 a barrel of an average now for 2027.
All right, Manisha, thank you very much for that. So that is commodities in focus. We'll take a break. Latha speaks with Jairam Sridharan of Piramal Finance on falling yields impact on NBFCs. Of course, there'll be lots of stuff about Piramal Finance, the company as well, along with the industry. Stay tuned. Coming up in just a bit.
To corporate radar. The cost of raising money through CPs, CDs, corporate bonds in the Indian market has fallen by a massive 30 to 50 basis points just in the past 2 weeks. This comes after the Reserve Bank said it will pay the hedging cost for foreign currency deposits raised by banks. With cheap foreign currency funds coming their way, banks have stopped trying to access the domestic CD market, and as a result, the entire across the yield curve, yields have fallen. To understand how big a difference it makes to NBFCs, who borrow a lot from the bond market, I have with me Jairam Sridharan, Manager Return CEO of Piramal Finance. Remember, Piramal Finance has already been one of the best performing stocks in the NBFC space. It rose, I think the stock was 23% higher year to date, and that was even before the FCNR SOPs were announced. Jairam, good morning. Thank you very much for your time. Okay, so just from the month of June, how much do your costs fall, cost of raising money?
Good morning, Latha. Thanks for having me. Before I answer that specific question, a little bit of background on what has happened to the yield curve. And rates in general. There are three things that have happened. As you rightly said, the rates have by and large fallen the last 3 weeks. The week ending May 22nd was the peak. And since then, rates have generally been falling. So it's been 3 weeks now that rates have fallen. But the fall is not uniform. There are three things to keep in mind. One, the short-term rates have fallen a little bit more than the longer-term rates. So the 3-month rates have fallen by about 60 basis points. The 3-year rates have fallen by about 40 basis points. So short-term has fallen a bit more than the long-term. That's number one. Number two is that the fall has been more in the better rated entities, and it has not yet fully percolated down. So essentially AAAs, the fall has been the highest. AA plus fall is a little bit lower. A's and below, the fall is even lower. So that's the second thing to keep in mind. And the third piece to keep in mind is while rates have fallen from their peak reached on May 22nd, they are still either at or still a little bit above where they were pre-war.
Yeah.
So it's not like we are in a low rate environment, right? The rates are still a little bit higher. Now, in that context, now let's look at what happens to borrowing rates for the full quarter. For the first quarter, essentially for the entire industry, the most of the quarter has been spent on a high interest rate regime.
Okay.
Because all of April, all of May, and you're pretty much still, as I said, the 22nd of May, we were in fairly high rates. It's only after that you started seeing some moderation. So my guess would be that the sector overall, the rates would be, of the borrowing rates would be either at or even slightly above where they were in Q4. You're not going to see a fall in rates. In fact, given where they are right now, because we are still not quite at pre-war levels from a rate standpoint, this also probably indicates that even in Q2, the rates are probably going to be either at Q4 levels. They're not going to be meaningfully below. So we are not yet in a falling rate environment. We shouldn't kid ourselves. We're just a little bit of reversion.
No, we aren't. I agree with you. I mean, Kevin Warsh's statement, if anything, is indicating that the risk-free return, the US risk-free return itself is, if anything, edging higher, certainly not coming lower. I take your point on that. But, okay, so that removes one positivity from the market's lingo. The banks are definitely going to get some, 3 or 4 basis points cheaper funds because it's being, hedged by Reserve Bank. Won't that have an impact? The fact that this big borrower is out of the market, won't it in the second quarter, bring yields even lower?
No, you're absolutely right. From a pure liquidity perspective, or the amount of money available to non-banks of all kinds, corporates, NBFCs, everybody, to borrow from domestic debt capital markets, there will be a lot more available because clearly in the last few months, banks have crowded out everybody else in these markets. There is so much issuance of CDs from banks that has been happening in the market that there has been precious little room for anybody else to come and borrow money. We at Piramal, for example, haven't been in the domestic debt capital market for the last 4 months. We have done no issuance, practically nothing in short term, practically nothing in the long term. So we've done nothing at all. We've just been waiting on the sidelines for the situation to clear because there are these big daddies, these banks, who are coming in there and are dominating the entire borrowing. Now that banks have some of these other sources, we all saw the big ECB borrowing yesterday, and there is all this FCNR stuff that will come. So that's great news for us. We love it when banks get more money. Always good news for us.
Yeah. No, absolutely. I mean, why only the guy who raised the ECB? Last, all of 25, we saw PNB and BOB as big money raisers in the CD market. So if they are away and they've all announced FCNR, you will perhaps have some breathing space. So therefore, Jairam, you'll also have that AA rating, your rating upgrade, which came practically towards the close of the fourth quarter. And then you have somewhat benign circumstances for the second quarter. So if you have to give us, a September 30 view, or even an FY27 view, will your margins go up? I mean, you saw a good 14 basis point rise, even without all these in the previous year. So this year, do you go above 6.5 margins?
Yeah. So I will, Lata, with your indulgence, I'll stay a little bit away from Piramal specific numbers here. Let me make a kind of a more general comment. I think you're right from a rate environment and margins perspective. There was a period when it felt like the sunny times for NBFCs are over, right? Because there was a period of a year and a half when rates were all falling, which is obviously great for NBFCs. So NBFCs did super well in that time. And then there was this period when it felt like, hey, rates are going to start rising very quickly. And that is generally bad for NBFCs. But what has happened in the last 3 weeks has actually moved that concern away. If you look at when people were expecting, or the market was expecting, a rate increase to happen and the quantum of rate increases, you will see that both the date has gotten pushed out and the quantum has come down in terms of expectation of the market. So our economist, Devopam, has always maintained, and he continues to, that that rate increases are maybe a Feb phenomenon, not an October phenomenon. But I know the consensus in the market has been October. But now I see, you might know better, but now I see that the consensus is also moving a little bit more towards February. Right. So everything is sort of moving out, which is great for NBFC. So the fantastic outperformance that the sector has had over the last year and a half probably has another year in the tank.
No, absolutely. Just now we were flashing Citi. They had forecast, Samiran Chakrabarti, the economist, had forecast 2 rate hikes this year, probably starting August itself. Now he has no rate hike at all. He has a pause for entire FY27. And I think the market consensus will also move over there for now, at least because crude is such a big factor for us. All inflation forecasts are coming down. But as you say, this is tactical. This is for the year because the global yields are moving in another direction. So we cannot expect that yields will keep falling for us alone. So can we say NBFCs are going to have higher yields, higher margins for the year? There is a tactical gain for the next 2-3 quarters.
Yeah, I think the first half of the year is going to be hard. The second, because of what happened in Q1. See, cost of funds are going to be flat to higher, I think, for most of the sector. That's going to weigh heavily on the full year numbers. So my guess would be more flat than higher, I would think.
Okay, actually, I thought I would ask you Piramal Finance questions. You all are not in any silent period yet, isn't it? There's a long while for the results. So,
yeah, I'll do my best.
Okay, I wanted to know if, in your specific case, it can be better 6.5.
Yeah, so we have in our business, we have an underlying dynamic which has resulted in a margin improvement over time, which is kind of the reduction in our negative yielding legacy, right? And that story, as we have guided before, is that it will continue and it will pretty much close by the end of this year. So that that tailwind we have structurally, right, which is just different from where the industry is at, and that tailwind is going to continue.
Okay. And what about asset quality? After all, the past few months have been very, very uncertain months. Textile people were facing uncertainty. Food processing was facing uncertainty. Those were the 2 areas where also you all showed some bit of jitters. Will asset quality improve or stay flat or even get better?
In general, I was joking with someone the other day that when we look at the numbers on asset quality, etc., it feels like the micro has not received the memo that the macro is bad.
Okay.
So it's like the micro numbers are looking very strong. In general, delinquency numbers are strong. Collections numbers are strong. So whomever I speak with, my colleagues in the industry, all point to continued strength. In fact, we're all calling each other and saying, "Hey, what am I missing? Am I missing something? Like, are you seeing something different? Is there a sector that you're looking at that I'm not looking at, etc." But in general, the strength has been it's been somewhat fantastic actually, and not believable. Like, what is going on and why are things so strong still? We don't know, but it is very strong. Don't look a gift horse in the mouth, I think.
Absolutely. No, I just spoke to the PNB guy and he's saying that of the 8 lakh crore of loans he gave over the last 4 years, the bad loan is 0.4%. He said, even I asked them to recheck the numbers. So there is wide, agreement with what you're saying. My producer is on your side. She says the time is up. So I can't ask you Piramal Finance questions. Thank you. Thank you very much, Jairam. Pleasant conversation and a little optimistic as well. We have to wrap up on Bazaar on that note. After the break, Chartbusters.
HFCL secures a near 2,600 crore rupee order supply coming in from RVNL for the BharatNet Phase 3 project for telecom equipment, optical fiber, cable network and maintenance for 10 years. Stock up 4% in early trade.
Shares of Kirloskar Ferris skyrocket on the back of international order worth around $13.5 million to supply 30,000 metric tons of basic grade pig iron to a London-based buyer. That effectively is around 4% of their total pig iron volumes.
The India-UK FTA to be implemented on July 15 following talks between Prime Minister Modi and UK Prime Minister Keir Starmer on the sidelines of the G7 summit. Deal to allow zero duty access to 99% of Indian exports to United Kingdom. Commerce Minister Piyush Goyal hails it as the next generation pact that opens up level playing field for both textiles and Alcobev. All these stocks higher today.
Shah Metallic lays out an ambitious FY31 vision, 42,600 crores in revenues, 6,200 crores in EBITDA, and $1.1 billion of capex plan funded entirely by internal accruals. Jefferies buys into the story. They have raised their target price to 1,150 rupees. The stock perks up in early trade.
Bosch Home Comfort in focus, up 4% as promoter Bosch Global Software launches an offer for sale to pair 7.2% stake to meet minimum shareholding norms. Floor price at 1150 is a discount to yesterday's closing price, but high demand keeps the stock higher.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the markets are consolidating today. We're holding around the 24,100 odd mark. It's a Sensex weekly expiry that will play out as well. So some volatility will pick into the system later on to the trading session. But Mangalam, otherwise a good day. Some green is good. Rupee is more or less stable. The dollar index though has strengthened overnight. And crude extremely well behaved. We're talking about Brent crude prices that were at around $100, $110 per barrel, which is holding below sub $80 per barrel mark.
Yeah, so the index notwithstanding, we're seeing a lot of traction in our broader markets right now. 1,800 stocks, 1,900 stocks as we speak in the green for about 1,000 stocks which are in the red. Makes your portfolios feel a lot better for the fifth trading session right now. As we speak, and a lot of these stocks are actually seeing a lot of traction. Nykaa, for one, did well in yesterday's trading session, now is up 5% right now at the high point of trade. They have their analyst day today, and the presentation's uploaded on the Bombay Stock Exchange already. And three numbers that really stand out for me. The FY30, they've given revenue growth targets. They believe that their revenue can be anywhere between 2 to 3 times what it is right now by FY30. And were that to happen, the EBITDA would actually grow a lot faster. 4 to 5 times jump in their EBITDA and low to mid-teens EBITDA margins. So across the board, strong growth projections that the company has been given. Remember, FY26 to FY28 as well. The company had given these growth projections and managed to meet them, which explains why the stock is higher by 5%. Going into the analyst meet yesterday as well was higher in trade to the tune of around 3.5 to 4%. So the last 2 days, stock up nearly 10%. Individual stocks doing a lot better. Let's get in Ajit Mishra of Religare Broking for a quick technical check. Ajit, as we're seeing some consolidation in the frontline end, a lot of individual stocks doing a lot better. So if you could give us your call on both the indices and individual stocks.
Yeah, good morning, Mangalam. So yes, we are holding strong. It's the fifth day of index maintaining its positive bias. But Mangalam, now we have reached to the next hurdle, which is the 100 days of exponential moving average, which is placed around 24,150 mark. So it's going to be a gradual journey for the index is what we believe. But at the same time, banking is maintaining its outperformance, which is keeping the tone positive. Then we have the other rate sensitive, which are also pitching in on the rotational basis. So overall, we expect this positive consolidation bias to continue since we have this expiry also scheduled today in Sensex. Maybe there could be some volatility in the later half, but overall the tone looks positive. So means we can continue to look for buying opportunity in case if index witnesses any dip towards 23,800, 900 zone and 23,650 will continue to be a major support area. And eventually we are inching towards the long-term averages, which is around 24,450. Basis that means we are seeing rotational buying. Yesterday, the defense counters were buzzing in the trade, and it's been almost like 2-3 months of consolidation, which we have seen in most of these names. So HAL is something that we like from the defense basket, which rebounded very sharply from its major averages. So we anticipate 46.50 to be tested shortly. So with stop at 43.30, one can accumulate HAL. And then we have Power Finance Corporation from the energy basket, which has seen a decent correction after this strong move. So we are set for another base formation followed by a rebound. So here also one can look to accumulate fresh in PFC with 428 as a stop loss and 452 is a target area.
Got it. Okay, all right, Ajay. Thanks a lot for that. We look forward to chatting up with you soon. For the time being, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Anubhav Sahu of moneycontrol.com joins us to talk about a stock that he's tracking closely. Anubhav?
So, as a follow-up to a potential peace deal between Iran and the US, war premium has substantially reduced. Now, Brent crude prices, as we speak, is down by 35% from recent highs. While normalcy for the trade flows through the Strait of Hormuz can take 3 to 4 months, oil derivative product spreads could compress in near term. So, there is a high probability that scarcity premium assigned for the products and valuation can shrink. Now, with this context, we believe some of the chemical stocks which had a stellar rally recently can witness profit booking. We are particularly getting cautious on Balaji Amines and Himadri Specialty. Now, stock of Balaji Amines nearly doubled. Himadri Specialty moved more than 50% in last 2.5 months. Now, remember, Balaji Amines benefited from the traction for dimethyl ether plant, which is an alternative to LPG, and Himadri Specialty gained attention for this coal tar based chemistry given constraints for oil based feedstocks. We acknowledge that entire chemical sector would benefit from lower input and freight costs if the peace deal fructifies. Also, medium-term growth drivers like import substitution initiatives, success of China's anti-involution policy, and battery chemicals opportunity appears to be intact. That said, a good part of the growth prospects are already in the price.
All right, Anubhav, thanks a lot for that. That's about Balaji Amines. With that, what we'll do is take a short break, come back on the other side. We have the management of Kalyani Steels joining in to detail their business outlook for FY27.
Welcome back. You're tuned in to Chartbusters here on CNBC TV 18. Well, let's get a ferrous company then on the show and discuss how are the dynamics panning out on ground. We're joined by Mr. R.K. Goel, the MD at Kalyani Steel. Hi, Mr. Goel. Good morning. Good to see you in, and thanks a lot for speaking to us here on CNBC TV 18. Well, let's get to the point straight away. How is demand on ground? If you could help us out, you're normally functioning at optimal levels. So could you confirm that in terms of demand? And it's that part of the year where you go ahead and you negotiate with some of the OEMs for price increases. Sources tell me that you have increased prices by roughly around 4,000 to around 4,900 rupees per ton. Could you narrow the range, or is it bigger than that? Please confirm that to us, sir.
Good morning once again. Currently demand is very strong, led by auto industry, and exports are also pretty good for auto components. So there is a shortage of material very clearly in the market. As far as the price part is concerned, whatever price increase was there till last quarter, we could get a compensation for that. And there is a price increase even subsequent to that, for which we'll be going to the OEMs once again. But as of now, whatever was the cost increase till last quarter, that has been compensated. And the price increase is largely between 4,700 to 4,940 plus alloy increase. So that takes care of the cost part.
Okay. All right, sir. Now a couple of details. Everyone is on board for this increase, all the OEMs, or are there a couple of clients who are still deliberating, or this 4,700, 4,900 has broadly been accepted?
Broadly, it has been accepted. If there's some who have yet to confirm, but I'm sure they will do it.
Got it. Super. What about the timing of this price increase? I mean, is it a quarterly? Is it a semi-annually? Or is it a monthly? What is the period for which this has
Generally, it happens 4 times in a year.
Okay.
So this has happened now. Of course, normally should happen at the beginning of the quarter, but it has taken some time, Typically, it is between the two industries, auto OEMs as well as the steel industry. But eventually it has happened, and that's how it happens even in past.
So this will be effective from April 1st?
Yeah, April 1st, and some part is from October 1st last year.
Right. Oh, okay. So all of that will flow with a bit of a lag then?
Sorry, January 1st.
From January
1st and April 1st.
Okay, so then the margins for quarter one will look much better than the 20% you got in the last quarter, in quarter four, because now you have the price increase and input cost would be more or less as high as it was on 31st of March?
No. It is continuously increasing. Okay. And we have a very large impact because of this Iran and US and Israel war. And as you know that oil prices have gone up. All the fossil fuel related products prices have gone up. There's transportation prices have gone up, and even prices of coking coal, iron ore, everything is on the rise, and more so about the ferroalloys. There's a huge increase in ferroalloys.
All right.
So then what it means, sir, in terms of margins? Margins will hold at 20%. Will it be a little bit higher?
No, it will be by and large intact. And for this quarter, again, whatever increase is there, we will be again going to the OEMs.
All right, we take that point. Thanks a lot for that. Last year you said that you will be ready with an expansion plan this year. So we remember that. Now, just an update on that.
We'll come back to you as soon as we are able to firm up our thinking and ideas for execution.
Okay, but Mr. Goel, has the EC been received for the Odisha project? Because, the street says that this is a beautiful company in terms of demand, in terms of your products as well. They only want little aggression with regard to the expansion. And you have given a hint that that's coming about. Has the EC been got for the Odisha project?
It is taking some time.
Taking some time. But do you expect it to happen, say, in the next quarter?
It is not totally in our control. So as soon as it will happen, we will come back.
Okay, got that. You have got around 450 crores of cash in your books. And you have an ambitious plan, in terms of expansion. So could you help us out with?
There's cash in our books, free cash, and that's basically parked for expansion.
Expansions, that's 450, 500 crores?
No, it is much more.
How much?
Over 800 crores.
It is around 800 crores of cash in the books. Got it. And your expansion plan is how much, sir, for the next few years? What is the total capital?
To you as soon as we are able to finalize everything.
Mr. Goel, you're keeping the cards very close to your chest.
Yeah, we are not, we will announce at appropriate time.
No, what we want to understand basically is the direction in which this is going. If you could give us a rough range. I'm not saying that you give us...
The market is highly dynamic. The day we start placing order or we conclude, okay, now we are going ahead with so much of investment, then that's the right time to disclose the numbers.
You have the board approval for the capex, right? Or you will have to...
I think as of now.
All right. And by when do you intend to go to the board for the capex approval?
We are waiting for certain approvals from the government.
Okay.
Okay.
What about
are those certain approvals? If you could give us a sense, because you have cash of what, around 700-800 crores on your books, like you just pointed out. Is it fundraising? Is it something to do with the debt? Is it something to do with the quantum of the capex? Is it some acquisition that you're eyeing? What are those approvals? If you could give us a color on that.
I think this is not the appropriate time. Once we have all the approvals in place, then we will announce everything.
Okay, Mr. Goel, then give us some basic details. I'm sure that you can share. We had Mr. Kalyani who joined us on the show, and he was sounding extremely optimistic about business. How much of your revenue, that's Kalyani Steel's revenue, comes in from the group company?
I think it is around close to 50%.
Around 50% comes in from that. And if the group is itself going to be growing and that defense spend is going to go up tremendously with the defense vertical doing well, do you think that you as well will be moving in tandem with regard to the ambitious plan, say, of a Bharat Forge and other group companies?
You see, demand in general is very good. Okay. It is not only the group companies, it is for all other non-group companies, even for export of components and all. So in general, demand is very good. That is why we are thinking of expanding our capacity. Right. And we are running at more than 100% capacity since more than 1 decade.
Have the prices to the group company been passed, price hikes?
Pardon?
Have the price hikes been passed to the group company already?
It's all automatic. It is nothing to do with the group or non-group because it is all settled with the auto OEMs, and the same thing is applicable to everyone.
You think the promoter entity will want to come in there and take a bigger chunk in Kalyani Steel because you have such ambitious plans? And as you said, for close to a decade, I think you mentioned that you're running at optimum levels. So now is the time that Kalyani Steel will actually scale up capacity. Do you think promoter entity will actually like to have a bigger chunk in it, which means that they'll be issuing some preference shares or doing some warrants? Would that be on the cards?
We have not taken any such decision, nor we have discussed that internally. Once basic approvals are in place, then we will do all these things. It will not take much time.
Well, Mr. Goel, we love to ask you all the questions that your investors like to be, like us to ask you. So we have done all of that. For the time being, we'll wait by in terms of your expansion plans and how exactly that will pan out. For the time being, what we know is that the OEMs have accepted a price increase of 4,700 to around 4,900. It's a quarterly price increase. Your margins will remain at around 20%. And we'll stay tuned for those expansion plans, the detailing of that expansion plan.
And if I can just slip this in, from, again, what the shareholders want to know. You said right now is not the right time. You will tell us in due course. Could you give us a timeline on how soon or how late would it take for you to tell us? Give us some clarity.
Maybe by the time our next board meeting is over.
Perfect. That gives us at least some deadline to work with. By the time your next board meeting, which is, say, 2 months from now?
Yeah.
All right. Within 2 months, we'll know, Nigel.
Okay, Mr. Goel, thanks a lot for joining in. We pushed you a little bit, but you kept the cards very close to your chest. Thanks for joining in.
Thank you.
Time to slip into a short break. Come back. We'll focus on the other stocks that are bobbing around. Stay tuned.
Welcome back. As you can see at the top of our screens, the Nifty and Sensex splitting between red and green. Some consolidation is the order of the day, even as the Nifty Bank is doing a lot better today, as is the mid-cap index. A bunch of stocks which are spiking right now. Keynes Tech, over the last few trading sessions, has been doing well. This week's gains up 9%, and currently, as we speak, has moved to the high point of trade as well. United Spirits is the other one, which is up 4%. Remember, we've been talking about how there is now a date where the India-UK FTA happens. Earlier this morning, we had Karan Taurani as well, said that their premium volumes could actually increase by a lot if this deal were to happen. And obviously, to them, there is that additional kicker coming in of the cash from the RCB stake sale as well. So all these factors and the underperformance on the stock working for it. But let's talk about the cables and wire space. That too has been buzzing for a while right now. Another bullish note coming in this morning, and this one's from Motilal Oswal. Upasana joins in with the details.
Well, Motilal Oswal has put the spotlight on cable and wire industry. It believes that the outperformance for this sector will continue as the sector is the key beneficiary of ongoing infrastructure expansion and even electrification drive that the company is witnessing. Now, cable and wire industry, the demand tailwinds are likely to remain intact over the long term as India's energy transmission remains one of the key growth driver for the sector. Hence, it has the higher growth visibility will drive the overall earning upgrades is what the brokerage believes. Now, coming to RR Kabel, here the brokerage has given a rating upgrade from neutral to buy with a target price of 2,600 per share. It has also raised the EPS estimates for Polycab by 8% and RR Kabel by 11% for FY27 to FY28. On the back of the strong revenue growth outlook, supported capacity expansions, market share gains and even margin expansion going ahead is what the brokerage has highlighted. Overall, it has maintained a buy rating on Polycab and KEI Industries. And when it comes to revenue CAGR growth, it believes that the Polycab will continue to deliver industry-leading growth of nearly 22% from FY26 to FY27, followed by RR Kabel and KEI Industry, which it estimates a CAGR of nearly 21%, and lastly, Havells at 14%. So all in all, certainly a bullish note coming from Motilal Oswal on cables and wires.
Thanks a lot for that, Upasana. Well, let's turn our attention to Vedanta Aluminium. And we have two brokerages that have come in there, and they have initiated coverage on Vedanta Aluminium. First up, Citi. They have initiated coverage post the demerger. They have a buy rating target price at 560. They say the company is their top India metals pick. The drivers include the positive aluminium outlook, the growth potential, both at Balco with regard to the expansion that's currently underway, and Vedanta Aluminium has the deep bottlenecking opportunity as well. Balco, remember, the listed entity has 51% stake in Balco. Next, on cost focus, they are citing the higher captive alumina, domestic bauxite and captive coal as well. That will help them on the cost side. They're expecting the company as well to be net cash positive by FY28. That's interesting because currently they're having a debt of close to around $3.5 billion odd. But what are they working with? They're incorporating aluminium prices for the next 2 years at around $3,400 per ton. That's a little bit higher than what current prices are. So they're clearly factoring in that the aluminium market will stay in a deficit. Inventories will get drawn down, which will drive up prices by around 15 to 20% is what they mentioned in their note. It could also move towards $4,000 on a per ton basis. So they're extremely positive, it seems, on the aluminium sector. And that's why they're bullish on Vedanta Aluminium as well. Moving to Kotak, they have initiated coverage, buy rating, target price, fair value they're saying is around 600 rupees. Factors that they're working with, the capacity additions underpin around a 6% volume growth over the next few years. So that's interesting because they are one of the few aluminium companies domestically that has capacity ready as they move from around 2.5 million to around 3 million tons odd. The integration benefits as well will flow in because of bauxite and coal mines as well. And that's why they are working with the cost of production falling by around $150 per ton. They believe that the aluminium market will be in a structural deficit, and that's why prices will remain elevated for longer, which in turn will support earnings. They also cite that the free cash flows will drive the deleveraging exercise and in turn reward shareholders. So put everything together, two brokerages, they are optimistic on the prospects of Vedanta Aluminium, and that's why they've initiated coverage with target prices much higher than current levels. We'll see how that goes.
All right, we take that point. Just a word on Calpis. Calpis is a brand in India, which Varun Beverages is currently going to introduce. It's a Japanese cultured milk beverage known for its sweet, tangy, and refreshing yogurt-like flavor. And this comes immediately after the company, in its recent approval with Pepsi, said that they are looking at beverages outside of PepsiCo's fold as well. So this just adds a little more to their overall portfolio of beverages. The stock has been doing well, also aided by a longish summer this time around. So all these factors doing well for them. This is just the first of the many that the street was expecting coming in from the non-Pepsi part of the portfolio. Calpis, a Japanese-based fermented milk-based beverage. How does that taste? Whether we are interested in it or not, that's for Nigel and me to discuss in the short break that we will take right now, because we are out of time on this edition of Chartbusters. But you stay tuned. The team of Trading Hour takes the market action forward.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormis Fatakia. Joining me as always, Ritu Singh. Well, it's been a quiet day for the market so far, and well, unsurprisingly so, considering the fact that we have recovered almost 1,000 points from last week's lows of 23,070. So we have recovered significantly in the last 4 to 5 trading sessions on the index, and therefore taking a bit of a breather in today's trading session after that 4-day rally that we have seen that started on Friday afternoon. Similar sort of price action playing out on the banking stocks as well. No significant moves there, other than of course the fact that today being the Sensex weekly expiry, it brings along with it its fair share of volatility. The banking stocks are outperforming, yes, but that is of course not contributing to gains on the index as of now. 170 points higher, so the Nifty Bank is headed towards the higher end of that range of 57,000 58,000 to 58,000. That's doing well. And there you can see the contributors as well. HDFC Bank, SBI, all of them doing fairly well for themselves. Ritu, hi, morning.
Good morning, Hormaz. Yes, pretty volatile on account of that expiry. That's playing out. But at least you have the frontline index holding up, above that 24,000 mark. And that's what the bulls would be hoping. The next, of course, hurdle would be the 100-day average. That is about 24,231. So we'll see if we get there. But for now, holding up mildly in the red as we speak for the Nifty and back again in the green. The advance decline ratio also, tells you there's just about one stock that's advancing, for about 1185, 1791 stocks that are advancing for about 1185 stocks that are declining on the National Stock Exchange. Looking a bit even-steven there. Those lines look like they might be converging, so we'll have to see how that plays out. The macros are looking good. Oil is below $78 a barrel. That's looking good as well. The bank Nifty, like you said, holding up. The broader markets are doing relatively better. The IT pack also seeing a bit of red. But Hormaz, as always, has walked over to the wall to give you the list of stocks to keep your eye out on. Hormaz, over to you.
We are a couple of hours into the trading session and the index has gone absolutely nowhere other than the topsy-turvy moves that we are seeing. A positive macro indicator is the fact that oil prices are down, yes, and they continue to remain sub 80. In fact, now they are sub 78 as we speak on Brent. So they've given up almost everything that they had gained during the war starting March. And the dollar, though, that is the one that's you need to watch out for. It strengthened significantly after the Fed policy last night from levels of around 100.4, it's down to around 100.2, but still above the mark of 100. The big event from last night was the fact that NSE filed its DRHP for its IPO, and New India Assurance is one name among the selling shareholders that's expecting a big windfall, 13.5% higher. Of course, it's been a big underperformer as well, still 50% below its IPO price. IFCI seeing some profit booking. Of course, it has had its run in anticipation of the fact that the NSE will be filing its DRHP, and LIC not among the selling shareholders in the IPO. They are going to stay put, and stock is up around 2.5%, although slightly off the highs of the day. You take a look at the newsmakers today. RR Kabel is doing well. On the lines of the wires and cables companies received an upgrade today from Motilal Oswal, 6% higher from the stock. The 6% higher for Nykaa as well. It just put out its investor presentation a couple of minutes ago, and that's doing well. Reddington on reports of Apple hiking product prices. So that's led to a 5% up move here. And Anthem Biosciences, after a block deal that took place earlier in the day, the stock is up around 4%. Defense stocks were doing well yesterday. They continue to do well today as well. MTAR Tech made a new record high in today's trading session of around 85.75. So that's up 2% as well. Zen Technologies, Acres, Solar Industries, all of them continuing to add on to their initial gains. The big India-UK FTA, which comes into effect soon, has seen a positive reaction on a lot of these textile companies. Gokaldas, Wellspun Living, both up around 4%. What's also up 4.5% is United Spirits. And lastly, the volume-led movers in today's session. Take a look at the move seen in CDSL. The stock is up in 4 out of the last 5 trading sessions. So from around 1150, 1160 odd, the stock has moved to 1400 in just 5 sessions. Star Health and Carborundum too seeing healthy gains on very strong volumes, Ritu.
Okay, Hormaz, thank you very much for running us through that list. Another stock in focus is Shyam Metallics. That's up about more than 3% in trade today, buzzing on the back of their FY31 targets that the company has released. Nigel D'Souza is here to put that into perspective. Nigel, what kind of commentary is coming in from Shyam Metallics?
Well, Shyam Metallics had their investor meet here in Mumbai, just yesterday, and they've laid out a very ambitious 2031 target. Let me run you through a few details. They're talking about revenues at around 42,650 crores. The EBITDA number they're talking about is around 6,236 crores. Very, very ambitious if you just look at what they've done and where they believe they're headed. Now, in terms of return ratios, they're going to maintain it healthy at around 20% to around 22%. They also say that the net cash positive number will continue, and the entire focus is going to be on value downstream products. And that's why the EBITDA number in various segments are going to balloon up. A lot of focus is on stainless steel, and from around 77 crores, they're talking about 1,100 crores by 2031. That's extremely ambitious. Now, on carbon steel, from around 1,700 crores, which is bulk of the EBITDA right now, they're saying it moves closer to around 2,866 crores. On special bar quality steel, that's going to move to around 1,019 crores or thereabouts. So that's broadly the breakdown in terms of the EBITDA number. For this, there'll obviously be a capex. They have highlighted that around $1.1 billion of capex will be deployed over the next 4 to around 5 years, which will be funded by internal accruals and there'll be no external debt. Let's see how that goes because that's a very ambitious number. The past record was pretty good. In the last 20 years on a far lower base, they have compounded their EBITDA, their revenue as well as PAT at around 20% CAGR. But from this base, it'll be interesting to see whether or not they can go the distance. Jefferies, one of the brokerages that were positive, they're even more positive. They have a buy rating. The target price they've upped to around 1,150 from around 1,040 earlier. What are they factoring in? EBITDA and EPS to compound at around 14 to 16% over the next 3 years. They believe the company is offering one of the best growth potential in India metals. So that's why they're optimistic. Stock as well, reacting positively.
Nigel, thank you for that. But stay on because the street wants to hear more from you, this time around from Kirloskar Ferris. And that's a $13.5 million order that the company has won. 9.5% higher on that one.
Well, that's right. Kirloskar Ferris, that stock is buzzing in today's trading session. They have bagged an order, which is not very large in size, but it's clearly an effective one from the street's perspective. Remember, the stock, though, had corrected close to 25% from its 52-week high. So it appears it's recouping some of that lost ground. What's the news piece? They've received a contract for the supply of pig iron. The buyer, well, they has an office in London, UK. The order details, well, quite interesting. 30,000 tons of basic grade pig iron on FOB basis. Contract value around $13.5 million approximately, and the latest shipment will need to be completed by the 15th of August. So around 30,000 tons is effectively around 4% of their entire pig iron volumes, which is ballpark around 7 lakh tons approximately. So not very large in size, but it appears the street is latching onto this. Maybe they see a bigger potential in the time to come as well with regard to exports, and probably that's the reason why the stock is excited on this not too large order.
Nigel, thanks very much for putting that into perspective. Another stock that's excited is Nykaa. That's buzzing on the back of the company's beauty and fashion segment targets for FY30 that they've presented in this Investor Day presentation. Mangalam Malu is here to put all of that into perspective for us. Mangalam.
Well, tall targets given by Nykaa in its Investor Day, and they've given targets for all the way up to FY30 as well. In fact, on an overall basis, they target nearly 50,000 crore plus gross merchandise value in both beauty and lifestyle businesses. And what do this mean for their overall business right now? For FY30, they expect the revenue from current levels to grow anywhere between 2 to 3 times. And were that to happen, the EBITDA would obviously grow a step faster, and they expect the EBITDA to either quadruple or grow 5 times over the next 3 years from FY26 levels as well, which would mean that the FY30 EBITDA margins would be anywhere between low to mid-teens, and this compares with the last year's number of close to around 7.5%. So they expect revenues to triple, EBITDA to go 4x, and margins to double from current levels as well. For the beauty segment, they target a GMV growth of anywhere between 2 to 3 times and healthy double-digit EBITDA margin. Remember, the last quarter exit numbers were closer to high single digits on the EBITDA. So they expect that to move to healthy double digits. And the retail footprint would expand from current levels to around 600 plus stores by FY30 as well. For fashion business, now this has been a bit of a drag on the profitability of the company. Broke even just in the last quarter. They expect that there would be high single digit EBITDA margin by FY30 with GMV growth target anywhere between 3 to 3.5 times, and steady state EBITDA margins, which is beyond FY30, they believe could cross that 10% mark as well. And some other highlights, House of Nykaa, which is basically their own brands, which did a net sales value of around 3,200 crores in FY26. They expect this portfolio to jump all the way up to over 5,000 crores by FY30. And Superstore, which is basically their B2B business, they expect to reach about 1 million stores in the country with a gross merchandise value target of nearly 3,500 crore plus. This number too was shy of 1,200 crores in FY26. So across the board, multiple, multifold jump is what we're seeing across all their parameters, and which is why the stock is up 5% now, despite being 5% higher yesterday, taking this weekly gain to double digits.
All right, some tall claims there. Let's see if the company makes good on them. Mangalam, thanks very much for bringing that into perspective for us. The stock now up more than 6% as we speak. We'll take a short break, but up next, we're going to bring you all the action from the bond market with Manisha Gupta, so stay tuned.
Welcome back. As promised, we're shifting focus to the bond markets. Then Manisha Gupta is here with the latest. Manisha.
Thank you for that, Hormuz. Well, the Indian bond markets are facing a dual directional impact at this point in time. On one side, you have the US and Iran peace agreement. And on the other side, markets are dealing with the hawkish US interest rate outlook as well. So on one side, the decline in crude oil prices, which, by the way, have now declined below $78 a barrel as well. Our new 3-month lows on your screens is pulling domestic yields lower. But then on the other side, you have the hawkish US outlook, which is capping the domestic rally, as it were. Interestingly, you have the dollar index as well, which is now trading above 100. The markets are looking at the Indian rupee as well, which has been choppy, opened with a gain. But since then, we've seen banks also selling dollar for the exporters therein. The Iran nuclear program is something that the street will now watch out for the next 60 days. It's going to be a lot of back and forth, and the markets will look at the new US Fed statements coming in during that period as well. So it's going to be a choppy market at best, is what the street believes. In the meanwhile, there are also better numbers coming into the Indian bond markets therein. There is a strong inflow that we've seen from FCNR deposits, which seems to be helping the bond markets, which are absorbing external shocks. And then you have foreign investors, which have injected to the tune of $2.2 billion into the domestic bond markets over the last 9 sessions itself. The corporate bond market, the trading there also has seen a volume surge as well, driven by, of course, lower digital entry barriers. And then retail and institutional overall trading volumes have gained up by a 30% on an year-on-year basis, to the tune of hitting a record number of 22.07 lakh crores therein. The larger corporations also are looking at fundraising. This is being done via the short-term debt instruments. So when you look at the overall number there as well, from 1st of April until 15th of June, the companies raised 4,39,000 crores via 1920 commercial papers issuances. So we're looking at stronger numbers coming back into the street right now.
Thanks very much, Manisha, for bringing us that. But let's stick with the bond space. And one of the most exciting corporate actions recently has been HDFC Bank, that has raised $750 million in offshore bonds that were priced at 90 basis points above the 5-year US Treasury at a coupon rate of 5.067% per annum. The bank becomes the first lender to take advantage of that 1.5% fixed swap that is provided by RBI for banks to raise money overseas. And it's the largest such deal by any Indian lender since SBI's $750 million bond in 2023. So let's bring in Arup Rakshit, Group Head of Treasury at HDFC Bank, for more on this one. Arup, thank you very much for joining us here on CNBC TV 18. You know, a very tight, just a 90 basis point spread over the 5-year US Treasury. Were you surprised by this kind of a reaction, given what's happening, with the global volatility? And, what is the takeaway? How do we read into this, into how, the India risk premium is being treated by, some of these investors overseas?
Thank you. Thank you for giving me this opportunity. No, I think we were not surprised. I mean, we were working with our partner banks, and they had guided us in how to go about it. And, it was a very successful bond raise, I must say, but surprise, no. I think, India has got one notch upgrade since we had hit the market last time. And I think there was only one bank who had come into the bond market after the upgrade scenario of India. So from that perspective, there's a supply side which will start now coming in. So we were quite happy with what we have got. Yes, it's a very tight pricing, and we have managed to get that. So it shows that India is still recognized well in the international markets, and obviously it has priced the name well also. The HDFC Bank name has also worked in this situation.
Well, Arup, $750 million raised. Let me just push and ask you if this is it, or will you come back in the market sometime in the near future to take advantage of RBI absorbing this hedging cost, and especially because the bank CD ratio has been high. There's been pressure on the deposit front. Some of this borrowing coming from overseas, will that ease some of that pressure as well?
Two things. You asked two questions. First, it's just 2 days, so let us first the money come in and things like that. So we did move quite fast, and our overall approach has always been that whenever there has been an opportunity in the international market, we have hit the market. If you see our track record in the last 5 years, that's how we have gone about. It's not a plan that every year will come or something like that. So if there are opportunities which exist, we have been opportunistic in that. Insofar, will it ease? Yes, so it will obviously ease the dollar rupee part of it, the weakness of the rupee that was coming. If this kind of a supply starts coming in, that will get eased out. There has been a gap between the deposit rate and the credit growth rate. So some amount of that will also get eased out once the FCNR deposit starts really picking up and coming on shore. So those are the positives which are likely to happen for the market.
Arup, the other repercussion is what is happening in the domestic bond market as well. I mean, every dollar that you raise overseas, and banks like you are huge borrowers in the CD market. That is one less rupee that is borrowed in the CD market. We've already seen the short-term rates fall by about 30, 50 basis points or so. We had, the Piramal Finance CEO earlier saying how it's a bit of a relief for NBFCs. Do you expect the short-term rates to trend lower given banks like yourself have tapped that market? More are expected to follow suit.
If you see the decent market, it has already come down ever since the announcement of RBI came through, including some of the CD rates have come down. But I think it's a question of the CD rates have also been a question of the demand supply between the credit offtake and the deposit side growth, which has had a decent gap going into this the current fiscal. We have had a decent credit offtake which has also happened, and deposit growth has not really seen that kind of a growth. So that's where the bulk deposit rates and the CD rates have been a little high. Yes, so we hope that if external supply starts coming in, some easing on those rates will happen. But there's also the hangover of the 10-year yield, which will continue to be a little on the right only, a little higher on the higher side only, because obviously the other things don't change. The SBL issuances and all will still remain. The easing out on the bond market, which has happened for the FPIs, where some amount of money has already started coming in, that should help ease out the bond yield also.
Arup, I don't know if you could help us with the FCNRB rates as well. The bank has priced them at about 6%, and I'm seeing some of your peers like Bank of Baroda, others price it at, Federal Bank as well, 6.25, 6.5%. And now, of course, you have RBI that has removed the cap on 3 to 5 year FCNRB, fresh bonds. Are you comfortable with the current rate? Could it be revised upwards because of RBI removing this cap? And is there an initial estimate or on how much the bank could raise through this window?
So from the rates perspective, I think every bank will be somewhere anchored on what the market is at. So yes, we were among the first ones to announce the rates. People have come with different rates, higher, lower, both sides. We will always be anchored on what the market is at. We don't want to be away from the market. So let's see how the market pans out on the rates. Yes, I know the RBI has removed the cap, but you'll also have to see that where I can deploy the funds. So that will also play out on what the rate is offered at. With regards to the amount, let's see, because last time, there is a history of last time how much money had come in. Obviously, things are a little different to last time. So let's see. I mean, I don't want to hazard a guess here how much money can come in. Not just for us, even for the country. Maybe a country that there have been talks in the market about a $40-50 billion from the market, from the country's perspective, through the FCNR route. Let's see. I mean, very early days. It's just about 10 days have elapsed since the circular has come out. People are figuring out the processes and everything, and every bank is in touch with customers. So let's give us some time to figure out how this pans out.
But, Arup, if I'm not wrong, you were one of the biggest beneficiaries in 2013 as well. You, along with SBI and ICICI Bank, of course, having a better overseas presence. Any ballpark figure you could give us? I mean, how much did you exactly raise last time? Could you top that?
I think last time we were almost over 10% of what market had raised. I don't want to hazard a guess at this juncture because every bank has its own ways of doing business now. So that time there were a lot of fewer banks who had presence overseas. This time, many banks are there in the city. But yes, we are very hopeful we will be able to be among the top few banks only in this field. Let me not quote it.
Giving us a number, but Okay, not giving us a number, but will be among the top few banks that are able to raise some of the largest sums through this FCNRB window. Arup, thank you very much for taking the time out. I know you're pressed for time, so we'll let you go and hope to have you back perhaps later when you have clearer visibility on how much the bank is able to raise. Thanks very much.
Thank you. Thank you.
Okay, we'll slip into a break on that note, but when we return, we'll discuss market technicals with Rajesh Palvea of Axis Securities, also get his top trading bets.
Welcome back. Well, the markets have taken a bit of a leg down in just the last few minutes. The Nifty Bank, well, it is where it was at the start of the show, but the Nifty is down around 30 points. So still holding on to the levels of 24,000. The bulls would be hoping that this level or at least the base lower down at 23,900 or 23,800, that is one level that should sustain on a closing basis as we go into the second half of the weekly expiry session. A good time to get in Rajesh Palvea from Axis Securities for a quick chart check, some trading ideas as well. Rajesh, good morning. Thank you for joining in. Are you witnessing some exhaustion at that 24,150 level now that we have recovered almost 1,000 points from last week's lows? Your call on the index now and your trading ideas for the morning as well.
Yeah, hi, morning. So yeah, after a strong rally of almost 900,000 point from the recent low, Nifty is consolidating in range only. Though we have already registered a breakout about 24,000 level, but still follow-up buying action is still missing in the Nifty. Bank Nifty has also run up sharply in last couple of week, and here also we are seeing some sort of consolidation in Bank Nifty also. But overall, if we analyze the broader market, it clearly shows that there is a strength in the market, and the kind of stock specific buying action is taking place, which gives us confidence that maybe after a brief consolidation, we could see a breakout about 24,150, 24,200, and once that happen, I think this really can extend further, and possible target towards 24,500 to 600 we may witness in the coming weeks. So buy and accumulate would be the strategy on the downside. 23,850 needs to keep as a stop loss. Until these levels are intact, I think buy on dips one can adopt as a strategy. On the stocks front, we are focusing here at capital market related theme. Lot many stocks have shown good accumulation in last couple of days, and there is a breakout took place. So Angel One is looking attractive. The way stock managed to give breakout of its multiple supply zone on weekly chart, we believe that this stock has potential to extend gain, and possible up move we may witness towards 385 to 390. So one can buy and accumulate. On the downside, 340 needs to keep as a stop loss. Another stock where we are focusing at this juncture is Amber Enterprises. Here also, since last couple of days, stock is making higher high low formation, and looking at the buying action in especially in last 2-3 trading session, which clearly showing that buyers confidence is there in the stock, and the near term chart is already registered a breakout. So projecting target of 8,250 to 8,300. On the downside, 7,880 needs to keep as a stop loss.
All right. Thank you very much for that. Appreciate your time here. And we just slip on, into a short break on that note. But up next, we'll get you Nikhil Khandelwal from Systematics Group, who will be here to give us more on market fundamentals and his views on some sectoral bets. Stay tuned. 24,064 on the Nifty. It's now in the red, down by about 21 points, led lower by the IT pack as well. The broader markets, though, still holding in the green, and the Bank Nifty trading with gains of about 200 points as we speak. But let's get in Nikhil Khandelwal from Systematics Group, who joins us now to discuss market fundamentals and his top sectoral picks. Nikhil, welcome. Thank you so much for your time here on CNBC TV 18. Let me first start with that, conference you recently concluded. There are 29 promoters that have made presentations, and you've come up with this detailed note on it. But, in a few lines, if you could sum up the mood from the conference for us, are corporates a tad more optimistic now, given that, the war in West Asia seems to be tempering down, oil prices are, looking better, cap expense picking up. What was the biggest takeaway?
Yeah, hi, good morning. No, so we had a very interesting event just a couple of days back. We invited companies which are primarily in the small and mid cap space from 5,000 crores to about 75,000 crores of market cap. Companies ranging from financials, capital markets, to manufacturing, consumption, healthcare, etc. The larger takeaway from the interactions with the companies was, everybody has seen probably the most difficult period of, logistical uncertainty, the overall inflationary environment heating up, unavailability of raw materials, etc., etc. Even the tariff scenario, which continued to play over the past 3 quarters, has played a lot of havoc on companies' supply chain. The companies are broadly covered ground from there and are looking at a market much more optimistically. Most of the companies across these 29 to 30 names spoke of volume growth of upwards of 15 to 18% in their business, whether they were wealth management firms, whether they were chemical manufacturers, etc. The second thing was that everybody's beginning to now look at this weekend signing of the peace agreement and potentially looking at a life beyond the West Asia war. So I think given all of that, there is a lot more optimism across most of the businesses. We believe that the cyclicals, companies which are more cyclical in nature and more prone to the inflation cooling down, are looking more stronger at this point of time in terms of their earnings expectations and visibility, while others are more optimistic given that a lower inflation will help cool down will actually bring a lot of consumption thrust in the Indian economy.
In that light, Nikhil, which are the areas that you have put money to work with during the war period as well, and now with this uncertainty coming to an end, and as you mentioned, looking at a life beyond the war, are you making any tweaks to your investments that you have made recently?
No, so I think we've been consistent on investment in certain sectors, which we believe that a war or no war, I think they would be areas which will continue to show sustainable growth. So we have been quite positive in our weightage on the larger manufacturing space in India, whether it's the capital goods manufacturing, whether it's the electronics manufacturing, or even certain export-oriented businesses like textile manufacturing. We have been quite positive on that space in general, because what we have seen that the China plus one and the Europe plus one theme has continued to play to the advantage of Indian manufacturers, whoever are in export-oriented businesses. And in general, the India's power and capital goods manufacturing theme will continue to play strong. So I think that sector and that weightage for us in that space remains quite strong. However, given the last a week or so of developments, we believe that a significant amount of weightage we are now bringing back into cyclicals, and we believe that a lower oil is not just a reduction in inflation; it is also a potential sign of strengthening in rupee. It can also lead to a lower interest rate environment in the mid to long run. So given all of that, we have started to become quite overweight on financials as a space. We believe that the larger banks will be the first big beneficiaries of the next 6 to 12 months as inflation, rupee, and the interest rate environment cools off. So the larger banks becomes a big overweight position for us, led by the ICICIs and SBI in particular. Cap goods and manufacturing space, which I spoke about, I think across the board, whether it's defense, whether it's power, or it's railways, or textile products, I think across the theme, we like a lot of large to mid-sized companies and believe that they will continue to be a strong play going forward. So I think these are the two top most weighted ideas and investment themes as far as our house is concerned.
All right, Nikhil, thank you very much for laying that out for us. Out of time, and hopefully hope to get you back later for more on your views. Thanks very much for being here today. We'll take a short break. When we return, more on the markets in just a bit. Well, high valuations in the Indian market have been a concern for domestic and international investors alike. But do higher valuations also imply underperformance? Now, according to a Jefferies note, multiple sectors have seen strong returns in the last few years, despite valuations being high. Hormas puts the spotlight on the takeaways from there. Hormas.
There's a very interesting note from Jefferies. Usually you would say that, oh, expensive valuations means there is a cause of concern for a lot of these companies. But Jefferies has highlighted eight examples in the last 15 years where they have said that in instances like those, valuations may have surged to those quote-unquote expensive levels. But despite that, a lot of these stocks and sectors have delivered strong returns over the next 2 to 3 years. Now, which are those sectors that they have highlighted? Defense, NBFC, cement, FMCG, retail, capital goods, hospitals, hotels. And this is over a period of the last 15 years where Jefferies has analyzed all of these sectors across different periods. Look at defense. They analyzed this between September of 2022 to July 2024. By September 2022, the defense sector had a PE of 41 times, which was 41% higher than its 10-year average. Despite that, by July of 2024, the entire sector had outperformed the Nifty by a whopping 229%. And that was led by a 33% EPS CAGR as well. Now, what led to this outperformance? The strong indigenization push, order visibility, import substitution, all of that contributed to this outperformance on the defense companies. Look at the NBFCs as well. Now, come October of 2021, their PE was 78% higher than their historical 10-year average, but yet they managed to outperform the Nifty by 40%, led by a 23% EPS CAGR as well. Now, what led to their outperformance? It was the rising credit penetration, the improved asset quality after the IL&FS saga that took place, and scalable digital models as well. All of them contributed to that growth. Cement was one such sector as well. By June of 2014, their PE multiples had risen to 74% or higher than their 10-year historical average, yet they outperformed the Nifty by 47% by May of 2017. But this is possibly the only sector where the earnings growth has been subdued as a 7% EPS CAGR, and that was on the back of hopes of an infrastructure and construction upcycle during this period. The FMCG at one point was the darling of the street during that 5-year period between 2014 and 2019. And that time their PE multiples were higher by 44% than their 10-year average, yet they outperformed the Nifty by almost double, and it was a 12% EPS CAGR as well. And that was led by the formalization of the economy, the GST-led shift to organized players, and of course, mind you, all of this is excluding ITC, the numbers that you just saw. Retail as a segment also did very well between December of 2019 to September of 2024. Their PE multiples were 41% higher than their 10-year average as well by December of 2019, yet they outperformed the Nifty by almost 2.5 times and an EPS CAGR of 20%. Here too, it was formalization and premiumization that led the outperformance along with the rising discretionary spends. Capital goods as a sector was first getting re-rated between September of 22 to June of 24, and here too the outperformance of the Nifty was 90% despite their valuations being 28% higher than their 10-year average. The contributing factors here were the investment cycle revival after COVID-19, strong order inflows, better margins, all of them were there in place. Hospitals as a sector also did very well over this 4-year period between December of 21 to October of 25, outperforming the Nifty by 85%, a 23% earnings CAGR, and this is despite their valuations being 44% higher than their 10-year average. And this was, of course, because of the rising insurance penetration, operating leverage, and their improving operating revenue per bed. Now, all of these are prior examples, and now they are saying that the power sector is heading into a similar theory of higher valuations, but they might go on to outperform. Why is that so? The supply and demand side drivers are aligning, and therefore the power stocks are among the best structural plays to play this strong demand visibility. Additionally, there are improved balance sheets of the state electricity boards, and of course the rising data center demand that is proving to be a positive as well. Among the top picks within this space, Jefferies has highlighted JSW Energy, Adani Energy Solutions, Premier Energies, and Siemens Energy. They've highlighted the fact that expensive valuations may not necessarily mean underperformance. They've highlighted prior examples as well, and power is now heading into a similar theme as well. And with that, we head into a short break. Back with more on the markets on the other side.
Well, let's get you the macro signal for the markets, holding up above 24,000, but still in the red. Crude oil prices, they've tumbled today. That's been the big macro story following the signing of this initial peace agreement between the United States and Iran. Both the benchmarks are down by more than 1%. The Brent crude now trading below $78, in fact, $77.35 a barrel now. It's been a massive retreat from the highs of, just over $100 we saw a few weeks ago. The rupee has seen some volatility, but it is now trading at about 94.25 against the dollar. Again, helped by these lower oil prices, although the US Fed keeping interest rates steady, officials signaling a potential rate hike later this year. This hawkish tilt did boost the US dollar index, and that did add some pressure on all emerging market currencies, including the rupee. But the rupee is appreciated for several consecutive sessions now from the record lows that we saw earlier. But beyond the oil prices, what's also supporting it today is signs of renewed interest from foreign investors, that were buyers in equities. The 10-year benchmark, G-Sec yields, they're also tracking this surprisingly hawkish signal coming from the US Federal Reserve. But that upward pressure on the yields has been tempered to some extent by the falling crude prices. As a result, the 10-year is now trading at slightly lower 6.86 as we speak. So that's the macro signal for the day. And on that note, Hormaz and I will take your leave on this edition of Trading Hour. But stay with us. Halftime report will be up next shortly.
Stocks trade steady after US-Iran ink a peace agreement, even as US Federal Reserve strikes a hawkish tone. Healthcare and financials notch some gains, while IT and utilities drag.
NSE files its draft offer document with SEBI revealing 10 shareholders will sell near 6% equity. The likely over 30,000 crore rupees offer will not just rake in profits for the sellers but can now draw in crucial foreign portfolio money.
Stocks of textile exporters climb after July 15th is fixed as the effective day for the India-UK FTA, and EU promises to ink its FTA by year-end. Indian exporters to UK will see tariffs drop to zero, while imports of spirits by the likes of Diageo-owned United Spirits will get cheaper.
Brent crude oil slides below $78 a barrel after Trump signs the deal with Iran ahead of the Friday schedule. The move aimed to opening the Strait of Hormuz quicker could see 60 oil vessels with 120 million barrels sail through.
Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Ekta Batra and Vinny Motiwala. Girls, good afternoon. Consolidation, that's the name of the game today. Absolutely flat on the Nifty, but yes, there is some negative bias that we are seeing below that 24,100 mark. We've come up from the highs of the day. The high today was 24,180 and we've seen a sharp fall from those levels. But again, there is a recovery which is underway. Whether that's sustains or not is the question that we're asking, but for now a recovery nonetheless. We do have mid caps which are trading in the green, but again it's a flattish move on that index as well. PSU banking index, that's the top gainer, contributing to the gains that we're seeing from the lows. Bank Nifty is also recovering, and the recovery that we're seeing on the Nifty is on the back of that as well. IT continues to sulk, so that's the top sectoral loser. We do have the auto index also, which is not doing so well, but overall I would say for now consolidating despite the peace deal agreement being signed as well. For the recovery that has come by, the question is whether that sustains or not.
Absolutely, whether that sustains or not is something key. 24,000 as of now is what the Nifty is managing to hold on to. An advance decline ratio today a bit more in the favor of declines versus advances, what we're seeing. So yes, that's what we'll watch out for in the trading session. Apart from that, a lot of individual movers also in trade. You have New India Assurance that's managing to hold on to gains. Star Health also managing to hold on to gains. So that's something that we'll keep an eye out on. As of now, the convergence of the advance decline ratio is nearing, but that's something that we'll keep an eye out on.
Hi, girls. Yes, absolutely. It is a day of consolidation, definitely for the markets at this point in time. But what stands out is that there are around 139 stocks which are at fresh 52-week highs in today's trading session, and around 28 stocks which are at fresh 52-week lows. So just want to point out that a couple of stocks which are at fresh 52-week highs include the entire banking space. So do watch out for that. We have Federal Bank, J&K Bank, Bank of Maharashtra, all of these stocks which are at fresh 52-week highs, along with the likes of Angel One as well as HCC. So all of these stocks are doing well today. Otherwise, Bajaj, Consumer, Bharat Forge, all of these stocks are now sitting at fresh 52-week highs in today's trading session. So really, you have to dig a little deeper and you will find those stocks which are creating some amount of wealth and value in this market. But let's concentrate on our What's Trending segment today. We're focusing on the UK-India Free Trade Agreement. First, we have Devyani, who's breaking down the impact on India's textile sector. And later we have Mangalam, who's decoding what changes in the alco beverage space. So Devyani, over to you.
Well, India's textile exporters are gearing up for a major structural tailwind that's coming their way, the FTAs. The India-UK FTA will be coming into effect from the 15th of July onwards, which means that it will eliminate 8 to 12% of import duties on textiles and garments that we're currently paying, opening up a $28 billion UK market for us, where we currently just export about $1.5 billion. Now, it's not just the UK. The proposed India-EU FTA could also provide duty-free access to us to a $260 billion market, where India already exports about a $5 billion worth of textiles, and that's expected to be signed by the end of this year. Now, the big benefit, India closes the tariff gap with Bangladesh, Cambodia and Vietnam, improving competitiveness in key markets such as ready-made garments, home textiles and carpets. Now, analysts expect a 5% market share improvement in the UK over the next 2 years and a potential 50 to 100% jump in exports to Europe over the next 5 to 7 years post the FTA signing. Now, the key stocks to watch out for are Gokuldas Exports, KPR Mills, Pearl Global on the garment side, and Indocount, Wellspun Living, etc. on the home textile side.
Okay, Devyani, thank you so much for taking us through the beneficiaries in the textile space because of the FTA. But we have Alcobev stocks that are in focus as well on the back of this India-UK FTA. And Mangalam is here to decode that. Mangalam, United Spirits is surely in high spirits.
Well, a lot of them are saying cheers because, while this was expected, now what we have is a date. From July 15th, it will be in effect. United Spirits up 4%, Radico Khaitan up 4%. If you look at, the other smaller players as well, Allied Blenders as well as Tilak Nagar Industries, all of them are in the green, outperforming the other parts of the market as well. So what we know so far is that this deal will come into effect from July 15th. The important part, however, while all the details aren't out, we know from the initial talks of the deal that the 150% import duty on Scotch will now be halved to 75% immediately, and over the next 10 years there will be a gradual way of reducing it to about 40% itself. So all of this would mean immediately there would be a price reduction, assuming no other increase in duty, to the tune of around 5 to 15%, and all the prestige and above products which were earlier imported will now be available at a slightly cheaper price, which means that volumes of that will be increased, and that would lead to some sort of uptrading as well. Now, over the last year or so, ever since this was first announced, we've been speaking to companies, and at various points companies have given us some estimates. United Spirits, for one, would save about 110 to 120 crores on this. Radico Khaitan would save about 70 to 75 crores on this. AB, Allied Blenders and Distillers would save anywhere between 30 to 35 crores as well. The question is whether they let that sit in their EBITDA, or do they pass it on to increase their volumes. This morning we had Karan Taurani, who joined us as well, said that once this would happen, it would, for a player like United Spirits, increase their volumes from about 4 to 5% to between 7 to 8%. So that would be an upward shift. And the important part for United Spirits, apart from the stock being an underperformer lately, is that over a month and a half from now, we'll also get that one-time payment that the company will get from the sale of Royal Challengers Bengaluru. So that additional cash coming to their books gives them a proper trigger in the next month and a half, along with the UK-India FTA. So all these factors leading to all the whiskey players, including United Spirits, to say cheers.
Okay, cheers it is ahead of Friday. Thank you so much, Mangalam, for joining us with all those details. So that's what UK FTA means. Comes in effect from 15 July. Ahead of that, these sectors are buzzing in trade today. Let's slip into a short break now. When we come back, we'll have Sir Bharto Mukherjee of CareEdge joining us. We'll discuss the impact of delayed monsoon, possibility of an El Nino on the Indian economy.
Welcome back to Halftime Report on CNBC TV 18. Nifty, moving and inching closer to the 24,100 mark. Tried, went back to the green, again coming back to the red. So let's watch out for that. But a lot of stocks that are moving around in the trading session. And to take us through those buzzing stocks, we have Hormuz here to take us through those details. Hormuz, over to you.
Some interesting movers in today's trading session, and none better than New India Assurance as an underperforming insurance name. The reason why the stock is up around 12% today, it features among the selling shareholders in the NSE IPO and an acquisition cost of 30 paise, and is going to be a big windfall for them when they sell over 1 crore shares of their own in this IPO. Now, the others, some companies that are reacting to their growth targets that have been laid out. Nykaa is one such name. The stock is up 10% in the last two sessions, 7% today, was up another 3.5% in yesterday's trading session. And the other one that's reacting in today's session is Reddington, and there have been reports of Apple hiking prices of their products, and the stock is up for the 7th day running today, and during this 7-day period the stock has gained as much as 13%. Polycab and Kia Industries were stocks that were doing well in yesterday's trading session, and taking cue from that, RR Kabel is following suit, is up 4%, slightly off the highs of the day though. The upgrade coming in from Motilal Oswal earlier in the day, the firm continues to remain bullish on the entire space. There's some profit booking seen in some of the high-flying names in yesterday's session. IFCI, of course, has had its run in anticipation of the NSE IPO, extending its losses now down 7%. IDBI Bank was up 18% in yesterday's trade, seeing some profit booking, and Central Bank of India too coming off yesterday's highs. And lastly, some stocks at 52-week high levels. Netweb Technologies continues to move higher, another 5% added to its tally. Carborundum Universal doing well on very strong volumes. Titagarh Rail and Syrma SGS at a 52-week high as well.
Okay, all right. Thanks very much, Hormuz, for joining in and giving us all of that perspective. But let's focus on the macros now. The IMD has forecasted a below normal monsoon this season. In a recent report, CareEdge Ratings warns that the weak rainfall could possibly fuel food inflation, with tomatoes, onions and potatoes amongst the most vulnerable commodities. The report also notes that deficient rains may hit rural incomes, which in turn could weigh on overall consumption demand in the economy. To discuss this and more, we have Sarbarto Mukherjee, who's the senior economist at CareEdge, joining in. Mr. Mukherjee, thanks very much for taking the time out. I just wanted to understand, how resilient do you think the Indian economy could be if in case we do see this deficiency come through as adversely as it's predicted?
So thank you for having me. The thing is, the Indian economy is much more resilient as compared to the past, but the impact of the El Nino would be there. So we are not completely immune to the fact that the rainfalls are going to be deficit. We have the resilience part largely stems from the aspects such as a better irrigation coverage. So currently, almost 60% of the total gross sown area is under irrigation. And also we have diversified a lot to the non-allied or the non-crop component side of the agriculture, which is less reliant on the rainfall. So these are the aspects which add to the resilience aspect for the economy.
So, Mr. Mukherjee, you said maybe not such a big impact on GDP. We are resilient here, but there could be some impact on food prices. Can you give us a sense of how much of food prices already risen? Because it's just not a possibility of El Nino or deficient rainfall. We did have supply chain issues because of West Asia crisis, which might not continue now. But adding on to that pile on because of food inflation, how much have prices risen? What is the risk of price hike from here on?
So while we have a good buffer crop levels, then that's largely in the wheat and the rice segment. But the food inflation could be higher for crops like, say, for segments like vegetable, pulses, and edible oil. It's also important to keep in mind that El Nino is a global phenomena, and countries like Indonesia and Malaysia, from where we import a lot of palm oil, are also likely to see the adverse impact of the El Nino. And if there is a fall in the production in those countries, the pass-through can happen because almost 50% of the global, 50% of the Indian edible oil consumption is imported.
Mm-hmm. Mr. Mukherjee, good afternoon. I want to understand one thing, right? While you said obviously the link between GDP, monsoon, that's reducing. 43% of the workforce is still agriculture side, right? Approximately. One, does this cause maybe a bit of a slowdown then on the rural front if we see those concerns coming in, rural demand slowdown, and then overall weighing down on the GDP as well?
Yeah. Obviously, the impact won't be much from the agri GVA growth front, but the impact would play out from the price as well as the rural demand side. Given that 43% of the employment comes from there, and if there is an overall impact on the agricultural output, that can have impact on the rural consumption side. And over the past couple of years, the rural side of the demand was holding up well as compared to the urban side. And any impact on the rural economy will play out in the consumption story.
Okay. Well, Mr. Mukherjee, while we're talking about El Nino, Citi has come out with an interesting report where they've upped the India GDP forecast simply because of Brent crude prices, which they now see softening to around $70 from that $93 forecast that they had for Q2 to Q4 of FY27. So that obviously is going to be an incremental positive for us. Just give us a sense, how much of a benefit do you think it could be? How much do you think it'll offset the impact of the possible El Nino? And in your sense, what is the GDP forecast that you're working with?
So we are holding on to the GDP projection of 6.7%, assuming that the Brent oil prices average around $90 per barrel. Even though the Brent crude oil prices have corrected to a level of around 80, there can be some upward pressures from the buildup of inventories, which during the crisis, we have seen a huge drawdown on the inventories of the crude oil prices. So realistically, the crude oil could average somewhere between 85 to 90 levels, and we are still waiting for the cues to see at the levels at which the crude oil prices will stabilize going ahead. In terms of the El Nino part, the impact will largely depend upon the temporal and the spatial distribution of the monsoon that will play out in the coming months. Obviously, there will be some impact, and our 6.7% growth projection already takes into account that there will be a lower rainfall this year.
Okay. Quickly, Mr. Mukherjee, coming back to the food inflation bit, you indicated some of the food prices or some of the crops which could be impacted. How much price rise has already taken place? What is the risk? If you can give us some numbers.
So overall headline inflation wise, we are currently projecting around 5%. And as I have said, this number already takes into account the impact of El Nino. The food price rise, for example, in the global edible oil basket, if you look at the Food and Agricultural Organization's data, for the month of May, the overall inflation in the edible oil segment was around 29%. So that will basically flow into the domestic basket, and the food price inflation can go up and will basically peak towards the third quarter of this fiscal year.
Mr. Mukherjee, do you think there is any intervention that may be required? It's too early, but from the government point of view, anything in terms of price stabilization fund, MSP adjustments, anything that already should be taken as a step now given the El Nino conditions that are expected?
So government has already taken some measures like, say, restrictions in the exports of certain commodities. I think government will see how the monsoon progress, and we are at a very early stage right now. And we'll see how the progress of the monsoon goes on and then devise the policy accordingly. And obviously, if there are pressure points, then we can see some import of pulses from abroad to adjust the price pressure within the economy.
Okay. I didn't quite get what you're expecting from the RBI.
So from the RBI's perspective, we see a possibility of a rate cut towards the end of this calendar year. But RBI will now basically hold and see how the overall macroeconomic condition plays out, especially on the inflation side. The risk on the growth side have subsided significantly with the recent deal between US and Iran. But the inflation risks are still high. RBI will see how the impact is flowing into the household expectation part of the inflation.
Okay, take that point. A lot of factors to consider before any policy decision could be taken. Mr. Mukherjee, thank you so much for joining us today with your thoughts on a possibility of El Nino and what the policy outcome could look like going forward. Time for a break now. Manish Hatirumani of Deen Dayal Investments will join in with some trading strategies on the other side.
Welcome back. Well, for the markets, it's extremely quiet at this point in time. So we have the Nifty, which is just about higher by around 15 odd points, and the mid-cap index, which is up around 0.2%. The bank Nifty also up around 0.4%. But one space which really stands out this year, in fact, is a couple of these pharmaceutical stocks which have a little bit of an R&D bent or a research and development bent. So I'm just going to name a couple of them. I'll start with Spark, which is up around 75.8% this year. We have Panacea Bio, which is up around 45% from the vaccine space, Wockhardt, which is up around 44%, and Orchid Pharma, which is up around 35%. So 4 of these companies are linked to R&D in some form or manner. So I'll take you through each one of them. Spark is basically the R&D arm of Sun Pharma. It recently sold a $195 million priority review voucher, which they received from the US FDA, which means that they've received this amount of money into the company, which will then fuel their R&D programs going forward. So that stock has been in focus on account of that, and that's possibly one of the reasons for the outperformance. Separately, we have Wockhardt, which has been in focus because their novel drug Xenic, which is the drug that they've developed themselves, is an antibiotic which is now approved by the US as well as India. And the peak sales potential for this is $1.5 to $2 billion. So that continues to be in focus on account of that. Orchid Pharma, remember that last year the company bought back the rights for a global ownership of an antibiotic drug from a pharma company, Allecra. So this particular antibiotic is something that they themselves had in their portfolio, which was then out-licensed to Allecra. It eventually hit the market, and now they've basically bought back the rights. So the street would be looking at this particular journey quite closely. Lastly, Panacea Bio. The company recently announced that they're a part of the DenStar project, and they are the developer of Dengue-All, which is basically a tetravalent dengue vaccine targeting all 4 virus serotypes of dengue. So that is something which the street will be focusing on in terms of efficacy and the usage of it. It's currently in late stage development in India. So these are a couple of stocks which are in focus, which do have this R&D bent and which have performed very well on a year-to-date basis.
Okay, makes sense. Thank you for bringing that on the radar. So some of those pharma R&D stocks on our radar. The markets have recovered, by the way. The Nifty is very close to that 24,000 mark. So it's a good time to get a technical check on the markets. Manish Hathiramani, proprietary trader and technical analyst at Deen Dayal Investments, is joining us on the show now. Manish, good afternoon. Thank you for joining us. Will we continue this recovery that we're seeing from the lows? What are the next important levels on the Nifty now?
Good afternoon, Sonal. Thank you so much for having me on the show. As we had discussed last time, the key level really was 23,700. We have flown out of that resistance level. This should take us from the short term to 24,250, and that should be the first pitch stop. If we're able to sustain that, we can go as high as 24,500, 24,600 also. The new support range currently is now 23,700.
Okay, point taken there. And, Manish, could you talk to us about your individual names as well before we have some couple of queries from our viewers? So before that, your individual stock picks.
I'm working with 2 buy calls. The first one is on SBI Life, which is for a target of 1880, stop loss of 1750. After a downward move, this stock has shown early signs of a breakout after crossing the resistance of 1770. If we can keep above the levels of 1810 on a closing basis, this stock can achieve higher levels, 1880 being the first stop. Eicher Motors is the second one for a target of 7850, stop loss of 7450. This stock was trapped in a sideways zones for a couple of weeks. That was idly between 6750 and 7500. We have broken out of this range with higher than average volumes.
Manish, talking about some of the queries we've received from our viewers, the first one is from Utpal Jain. He's writing to us from New Delhi, holding 180 shares of RR Kabil, and this is at a price of 1,400 rupees per share. Is asking whether he should add more shares of the stock. What's your take on the technicals? Is it a good level to add more?
No, I would not suggest doing that, because when we broke out of the resistance, those were as low as about 1,600, 1,700 rupees. We have kind of moved up. I would rather suggest that he should start using trailing stop losses on his particular trade. For the time being, the stop loss should be around 2,000, and we can expect a target of 3,000.
Okay, all right. We have one more. Tina Kapoor writes to us from Chandigarh. She's asking if she can buy Sterlite Technologies for the short term, or is it a long-term play?
Sterlite Technologies is currently quoting at about 600 rupees. We have had back-to-back upper circuits right now, so I would not recommend somebody to buy it at this point in time. If we can get a drop closer to the levels of about 500, those would be good supports. And then she can continue holding that for a target of about 850 to 900.
Okay, take that point. We have one more for you, actually. Kamal More is writing to us from Mumbai, holds 300 shares of ITC at 380 rupees a share. He asked whether to hold or exit at current levels. Sitting on a loss currently, what are you suggesting, Manish?
This seems like a sell simply because we have been in an intermediate downtrend. However, if we can get above the levels of about 310, 320, those would be resistance levels we can continue holding thereafter. If he breaks the levels of 280, I would recommend a sell rather than exit from the current strategy.
Okay, point taken there, Manish. Thank you so much for joining us this afternoon, taking us through your individual bets, as well as helping viewers also get answers to their queries. So thanks so much for that. But let's move on and talk about what's happening in the world of F&O. Nifty's come back about the 24,100 mark. What does it mean there? Mangalam is at the F&O desk to take us through all of that. Mangalam, afternoon.
Well, markets near the day's high, so doing extremely well for the frontline index. Alongside that, we have the mid-cap index doing extremely well as well. The only counterbalancing factors right now for the Nifty are the two largest components. We have the Nifty Bank and the Nifty IT index. The Nifty Bank has been outperforming, but the IT index is the one which is underperforming, and which is why we're seeing the market, seeing some selling at higher levels or a bit of a lid on the gains that have been kept. Low volatility would make bulls feel a lot better. So the India VIX, which is down about 2.5% after being rather flat in yesterday's trading session. And we have a lot of consumer discretionary stocks which are buzzing for various reasons. Yesterday we had Trent, which did well. Today continues to do well. United Spirits higher on prospects of better margins from the India UK FTA. You have Nykaa on the back of strong commentary coming in their investor day. So all these consumer discretionary stocks doing a lot better. In the last few minutes or so, if you look at the intraday chart of the Nifty Realty Index, that's also seen a bit of a spike. Yesterday the Realty Index wasn't doing as well, the Mumbai-based ones in particular, and now that dip has been bought into, so we'll monitor that too. But as we move along, the 24,100 call writers are still fairly active on the Nifty, telling you around 24,200 to 24,250, where the 100-day moving average comes in. There could be some supply. Even as the support has moved higher, 24,000 put writers equally active, telling you that the support for the Nifty is around that 23,900 thereabouts itself. A lot of stocks on our radar, shorts added on Infosys and L&T Finance. A lot of long positions initiated on names like LIC, which is doing extremely well in today's trading session. We have Radico Khaitan as well, which has been spiking among all the other Alcobev stocks. A lot of long positions added there too.
Okay, thank you so much, Mangalam, for joining us. So with that F&O setup, markets, by the way, is at the day's high. There's a sharp recovery from the lows, as Mangalam mentioned as well. So keep an eye out on that. For now, we are at that 24,128 mark. We'll slip into a short break. When we come back, we'll get you more on markets and stock-specific action on the other side.
Welcome back to Halftime Report on CNBC TV 18. Nifty near the day's highest point, 24,120. Around that mark is what the Nifty is trading at. And since we started the show, we've seen a 40-point uptick from that level as well, 40-50 point uptick. Now let's look at the contributors, right? You have the bank side. So private banks, they are coming up top of the list. HDFC Bank, ICICI Bank, Axis Bank, and we have SBI also. So bank is something that is managing to pull up the markets, while IT on the flip side today is not doing that great. Infosys, TCS, we have seen on the flip side being a bit of a drag, while Maruti Suzuki, Reliance also seeing some bit of a red on the screen. But markets have seen that up move and recovery coming in as well. So that is what we will keep an eye out on. But yes, that's what we are watching out for in the trading session. Broader end of the market also is managing to do well. Let's go across to Manisha, who is here also to take us through what's happening in the world of commodities. Manisha, over to you.
Well, thank you so much for that. It is the crude oil prices that we are talking about, because the prices have continued to decline at a 3-month low, trading below $78 a barrel. Well, there's two things that the street is watching out for. One, of course, is the US and Iran peace deal that has happened. And the second is the very hawkish comments that we have seen come in from the US markets therein. Joining us then to talk about that is Sushant Gupta. He's director at Mood McKenzie. Sushant, hi, thank you so much for joining in. First of all, your reaction on the signing that we've seen happen between the US president and Iran. A more official signing perhaps would happen on 19th of June as well. But from where we stand with a 60-day clock ticking away, what is your initial take?
Hi, thanks, Manisha, for having us here. I think this is something which the market was always expecting. And if you see the trend of oil prices from April to May to June, the prices have been coming down. And just before the peace deal announcement was made, we saw prices already hovering around 85. Now, so a lot of the market is expecting that the Strait of Hormuz flow will start, after the peace deal is signed this Friday, which is tomorrow. And I think that's just being priced into the market.
Sushant, we've seen prices come off quite strongly, trading below 78. Would you say much of this news is now factored in, or there is still a further downside that you're looking at?
In fact, we are looking at the opposite. We think a lot of this news has already been factored in. The market is still forgetting that this is just the first step. Yes, in the right direction, but this is just the first step. We potentially see that the flow passage through the Hormuz will be very slow, because there are hundreds of ships waiting, on each side of Hormuz. The upstream production, which is shut in, will take time. The tanks which are full will take time to draw down. And by the time the crude oil coming from Hormuz will hit the market or the destination market, it will take time. And by that time, the inventories will keep drawing down. And towards, in July, mid-July, end of July, we expect inventories to hit the lowest point. And that's when the market will, start reacting to that. And we expect prices to slightly move upwards, from there.
So are you looking at an 80 coming back, or an 85 as a possibility?
Yeah, so I think in the next, for July, we are forecasting on an average $85 per barrel and slightly moving upwards from August. And only after that, once the passage is established, market is relaxed, that things are moving on smoothly, then the market are fundamentally oversupplied, but just that it takes time to get that oil back in the market. Then we see a slow decline in the prices towards 2027.
How are you also looking at the second half of 2026 and most part of 2027 in sense of supplies and demand going forward? The IEA report, which says that 5.05 million per barrel of day of surplus is what they are working with in next year. Increased supplies from UAE, from OPEC, from Iran, etc. will start hitting the markets by next year. How are you looking at this year vis-a-vis next year in sense of production, supplies and demand?
So, first of all, this year, the demand growth will be negative. We are expecting a decline of around 1 to 1.5 million barrels per day, with slight recovery after this news and the lower prices we see in the second half of this year. But net, we will still see a decline in the demand for this year. Next year, demand growth will be positive. But at the same time, the supply growth will be extremely positive. So supply growth will surpass demand by, order of magnitude. and we expect prices for this year, right? Even though second half of this year, from August, as I was saying, will be in the range of $85 to $90. August, September slowly come down toward December. So average for this year, we're looking at $104 a barrel, right? Average for this year. And for 2027, because there will be much more supply than demand growth, we expect close to around $80 for next year. The weakest point being the second quarter.
And how are you looking at the demand consumption going forward?
Well, I think demand for this year is falling but decline, but 1 to 1.5 million barrels per day. For next year, we expect the normal levels around 0.5 to 0.7 million barrels per day of demand growth for next year, which is much lower than the supply growth.
And what kind of supplies would we be looking at next year?
I think I don't have the number off the top of my head, but it is definitely much more than this year. It could be 5 to 6 million barrels per day of supply growth. But again, that really boils down to we are year-on-year change is something which we can't compare because we are starting out with a low number for 2026. But yeah, I mean, UAE, as they're not a part of OPEC Plus now, we'll be looking forward for more volumes from UAE. But for the key countries in OPEC, Saudi, Kuwait, Iraq, and Iran, I think that the growth will be slow, returning towards 2027. So net, I think the growth will be much more than the demand growth.
And how are you also looking at the China factor? Because the only thing that put the prices in a balance in the month of May and June, perhaps, was that 3.5 million barrels per day of a demand decline from China. Do you see that coming back?
Well, I think China, as I said, oil demand growth in China is anyway, has been slowing down. Gasoline, diesel are already peaked. So I think we were not anyway forecasting or banking our oil price forecast, solely on the oil demand growth in China. The large part of the demand growth is from Southeast Asia and India, and that's what was driving whatever positive demand growth we were seeing, pre-war. So China certainly will not, add to the demand growth. The story in China is still the same. Oil demand is peaking, and the focus more towards diversification of demand towards renewables. That's the key story for China.
Okay, Mr. Gupta, thank you so much for joining us with your insights. Manisha, thank you for taking us through that conversation. With that, we'll slip into a short break. When we come back, we'll get you more on markets. We'll focus on Nika as well, which is buzzing in trade today. Stay tuned for that.
Welcome back. Well, for the markets, it's consolidatory. The bank Nifty, however, has picked up pace, so that seems to be gaining some amount of traction, up over 300 odd points. But just watch out, because there are a lot of volume buzzers in today's trading session. So Shelly Engineering is at around over 40 times its 2-week average in today's trading session in terms of volumes. We also have Supreme Industries, which is at over 12 times its 2-week average in today's trading session. And Devyani is also joining the list with almost 11 times its trading volumes on a 2-week average in today's trade. So a lot of volumes generated on a couple of these counters. But nonetheless, Nykaa is also buzzing on the back of the companies targeting more than 5 billion gross merchandise value, or GMV, for their beauty and lifestyle business by FY30. Mangalam is here to put all of that into perspective for us. Mangalam, tell us more.
Well, it's an 8% up move that we've seen on the stock, and this after a 5% up move that we saw already. So the street was obviously fairly gung-ho on the prospects that the company has in terms of growth for the investors for the next few years, and that's exactly what's taking place. Even as the analyst day is underway, the presentation is uploaded on the exchanges, and the key highlights tell you the long growth runway that the company is projected for itself. I'll tell you some of the numbers. 50,000 crore or over $5 billion in terms of total gross merchandise value across their businesses by FY30 is what the company is projecting. And what does this mean in terms of their own reported revenues and EBITDA? Well, from current levels, FY26 levels, they project the revenues to grow anywhere between 3 to 4 times in the next 3 years. And were that to happen, the EBITDA would actually grow one step more. 4 to 5 times is the EBITDA jump that they are expecting. They are projecting a near low to mid-teen sort of margin for the company. Remember, last year, the EBITDA margin of the company was close to 7.5%. So they're expecting the margins to double from current levels as well, even as the revenue triples from current levels by FY30. The two key segments of the company, beauty business, they expect near 3 to 3.5 times growth in their gross merchandise value out there, with double-digit margins. Remember, this number, all of FY26 was 7.5%, 8%, and they expect that to go into double digits, so that's a positive. And add to that, they are expecting to touch over 600 stores as well. So not only will this growth be online, but a large part of that will also move offline. So the community building for Nykaa continues. For the fashion business, which has been a bit of a margin drag, broke even just in the last quarter, they expect good growth coming in here as well, with EBITDA margins of double digits, or rather high single digits in FY30, from just about breaking even in the fourth quarter. And the target is over a sustained period, they could do more than 10% or double-digit margins in the fashion business. The other parts of the business that are strong call-outs, House of Nykaa, which is their own brands, which include the likes of Dot & Key, K-Beauty, etc., which did about 3,200 crores in gross merchandise value last year. They are projecting that to grow over 5,000 crores as well. And eB2B Superstore, which is basically their wholesale fashion business, wholesale beauty business, they expect to reach 1 million stores by FY30 with a GMV of nearly 3,000 to 3,500 crores as well. This was a number which was sub 1,200 crores in the last year. So multifold growth across all parameters is what the company is targeting, and which is something that the street is excited about.
Okay, take that point. Thank you so much, Mangalam, for joining us. By the way, Brigade Enterprises is on our radar. Company's Morgan Heights project, which is in Chennai, there is a permission which has been revoked. So basically, Tamil Nadu authorities, they have said in their order, but remember, this order is dated 8th of May. So it's been like 1.5 months since this order was issued. They say that they cannot begin construction, or they cannot continue construction on this particular site because they started construction before they got approval from Wetland Authority, which is needed as per clause 9 of some of the regulations there. This particular project is an important one for Brigade. They have a project area of 1.09 million square feet. Their own interest in this one was 0.08 million square feet. They had launched it back in Q1 of FY26, and this is something which could be a dampener for them. We need to understand what kind of sales value were they expecting from there, but considering it's a 1.09 million square feet of area or a project that they're looking at, it has come in as a negative for the company. We'll watch out for any clarifications from them because the order date is in May, 8th of May to be very specific. So why did this come to light right now is something that we need to. Okay, so 2,100 crore is the gross development value from this particular one. So it's a big one for a company like Brigade Enterprises. We'll keep getting you more updates on this one. The stock though has come up sharply from the highs, is down 2.5% as we speak. This is coming in as a negative for the company. We'll slip into a short break and come back with more details on the other side.
Welcome back to Halftime Report on CNBC TV 18. Like you can see at the top of the screens, we're seeing a good recovery that's come in for the Nifty as well from when we started the show. 24,130 around that mark. So near the day's highest point is what the Nifty is trading at. Bank Nifty continues to see a bit more of an up move as well, and broader out of the market sustaining their positive move in today's trading session. Advance decline ratio has moved more towards advances versus declines. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch.
Stocks are steady after US and Iran ink a peace agreement, even as the US Federal Reserve strikes a hawkish tone. Healthcare and financials notch some gains while IT and utilities drag. NSE files its draft of a document with SEBI revealing 10 shareholders to sell nearly 6% equity. The likely over 30,000 crore rupee offer will not just rake in profits for the sellers, but can also draw in crucial foreign portfolio money. Stocks of textile exporters are climbing after the 15th of July has been fixed as the effective date for the India-UK FTA, and the European Union promises to ink its own by the end of the year. The Indian exporters to UK will see tariffs drop to zero, while imports of spirits by the likes of Diageo-owned United Spirits will also get cheaper. Brent crude slides below $78 a barrel after Donald Trump signs the deal with Iran ahead of the Friday schedule. The move, aimed at opening up the Strait of Hormuz quicker, could see 60 oil vessels with 120 million barrels sail through. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. Well, the markets, the bulls are trying hard to turn this into a good day, to turn this into a fifth straight day of gains for the markets. Well, it's a 60-odd point recovery from the lows of the day, but the range of the market has been very narrow all through the session. 24,050 on the downside, 24,150 on the upside. And this has been the case all through the last 2 to 3 days for the better part of this week, as the index has continued to trade in this very narrow 100-point range. But the good part towards the end of the session has been that we usually end up at or near the highs of the day, and that is something that the bulls would also be aiming for. Of course, today being the Sensex weekly expiry as well, so that will bring its own fair share of volatility on the in the second half of the trading session. Now, what's doing well today though? PSU banks, and they are being led by SBI. This is going to be a windfall for them as well, as they are among the selling shareholders in the NSE IPO. So PSU bank index is the top sectoral gainer. The Nifty bank is the one that is ensuring that the index remains in the green, while on the other side it is the Nifty IT that has been sulking all through the day. 330 points higher on the Nifty bank, and now they are at the higher end of the range of 57 to 58,000. They are just 70-80 points away from the 58,000 mark, and that will be a positive as well for the bulls. The banking stocks continuing to do the heavy lifting, as has been the case since last week. Of course, there are a lot of broader market stock specific movers as well. Nykaa has now moved to a 52-week high as we speak, after some positive commentary coming in from its investor day, where they have laid out some targets as well for FY30, and the stock is now up 7%. Good going for Nykaa, good going for Reddington as well. That's another 7%. There are reports of Apple looking to raise prices of its products, and that has also done very well in today's session. Both Reddington and Nykaa trading with gains of around 7%. But of course, New India Assurance continues to remain the top gainer in the broader market, still holding on to gains of around 12%. Now let's focus on the top story first. Then US President Donald Trump and Iran President Masoud Pezeshkian have digitally signed a memorandum of understanding to end the conflict and reopen the Strait of Hormuz. CNBC's Dan Murphy joins us now with all the updates on the 14-point MOU.
Overnight, the United States and Iran electronically signing an interim deal to end the war, reopen Hormuz, and open up a 60-day negotiation window on some of the finer points of this conflict. But of course, the pushback has been quite loud, including from those within the president's own party, who have suggested that perhaps the United States may have given away too much to Iran in order to get this deal done. Of course, the president also suggesting overnight that he would keep up the bombing if Iran did not come to the table over the next 60 days. Listen in.
If you don't adhere to the agreement, I don't want to do that, but we're going to bomb the hell out of you. And I don't think that they're going to veer from the agreement. What else am I going to do? Am I going to say I'm going to take you to court? Let me take you to court. Let me sue you. No, we're going to bomb the hell out of them if they violate the agreement. I don't want them to. I want them to honor the agreement.
President Trump speaking earlier. So the question is, what is inside this deal? This is a 14-point MOU that has now been electronically signed between the United States and Iran. As I mentioned, on top of the table here is the reopening of Hormuz, and markets have already responded to that. At the same time, the agreement also paves the way for Iranian sanctions relief as well. Again, this is going to be really critical in assessing just how much supply is going to be returning to the market and from from which point. But of course, the deal has also been criticized for some of the other arrangements here that are on the table, at least for now. Of course, the deal is silent on Iran's missile and drone program. It's also silent on Iran's support for regional militias and its proxies as well. These were key red lines, even concerns raised by the Gulf states and by Israel.
Dan Murphy there with the latest updates of that 14-point MOU. But the positive for the Indian markets has been, as a result of this MOU, is the 25% fall that you have seen in crude oil prices from the record highs of the war. Now Brent trading sub $78 as well. And this is due to the imminent opening of the Strait of Hormuz. And that has resulted in City India cutting its inflation forecast for the country and, more importantly, raising its GDP forecast to 6.9% from 6.6 earlier. Lata is here with all of those details. Lata.
This is a seminal event for India, the 26% fall in crude prices. I'm elaborating the City India report simply because this is definitely the first of a whole host of brokerages who are going to come with similar reports. Now, the City India says that based on their global city saying that the average crude price for 2026 calendar and for the first quarter of next year is being brought down from the earlier $93 per barrel average to $70 per barrel average. So a $20 fall. And because of that, they expect India's balance of payment surplus, which they originally estimated at 5 billion, to now come at 45 billion. But here it's not only Hormuz Strait. This is also because of the FCNR-B scheme that Reserve Bank has announced. They're expecting flows on that and hence the BOP surplus. The surplus will be higher, Citi says, if Indian bonds get included in the Bloomberg index. Then on current account deficit, this is directly linked to the Hormuz Strait. The current account deficit for Citi earlier was 2% of GDP. For FY27, they've brought it down to 0.9% of GDP. And why? Because the trade deficit is going to be lower, and that's because of a $31 billion fall, net fall in the oil import bill. Then inflation. There, the forecast is being lowered by 20 basis points. Earlier, the Citi forecast was 4.9. Remember, RBI is sitting at 5.1, but Citi is bringing it down to 4.7. And this is because, of course, further rise in domestic prices at the pump are not expected. More importantly, fertilizer prices, chemical prices, petchem prices, all of them had shot up in the global market. And, you know, the WPI in India also went up to 9.5%. That will at some point get transferred to consumer prices was the fear. Now that fear goes out because global fertilizer prices have crashed, crashed to half actually, from $900 to $400 for urea, and so on for other petchem prices as well. So that's why the inflation forecast brought down. GDP, most important, the forecast is upped from earlier 6.6 to 6.9%. The Reserve Bank is standing at 6.7. Now, this Citi bases on the RBI model that a 10% fall in crude prices results in a 15 basis rise in GDP. Now, this is a 20% fall in, or even more than a 20% fall in crude prices, and therefore they've raised the GDP forecast by 30 basis points. Because of the expected fall in inflation, Citi now expects no rate hike at all. Their earlier forecast was a rate hike starting as early as August, and one more. They had 2 hikes. Now, the risks to all these forecasts is that if the Middle East peace process for some reason breaks down, let's hope not. Of course, it's Friday evening that the actual signing will happen. But that is the risk. If it breaks down, or if El Nino turns out to be much worse than expected. Under current forecasts, El Nino is not expected to have an impact on the inflation. Again, I'm highlighting this because Citi is likely the first of many other forecasts that are going to raise GDP and lower CPI forecasts.
A big note there indeed from Citi. Lata, thank you for summarizing that for us. Take a short break. On the other side, the US Fed has decided to keep rates unchanged. It's first under new chair Kevin Warsh. More on the other side. Welcome back. India's largest stock exchange, the National Stock Exchange or NSE, has filed its IPO DRHP with the market regulator SEBI. Yash is here with more details from that offer document. Yash.
Well, the largest stock exchange in India and, of course, coming out with the largest fundraise through an IPO in the history of Indian capital markets. The National Stock Exchange filing its IPO DRHP after what was a decade-long wait of multiple times going back and forth with SEBI. This happened yesterday evening. And as far as the details of the IPO are concerned, all of them in line with what we've been reporting, in the last 2 days. So just taking you through those details, it is a complete offer for sale document, which means the entire fund raised through this IPO will be taken by selling shareholders in the proportion to which they would be selling their stake, and nothing comes into the company, into the National Stock Exchange as fresh capital. How much is being offered? 14.89 crore shares is what would be on offer, which forms 6% of equity dilution, which would be the size of the IPO itself. Now, from sources, what we've been given to understand, and this is what we had reported yesterday as well, is that in terms of number, in terms of size, this is likely to be about 30 to 32,000 crore rupees. That's going to be the size of fundraise, and that is likely to value the National Stock Exchange at 5 to 5.33 lakh crore rupees. It gets important to understand which are the selling shareholders as far as the IPO is concerned. The largest selling shareholder will be State Bank of India. It owns about 3.23% stake in NSE, and as a part of the total offer, it would be selling about 16.62%. MS Strategic owns about 1.2% stake, second largest shareholder, selling shareholder. As a part of the total offer, which was upwards of 14 crore shares, the amount of shares which would be offered by MS Strategic would be about 10.75%. And just like that, you can see the large shareholders who would be selling their stake as far as NSE's IPO is concerned. There are multiple public sector institutions who would come forward to sell their stake out of the total holding in the National Stock Exchange. Now, let's understand what is the paid up capital, what is the offer size. The total paid up capital of NSE is about 247.5 crore shares, and what is on offer, that is upwards of 14 crore share, hence forms about 6.02%, which is the size of the IPO itself. A quick look at the financials for NSE. The last reported financials, FY26, was a weak year for the exchange. You see, financial matrix across revenue to operating EBITDA margin all came under some pressure. But of course, all eyes would be on how FY27 pans out for the National Stock Exchange. Finally, this is an important slide because it tells the dominance which NSE has as far as Indian capital markets are concerned. The market share, that becomes a very important metric. In cash market, NSE has a 93% market share, equity futures 99.8%, equity options 74.7%, currency futures 99.5%, currency options. The total market belongs to the National Stock Exchange. So, of course, very strong numbers in terms of the presence which it has. All eyes would be on the kind of financials which the company provides in FY27, because by the time the IPO gets approved and launched, we'll be through the first half of the year. So those numbers will also be very crucial.
Crucial indeed. Yash, thank you for putting that together for us. On to some global action then. The US Federal Reserve has kept the rates unchanged under Kevin Warsh's first meeting as Fed chair. In his first press conference, Warsh also refused to give any forward guidance, stating that it was not well suited for the current policy conjuncture. Now, Steve Leisman has all the details on this.
Hawkish message on rates, reflecting that he inherited an inflation problem and saying the committee is strongly committed to dealing with that inflation problem.
We recognize that inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years. I am pleased to report that members of the FOMC are unambiguous and unanimous. This committee will deliver price stability.
Warsh clearly has embraced, at least for now, the existing hawkish bent of the committee, where 9 officials now project at least 1 rate hike this year and 6 see 2 or more. Only 8 expect to hold rates steady, and only one cut is projected. And markets have taken Warsh and the Fed seriously. The 2-year sold off hard, and the first hike is now seen with a 66% probability to happen in September. It had been December. A second hike now has a 55% probability for January, and there wasn't one priced in before the meeting. Warsh also pledged a rethink of how the Fed does business, appointing task forces to review Fed communications, balance sheet policy, data sources, productivity and jobs, and the inflation framework. Warsh stuck to his long-standing view that AI and productivity will be transformative for the U.S. economy. But it seemed as if any incorporation of that into policy would have to await dealing with the current inflation problem and hitting the 2% target.
Now, the Fed chair also explained why the Fed statement had been shortened. Listen to what he had to say.
A difference in today's policy statement. It's a bit shorter, a bit simpler, and it dispenses with some older language. That statement just gives you the facts as best we can judge it. Absent also is so-called forward guidance, which we agreed was not well suited to the current policy conjuncture. You also received the usual summary of economic projections. It's been the practice of this committee for participants to submit these projections, and I have encouraged my colleagues to continue to do so. I, however, have refrained from offering any projections of my own consistent with my long-held views on the SEP, at least as currently structured.
That's all on the Fed. Take a short break. Back with more on the other side. Welcome back. Now, the long pending India-UK free trade agreement will come into effect from the 15th of July. Our correspondent Abhimanyu is here to tell us more about the contours of that deal. Abhimanyu.
Well, several benefits are expected to accrue to different segments of Indian exporters, including labor-intensive sectors and agri-product sectors, in which exporters are going to gain from duty-free access into the UK market, and possibly they'll enjoy parity with several other labor-intensive exporters from different countries like Vietnam and Thailand, who also export to the UK market. So, of course, huge gains expected for them, and also the double contribution convention, that is the DCC, which also has been affected between both the sides. This is going to possibly increase services trade between India and the United Kingdom. Now, several Indian companies already operate in the UK too, and there are a lot of intra-company transfers which usually take place. And as of now, over 75,000 workers from India are posted in the UK by Indian companies which are operating in both the countries. And the DCC, which has been agreed upon between both the sides, will essentially exempt Indian workers posted in the United Kingdom from making social security contributions in the United Kingdom if they are making such contributions already in India. So that, of course, would be a big shot in the arm as far as the overall profitability and the competitiveness of Indian companies operating in the United Kingdom is concerned, and $500 million are expected to be saved by this. Also, government sources have indicated that around 85% of India's steel exports to the United Kingdom will not be covered under the steel measure, which the UK is going to come up with from the 1st of July. So essentially, most of Indian exports are not going to be impacted by the upcoming steel measure of the United Kingdom, and services as well as goods trade is expected to increase between both the sides. As far as government procurement is concerned, that though has been allowed for UK companies to participate in India's government procurement, however, they will be accorded the status of second-class suppliers subject to value addition norms within the domestic Indian market. Also, a quota has been given for EVs after the 6th year, which is going to begin after the 6th year. It will be based on 3 price bands. The first would be up to $20,000. The second would be between $20,000 to $40,000, and the last one would be between $40,000 to $80,000. So several segments of exports from India are expected to benefit, and a larger synergy is expected as far as an increased trade between India and the UK is concerned.
Abhimanyu, thank you for that update there. Take your leave on this edition of Business Lunch. The markets have come slightly off the highs of the day, but from me and the team, thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Ekta Batra. Ekta, good afternoon. Well, we recovered from the lows, so that good run continues. We are above that 24,100 mark, but a slight dip from those highs. So whether that could be a continuous phenomenon, but for now, bulls are enjoying the fact that we continue to edge higher.
Hi, Sonal. Yes, absolutely. You know, we've managed to recover above 24,100 at this point in time. We have the mid caps, which are just about 0.25% higher, but the advanced decline ratio is maintaining on the advancing side. So over 2,300 stocks advancing to around 1,800 stocks declining. So this is the picture for the market. The banks are doing very well today. So the Bank Nifty itself is up around 0.6%. Well, some news with regards to State Bank of India. The board has approved fundraise of around 60,000 crores via bonds as well as other debt securities in FY27. Remember, a lot of these companies do take these annual approvals, so that could possibly be in line. But nonetheless, 1.3% higher for State Bank of India, where they've approved a fundraise of up to 60,000 crores via bonds and other debt securities. But nonetheless, let's take you through all of the top stories that we're tracking this afternoon. Nifty trades above the 24,100 mark, led by realty and financials. IT and metals lag among sectors, and small caps outperform.
The India-UK FTA is to be implemented on July 15th following talks between PM Modi and UK PM Keir Starmer. Deal to allow zero duty access to 99% of Indian exports. Textile and Alcobev stocks rise.
Shares of Nykaa surge as the company unveils FY30 roadmap at its Investor Day. Eyes 2 to 3 times revenue, 4 to 5 times EBITDA growth, and $5 billion gross merchandise value across beauty and lifestyle.
Shares of Kirloskar Ferrous skyrocket on the back of an international order worth $13.5 million. Shyam Metallics also gains as the company lays out an ambitious FY31 vision, eyeing 42,600 crore in revenues, 6,200 crore in EBITDA, and $1.1 billion capex plan funded entirely by internal accruals.
And shares of RR Cable rise over 6% as Motilal Oswal upgrades the stock to a buy with a target price of 2,600. The brokerage says the industry is poised for continued outperformance and will be a key beneficiary if infra expansion drive continues.
All right, those are the top headlines that we are tracking on Midcap Radar today. The Midcap Index doing well, though it is one of those where we are seeing the advance decline ratio in the favor of advances as we speak. The small caps also contributing as far as the markets are concerned. But let's talk about our special segment, Midcap Movers. We have Upasana to take us through the midcaps that are moving around in trade.
Well, certainly the mid-cap index is up nearly 0.3%. So let us first focus on the top gainers in today's trading session. Topping the list is Fino Payment Bank, up nearly about 12% as we speak. NetWeb Technologies and even Saskin Technologies remain in focus as both these counters hit 52-week high with an uptick of nearly about 5 to 10%. PG Electroplast also in focus since quite a while. The stock is up 16% in 1 week and up 3% as we speak today. RR Kabel also in focus. It's up nearly about 4% on back of that rating upgrade by Motilal Oswal. Now moving the focus to the unusual, that is general insurance stocks are also seeing some buying today. New India Assurance also in focus on back of that, on the back of the NSE IPO that the company is to offload nearly about 1 crore shares out there. Star Health Insurance also in focus with nearly 7% uptick, and ICICI Lombard also seeing a bit of a uptick, nearly about 2.5%. Now on the flip side, let us look at some of the top losers. Cohance Life also in focus as the CFO resigns. NIIT, it is 27% of its 52-week high. Aeroflex Industries down nearly about 4%. And lastly, Brigade Enterprises down about 0.5%. So all in all, these are the movers in today's trading session.
Okay, all right, Upasana, thanks very much for that. Well, Brigade Enterprises is in focus because the environment clearance for one of their projects in Chennai is in fact revoked. So we have Sonal to tell us more about it. That stock is under pressure. Well, it's not China, definitely, but it
But we
is-
are in the Friday mood. It's okay, Ekta, we can do that.
Chennai for sure.
Yes,
but
of course.
recovered from the day's low.
It has. So, these, just to put things into perspective, we do get revocation of permissions, but again, on submission of documentation, there can be, further permissions granted as well. But of course, we don't know what will happen here. For Brigade Enterprises, the environmental clearance for Morgan Heights project in Chennai is revoked for them, and they revoked the environmental clearance note that they had received earlier. Now, this order is dated 8th of May, and it has come to light today, and that's what a lot of these, reports have been talking about as well. They said that the construction was commenced before they got the appropriate approval, especially from the Wetlands Authority. Now, Brigade Enterprises Morgan Heights project in Chennai is a 2 million square feet project. They started the first phase, which is around 1.09 million square feet, and they do have substantial interest in this because it's a JV. They have estimated gross development value of around 2,100 crore rupees. So it's a substantial chunk of their overall bookings, right? So if it does go and does not get that approval, it will be a big hit for them. But again, as I said, we still need to see whether they will submit some documents, and there could be some change in the permissions that would be granted as well. So for now, it of course did see some sharp fall when the news was flashed, but recovered from there.
Okay, all right. So that's on Brigade Enterprises from the real estate space. But Somal Mehta, head of retail research from Mirai Asset Sher Khan, joins in for a technical check on the markets this afternoon. Welcome to the show, Somal. Thanks very much for joining in. Well, for the Nifty, there is some amount of an uptick which has taken place. We've recovered back above 24,100 at this point in time. What would you approach in terms of stocks as well as the Nifty strategy today? What would your approach be? And for the Bank Nifty, are you seeing more traction there?
Good afternoon to everyone. We have broken out of a ending dangling pattern on the upside, and this breakout targets. First target was of 24,100. The next target is 24,600, which is the previous swing high on the quarterly charts. Now that we have been trading about 20 and 40 daily moving average, the medium-term outlook, the short-term outlook, both looks really good from here. Support would be around 23,800 and 23,600. So that will be a very, very crucial support for the markets at this point of time in the very, very short term. Medium term, definitely 23,100, which is a very crucial level for us because it is the 61% retracement level of the entire rise which we saw from 22,000 to 24,600. So that level remains extremely crucial in the medium term outlook. However, the strategy should be to buy on declines around 23,800 or 23,900 levels. On the upside, as I said, the target should be 24,600. Now on Bank Nifty, the next level on the upside that as a target would be 59,300, which is a previous swing high, and the support would be around 57,000, and in the medium term, 55,600.
Okay, that's on the Nifty and Bank Nifty. What about individual names? You said buy on dips could work for the benchmark. Is that something you're looking at in the broader markets as well?
Absolutely. I'm looking at PSU banks and I'm looking at defense. These two sectors are looking great to me at this point of time. The first one is Union Bank. Union Bank has broken out of a small consolidation, taking support at 20, 40, 200 daily moving average. Started making high top, high bottom formations. My target would be 188 and my stop loss would be 172. The second stock from the defense pack is Mazgaon Dock. Mazgaon Dock is looking great as well. Today it is little flat to negative. However, it has broken out of an indignal pattern on the daily charts, trading above averages. Great setup for a short to medium term outlook. Stop loss would be 2470 and my target is 2850.
Okay, all right, Somal, we're going to leave it on that note. Thanks very much for joining in. We'll take a short break, but up next, we'll be talking to Elara Capital's Prerna Jhunjhunwala to focus on the textile space on the back of the UK-India FTA. Stay tuned.
Welcome back. Well, let's focus on the UK-India Free Trade Agreement, which comes into effect on July 15th. The pact eliminates tariffs on textile imports from India, giving Indian exporters zero duty access to $263 billion UK market. To understand which are the companies which benefit the most, which are the stocks that should be on your radar, Prerna Jhunjhunwala, Vice President Equity Research, Irara Capital, is joining us now. Prerna, good afternoon. Thank you so much for joining us. Well, we know it is a positive, but can you list out some of the stocks which will benefit the most, which do have a lot of exposure to the UK market?
So UK FTA is a very important milestone that Indian government has achieved by getting ratification from the government. So we will be in a position to gain market share given the level playing field now with competing countries like Bangladesh, Pakistan, and Vietnam, which are exporting to UK market at almost 0% import duty. Now, still we have companies which are actually exporting to the UK market, and substantial portion of their revenues comes from the UK market. Some of them are SP Apparel, which have almost 50% of their revenues coming from UK market. KPR Mills, almost 15% of their garment revenues come from UK market. Wellspun Living, almost 10% of their revenue comes from UK market, and Indocount, almost 7 to 8% of their revenues come from UK market. So these are the four companies which are actually having an existing exposure to UK market. But at the same time, I would like to highlight that there are companies who are actually having minuscule exposure, but looking forward to add UK as a substantial market through their existing capacities and the new capacities that they are adding. So, for example, companies like Pearl Global have Indian capacities which can be now focused on serving the UK market. Similarly, Arvind, Gokaldas, all these players whose exposure is right now negligible can gain from adding exposure to these markets.
Okay. All right. Prerna, hi. Thanks very much for joining in. We'll get to your picks and your top picks at this point. But before that, with the UK FTA now coming into execution soon, how competitive are we vis-a-vis countries such as Bangladesh as well as Vietnam?
We are now at full competition with respect to these countries, largely because we have our cost structure is largely aligned due to availability of cotton and other materials that are required, which other countries don't have. So we were earlier disadvantaged due to this duty benefit that they had versus we did not have, and we also were higher on the labor cost. Now with duty going away and Bangladesh facing some issues with respect to power availability and other problems, we believe that UK in the UK market or anywhere, if we are at level playing field, we should be in a position to compete with these countries.
Okay, so it will create a level playing field for now. So, removing the duty structure is one thing, and you spoke about the companies which will benefit from that or potentially benefit from that. Is there anything else which is happening in the industry which is a dampener right now? Anything with raw material prices or imports otherwise that the industry is doing, and that also is something that investors should keep in mind before they look at textile stocks?
I think there's a lot going in the industry. For example, US tariffs are now, we are at level playing field in US tariffs. So our market share, which we had lost due to punitive taxation by US, is now likely to return back to us. So we'll see a cyclical recovery in our market share in the US markets, which is a core market for many companies currently. And we'll also see these FTA tailwinds panning out. So we are, in our opinion, at an inflection point in textile sector where growth opportunities are likely to unfold due to market access that we are going to get due to various FTAs, and we getting to level playing field on the duty structure. With respect to cotton prices, they have been very volatile. But at the same time, removal of import duty by the government is a big positive, and we are at par with international cotton prices. So that disadvantage is also not there anymore. We just need to be aware of the volatility that that we are facing as a country or and in global markets. Otherwise, all things are in place for improvement in margins and garnering better revenue growth.
Okay. Well, Prerna, stock specific wise, if you had to recommend maybe buying 1 to 2 stocks amongst your top picks from a 1-year horizon, which ones would they be and why?
We like Arvind Mills, Arvind Limited as our top pick. They have recently got an acquisition done in the technical textile space, accelerating their growth in the technical textile business. The Indian technical textile business grows at around 18 to 20% for them. And this addition in the US market gives them market access. So technical textile is one growth segment that would drive their top line as well as profitability. Plus, garmenting business is likely to scale up for them with more focus, with US coming to level playing field and focus on FTA-driven countries. So we believe Arvind is one of the stocks that could give better returns among the pack going forward. Apart from them, home textile companies like Indocount and Wellspun, which have and KPR and SP Apparel, as mentioned earlier, they are well positioned to actually take advantage of these FTA benefits in UK and Europe.
Point, Prerna. Thank you so much for joining us with your take on the textile industry and what this UK-India FTA mean for some of these stocks. That's the word coming in from Ilara. For now, we'll slip into a short break. When we come back, we'll get you more on the markets and also focus on RR Kabil, which is buzzing in trade after a bullish note from Motilal Oswal.
Welcome back. Well, RR Cable is buzzing after bullish note from Motilal Oswal. Upasana is here with the details on this stock.
Well, Motilal Oswal has put the spotlight on the cable and wire industry. It says that the industry is poised for a continuous outperformance and the demand tailwinds, they continue to remain intact over the long term as well, as India's energy transition remains as one of the key long-term growth driver for the sector. Now, higher growth visibility will drive the earning upgrade for RR Cable, and it is given a rating upgrade from neutral to buy with a target price of 2,600 per share. It has also raised the EPS estimates for the stock by 11% for FY27 to FY28, and even has given one of the highest, that is 21% revenue CAGR for 26 to 28 for the company. Given the stronger revenue growth outlook, market share gains, capacity expansion and even margin expansion that the brokerage is factoring in for the company. Now, earlier this week, mind you, Citi had also given a buy rating on the stock with a target price of 2,650 per share on the back of the sharp rebound that the company is seeing in terms of its exports, which is one of the largest contributor as compared to its peers. So all in all, this stock certainly remains in focus on the back of this.
Okay, all right, Upasana. Thanks very much for that. Just watch out for Bata, which has got a new MD and CEO. And after the news, the stock, which is up around 5% has surged to an 8% rise at this point, at the high point of the day, reacting to that bit of news, as you can see on the charts. Well, we need to wrap up on the show. That's all the time that we have on Mid Cap Radar. But MF Corner, once we're back. Stay tuned.
Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinny Motiwala. With me is my colleague Sonal Bhutra. Sonal, good afternoon. And today we're back with Know Your Fund Manager.
We are, and this is an episode where we try to break down investment philosophy in easier terms and understand what really goes behind the entire investment process, right? We'll talk about how they navigate changing market cycles, generate alpha, and identify the growth strategies they believe are most effective for building long-term wealth. To discuss all of this and more, we have with us Mr. Ajay Tyagi, who's the President and Head of Equity at UTI AMC, joining us now. Mr. Tyagi, good afternoon. Thank you so much for joining us on MF Corner today. To the most basic question, because that's what retail investors would always think. What do fund managers really do? So take us inside your portfolio construction process. How many stocks do you ideally want to own? And what's the maximum you would put in a single stock or a sector? And when do you decide the position has gotten too big, but your thesis that is still intact?
So Sonal, let's start with the first question, the most basic question. What does a fund manager do and what does a mutual fund scheme do? I would say at the most fundamental level, what we are trying to do is identify great businesses and have fractional ownership of those businesses for our investors. So as we all know, not everybody can actually be an entrepreneur. Not everybody can actually float a great business, the one which not only creates value for its customers, but also creates value for its investors. Mutual fund at the most basic level allows society at large and retail investors in particular to partake in such great businesses by way of a collective investment scheme, which in India is called mutual fund structure. So that's point number one. Your second question was more nuanced, of course. How do we position size? How does when does a stock become too big, and so on? So, I think for us, what's important is to understand how the business would actually behave over the next 3 to 5 years. We usually try to disassociate the business outcomes from what the stock prices are reflecting in the near term. We want to focus more on what's the ability of the business to deliver over, the coming years, and hopefully, beyond, 5 years as well. And when we do that, we basically try to keep the near-term factors outside of our frame of reference, because the near-term factors can lead to a lot of noise, can actually lead to, our conviction getting jolted every now and then. The third part of your question was that when does a particular stock become too big? I would say this also is very nuanced. I think if I were to answer it at the most basic level, I would say our position size is a function of our conviction about the business to actually have a very long runway in front of it. So the longer the runway for compounding of profits and cash flows for that business, obviously the conviction would be higher. Along with this, we also look at, does the business have the required moats to keep competition at bay, which means it has the economic characteristics which can help it sustain its profitability, and without compromising on its balance sheet can continue to enjoy this long growth runway. So it's the profitability and the sustainability of the profitability and the ability to compound earnings that leads to the position size in our portfolios. Yeah.
Mr. Tyagi, good afternoon. Thank you so much for joining us. Rightly said, near term leads to a lot of noise. You spoke about business runway and how, growth and compounding of that growth is key, as well as profitability. But you all have been consistently negative on sectors like metals, oil and gas, real estate, infrastructure for years, and positive on private banks, consumer goods, pharma, and IT as well. So what is the underlying framework for this? Is there some business characteristics furthermore that disqualifies maybe some sectors and stocks as well? You spoke a bit about it, but a lot more in detail if you could highlight that.
Sure. That's a great question, Vinny. But let me just, before I answer this question specifically, let me just say that, some of the sectors that you mentioned where we've been consistently negative may be true of some of our schemes. But that's not, a view across the board. The one thing which I must say upfront is that at UTI, we run the full suite of mutual fund schemes covering the entire spectrum. Some of them have a tilt towards quality and growth. Some others have a tilt towards value. Some are blended. So yes, what you just mentioned is completely true about some of our schemes which have a quality or a growth orientation. And that's where cyclical sectors like energy, oil and gas included, metals and so on have been absent. And the reason for that is simple. In these schemes, we basically want to focus on sustainability and compounding of earnings. We want to have the predictability of earnings in front of us before we commit, ourselves to these businesses. Wherever we think that the outcomes are fairly volatile and therefore we can't predict the outcomes 2 or 3 years out with any amount of certainty, we would not invest in them. Once again, I'm repeating for the benefit of your viewers, this is true of all our schemes which have a quality and a growth tilt. Equally, you also mentioned sectors where we've been positive for fairly long. Private sector banks is one of them. Pharma certainly is another one of them. And I would say healthcare rather than just pharmaceutical. Pharmaceutical is just one part of healthcare. As we all know, the healthcare sector has really expanded over the last 5 years to grow beyond the typical pharmaceutical sector into hospitals, into diagnostics, into CDMO players who are becoming extremely critical to the innovator companies around the world and so on. Moving on, we're also positive on the consumption sector per se. And last but not the least, IT, which has been a contra call for us, for some time now. And here again, the rationale is very simple. The predictability of these businesses, the pricing power of these businesses, their ability to continue growing because of the low penetration of majority of the businesses across these industries is something which actually gives us a lot of comfort in terms of our ability to think of outcomes 3 and 5 years out. So the predictability in these businesses is much better in compared to the other sectors that I mentioned early on. And I think that's what is weighing on when we construct our portfolio. Yeah.
Get that point. So that's your investment philosophy. But investment is a lot about finances. Yes, financial performance. It is also a lot about behavior. You've said the best wealth is created through delayed gratification and that investors should not expect positive returns every year. But the returns that we saw in the last 4 years, the SIP investors, they're checking returns monthly on apps. It's so accessible now. What realistic return expectation should a 5 to 10-year equity investor carry? It is very important to have that aspect in place when you start investing.
So once again, a great question. And I think every investor should be able to understand the true potential of equities as an asset class. Now, the construct here again is very simple. Look, equities, after all, are nothing but businesses which are thriving within India. India's economy on a nominal basis is growing, give or take, at about 11 or 12%. And if that's the case for the larger economy, then for the aggregates, whether it's the Nifty large cap or it's the Nifty mid cap, these aggregates also cannot grow meaningfully different from this number of 11, 12%. They can't consistently keep growing at 15, 16% for a full decade ahead of us. By the way, some businesses can still grow in high teens, maybe in the 20s as well, just like some businesses will grow in just single digit. And that's why it's important to understand where the aggregates would be and what can they deliver in terms of their earnings growth. And that's why it's important to keep the framework of nominal GDP growth and the commensurate earnings growth of the markets at large, whether it's the large caps or the mid caps in front of us, to have realistic expectations of the true return potential of equities. And if we were to keep this framework in front of us, then I would say Indian equities are primed to give somewhere around 12 to 14% return annualized over the next 5 or 10 years. Of course, active fund managers do have the ability to generate some alpha, that too through the cycle, not every year. And that's what we strive for, I would say. So maybe something slightly better than the indices, the underlying indices. But yeah, once again, this can't be too different from the 12, 13% number that I spoke about. So that should be the target returns investors should have in mind. And markets are always cyclical, by the way. They're always driven by the behavior of investors. Sometimes, markets deliver 20, 25% return over a 3 or 5 year period. To my mind, this is nothing but borrowing of returns from the future. Whenever this happens, usually the next few years are a little soft in terms of returns. The most important rule investors should always keep in mind is reversion to mean. If you have over any period enjoyed excess returns meaningfully higher than 12-13%, then in the following period you will have to give up those excess returns, and the period can actually give you returns lower than 12-13%. But through the cycle, if you hold it for a fairly long period of time, you should target something around 12-13 or 12-14% returns.
Okay, that's it, 12-13%, and I think we're facing that in 2025, 2026 as well, right, Mr. Tyagi? We've seen good returns before that, and now maybe a bit less in terms of returns for investors, but patience is what we should be the key for investors. On that note, let's just slip into a very short break. We'll come back and continue this conversation with Mr. Tyagi. Stay tuned in. Welcome back to MF Corner on CNBC TV 18. We still have with us Ajay Tyagi, President and Head Equity at UTI AMC. We're discussing his strategy, his thought on how mutual fund investing moves about as well. Mr. Tyagi, you spoke about high quality business is what you focus on. Sustainable growth runway, profitability is key when you're selecting a business. And holding them for the long term with a low portfolio turnover is what's been the strategy for you all. But quality stocks often look expensive at times, right? So how do you reconcile quality with valuation?
Once again, that's a great question, Vinny. So you're absolutely right. On the surface, quality businesses always look very expensive, but then they are expensive for a reason. You see, without getting technical, the earnings multiple or the P multiple, as we often discuss in the marketplace, is nothing but a shorthand for a more comprehensive exercise, which is nothing but what we call as discounted cash flow exercise, which basically measures the true worth of a business, not just from the perspective of the next 1 year or 2 years or 3 years, but from the perspective of the next 10, 15 years. And in fact, I would say even beyond that. Now, for businesses which are strong, which are actually growing their earnings year after year without seeing a down year, more importantly, without seeing a year of losses, and without exposing themselves to the risks of sometimes having too much of debt, which can lead to very dire outcomes for businesses during a bad phase of the economy. When we evaluate such businesses on a price earnings multiple, which I said initially is nothing but the earnings only of the next 1 year, they ought to be looking expensive because this price is capturing the true compounding nature of such businesses over the next 10 years rather than just the next 1 year. If you compare this to a business which is cyclical, which sometimes gives great profits, but then those profits can even see a decline and sometimes even losses, then any rational investor should be very careful in giving a very high multiple to just the next year earnings, because the next year number can be very, very volatile into the future. So I think that's the, I would say, basic premise between a very steady eddy compounder, where there is a much more predictability around not just growth in profits, but also growth in cash flows, versus a business where there is too much of volatility, where even the best of analysts can't predict, what the outcomes could be. So for instance, if anybody is evaluating an energy company, what should the crude price be? 6 months back, people were working with an assumption of $70. 2 months back, they were working with an assumption of $100. Now, perhaps they're working with an assumption of $80. How do you evaluate the earnings potential of such businesses over the long run? So for such businesses, you ought to be giving a lower price for the next year earnings compared to the more steady ones. Yeah.
And considering that so much has happened already, since you spoke about forecasts on crude oil prices, there was Russia-Ukraine war, COVID, then we had the West Asia war. So things keep changing for some of the businesses where volatility continues to be very high. Mr. Tyagi, you are on the other side of the table. You started with the basics of what a fund manager does. You run the fund. But if you had to advise a 30-year-old starting their mutual fund journey today, how should they choose a fund? Should they look at the past returns? Is it the fund manager, the philosophy, or the AUM size? Because a lot of them which have outperformed have huge AUM. So what's that one thing that investors generally get wrong when they are picking a fund, which you have seen over your almost a 25-year career, and more than that, actually?
Yes, so you're right. I would say the first thing that any investor should start with is the asset allocation. Asset allocation is, I would say, even more important than fund selection. So you ought to realize whether you want to be 70% in equities or 60% or 80%. For each one, it's slightly different. And this is where the role of a financial advisor or a mutual fund distributor comes in. So that's basically the first step. Then the next step is what your question exactly was, which is how do you select a scheme? Here again, there are quite a few things you have to look at. It is indeed a very bad starting point if you were to base this decision only on the performance of the last 1 or 2 or 3 years, because, like the markets, performance also witnesses reversion to mean. The best funds inevitably go through a downdraft, just like, the funds which are, in absolute doldrums can actually see a very strong performance in the coming years. So this is where the importance of understanding the philosophy of that fund and that fund house is very, very important. So a lot of effort should go into that. And that's why, merely opening up screens and looking at the best performers of the last 1 and 3 years and then choosing, or allocating money to these schemes can be a very, very dangerous exercise. You ought to go, one level deeper, open the hood and try and understand the core philosophy, the strategy of the fund, how has the portfolio been. I remember when he spoke about portfolio turnover ratio. Is the portfolio churning too much, which means that possibly lower conviction of the fund manager or the fund house. You also have to see what are the broad themes that the fund house is bullish on and whether they resonate with you or not. So I think a lot of this goes in. And of course, returns are important. So I can never undermine the importance of returns, but you have to see them over a fairly longer period, along with the risk that that fund has taken. So yes, returns are important, but you also have to measure that against the underlying risks that those funds have taken. Yeah. So I would say these are the few things that you'll have to take care of. Yeah.
Absolutely, sir. You know, that's for a first-time investor. They have to look at a lot of things. Just returns is not the only criteria. But what about someone who's already been investing, right? What would the message be right now? You see volatility coming in as well. They need to prepare for specifically any data points you would suggest. What should they be watching out for now?
I would say I'll take the big picture and put that in front of us once again. I think the big picture is, at least we are very confident at UTI that the country will continue to show us about 11 to 12% nominal GDP growth. Look, just like markets are cyclical, funds are cyclical, stock prices are cyclical, so is the economy. The economy goes through bouts of expansion and then bouts of slowdown. The economy has, and earnings therefore, have gone through their own share of slowdown over the last couple of years. Therefore, the stock markets haven't been too gratifying. If you also consider the fact that, maybe exactly 2 years back, markets were very, very richly valued, that is also leading to this consolidation. But like I said in response to one of your earlier questions, the potential for equities is somewhere around, low to mid-teens. You just have to be patient. We have seen many times, and these are not just times around COVID or times around great financial crisis of 2008 or 9, but also times in between when even a 5-year SIP has delivered just about 7-8% return. So it is not uncommon even for 5-year SIP returns to be just single digit. That doesn't mean anything. The average of 5-year SIP returns still measures up to that number of 13-14%. So if you are getting a little jittery and a little anxious about the fact that the money that you have been investing in very, very assiduously over the last 2-3 years is still not making respectable returns, I would say just continue with those SIPs. I would say what is most important to generate wealth as an investor is persistence and patience. If you have carefully chosen your schemes, I'm sure they will deliver the results to you in the fullness of time. And by the way, the last point, actually great returns and great investments are made during times when markets are consolidating and going nowhere. If you're catching a market which is making a new high every other month, then from a prospective basis, it may not turn out to be a great time to have been investing. On the contrary, perhaps today is a much better time compared to 2023 and 24. Yeah.
Take that point, Mr. Tyagi. Thank you so much for joining us with your insights. Very helpful discussion for new investors and for investors who've been investing since COVID and just saw those massive returns and now the downturn. So that puts things into perspective. With that, we'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
A Nikkei, Hang Seng, Shanghai, Kospi, all are in the green.
And it won't be from us. We don't have to give them anything.
9 officials now project at least one rate hike this year.
The Fed upgraded its inflation outlook and removed its easing bias.
Market reacted so negatively to the statement were the dot plots.
And the details have largely been in line with what CNBC TV 18 had reported.
0.1 higher on the Nifty and about 0.2 odd on the Nifty Bank.
The markets have been reacting to the Fed, the statements that have been coming in from US and Iran.
Well, it's been a quiet day for the market so far.
Since they target nearly 50,000 crore plus gross merchandise value.
Seminal event for India. The 26% fall in crude prices.
This is going to possibly increase services trade between India and the United.
Well, we recovered from the lows, so that good run continues. We are above that 24,100 mark.
Well, that is the day so far. Markets are kind of more in the flattish zone today, the indices at least, but there is a lot happening beyond the surface, below the surface rather, below the Nifty index, the Nifty Bank, and so much in the broader space as well. This is Closing Bell coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. Nigel is with me. Nigel, hi. Afternoon.
Hi, Prashant. Today what's encouraging is also the money market action, because on the day when the dollar index showed some strength overnight, the rupee actually, after weakening initially, it went to around 94.7. That's pulled back to around 94.25 the last time I checked. So good to see stability in the rupee, even in the backdrop, where the dollar shows some strength. To be fair, when the dollar index itself had weakened, a fair bit, the rupee as well weakened. So this is good to see. I think some kind of stability in the rupee is something I think the bulls will like.
Yeah. I think those numbers are still doing the rounds in terms of how much will, foreigners be able to, how much will NRIs put in, and we had a few numbers this morning as well from Federal Bank and others, etc. So I think that flow is very much keeping the rupee bid alive, even though earlier in the morning you had a bit of a sort of sell-off coming through. 94.28 or so is where now we are at. The Nifty Bank, the mid-cap, small-cap indices, just take a quick look at all of them before we go any further. The Nifty is unchanged. We started there, we're there still. Actually, we're pretty much, we've had a bit of a rally, bit of a dip, but almost unchanged now. Nifty Bank is maybe a little higher compared to where it started in the morning. And the mid and small-cap indices, take a quick look at those as well. So 100 points higher, so nothing, about 0.15, and the small cap index is also about 57 odd points in the green. NSE advanced decline ratio is also not that. It's about 1,700 stocks are higher and about 1,550 stocks are lower. So about 150 stocks separating gainers and losers across the board. So this is a much more closely matched market as compared to what we've had in the recent past. Well, let's just quickly run you through what's coming up here in terms of the program. So we'll talk about individual names, and we'll talk about Bata, where there's a management change. We'll talk about Nykaa. We'll talk about a bunch of other names as well as we come through. Bata is still up about 6.5%, was up almost 10. New man at the top from Nike, by the way, at Bata. So Mangalam talks to us about that. Nykaa is the other one which continues to be strong. There are some numbers which the company's put out as far as aspirations are concerned. So that's coming up in just a bit. How should you position yourself is the question. Mitesh is with us with the answer. Mitesh, good afternoon. Good to have you here. What would you recommend?
Good afternoon, Prashant. See, on the indices, nothing has changed. Nifty is practically flat. The bank Nifty has moved up slightly. And I've been highlighting that the financials could slightly outperform the Nifty, and therefore banking index would do well. But broadly, I think stay long. Could be some intraday volatility, but so I have.
Okay, I think we are having a little bit of trouble. Mitesh, give us 30 seconds. We'll just sort of patch you in again, and maybe the connection will be a little better, but we lost him right there as he was about to start talking about levels and stocks, etc. But Just going back to Mitesh in a bit, maybe Mangalam is with us in the meanwhile, and we can sort of address those two names we were referring to earlier, Bata and Nykaa. Mangalam, take it away.
Well, let's start with Bata. You know, Bata's got a leadership change. The announcement that has come in right now, Sanjay Rao has been appointed as the managing director and CEO of the company with effect from October 2026 to August 2031, a period of 5 years. The stock is up 7% on the back of that announcement, and there are two reasons why. One, over the last 3 years, if you look at it, you know, the revenues of the company grew at a measly 1% CAGR. The profits actually declined by about 20% on an annual basis. And the stock, which was in November at around 2150 rupees a piece, has now come down to sub 700 rupees before this announcement was made. So it's been a rank underperformer. And what does Sanjay Rao bring as experience? Two things that really stand out as keywords for me. One, Nike. Second, Zara. What does Bata do? If it has to, you know, increase its fast fashion quotient, then Zara experience helps. At the same time, if you look at, you know, the footwear quotient, who better than Nike when it comes to designs and moving into the premium part, sneakerization of the world, if you must. And finally, if you go through, you know, Sanjay Rao's LinkedIn profile, he marks himself as a turnaround specialist. So all these three things coming together for Bata, a company which has been struggling with growth, gets a turnaround specialist who has experience in both Nike as well as Zara. Can that be any better as a combination? Perhaps not. So, you know, we are seeing a lot of excitement built in right now. Remember, he joins from October. Performance is something that the street will monitor more than just the credentials right now. But as of now, a leadership change is something that, you know, is giving some hopes to a lot on the street.
What are valuations like, Mangalam, for Bata, if you've looked at them lately?
Well, lately the valuations have not been, you know, particularly attractive, largely because while the stock price has corrected, you've had the EPS correct as well. Last 3 years, I was looking at it, you know, the stock price is corrected by about 25% on a CAGR basis, whereas the net profit too over the last 3 years has corrected by about 20% CAGR itself. So which tells you that the multiples of the company have not, you know, really compressed. It's more an earnings-led depression in the stock price than just a multiples-led depression that we're seeing.
But the gentleman, Mr. Rao, is, I think it was based overseas, right? He's not he's not based here in India, at least the last posting.
Yeah, he's not based here in India. Last posting was basically Senior Director, Nike Retail for France and another, you know, country in that region itself. But importantly, what really stands out is that his Zara experience, the Inditex experience, works very handy in India because while he was at Inditex, he was instrumental in launching the Zara clothing into India with the joint venture with the Tatas. So obviously, you know, it's not that he's completely alien to the Indian business. He's actually set up the Zara stores in India along with Tatas while working from the Inditex side.
Okay, I think stock was up 6.5, and they like what the backdrop and the profile. It's moved up to the day's highest point as we are addressing it. So another 4% as Mangalam was talking about, basically the profile of who the new CEO is and what he's done in his previous roles, etc. The other one is Nykaa, Mangalam, if you want to address that as well. Stock's up 6.
From foot to face, so let's come back up now. You know, you talk about the beauty and personal care opportunity out here. Nykaa, the analyst meet is currently underway, but we do have their investor deck, which they've uploaded to the exchanges. And out here as well, they are speaking about a multifold opportunity. They expect from now to FY30, you know, the gross merchandise value could be as high as nearly 50,000 crores or $5 billion. And they've broken it down into both beauty as well as fashion business. Beauty, obviously, they believe that, you know, can be a multifold growth here and margin expansion too. From an overall company basis, they expect the revenues from current levels can become either 2x or 3x by FY30. EBITDA grows a shade higher by 4 to 5x, and margins, which are currently at around 7.5%, would grow to low to mid-teens from here on as well. So EBITDA margins double, EBITDA quadruples, and the revenue doubles or triples as well, depending on what side you're looking at on both sides of the range. For beauty segment, the gross merchandise value grows between 2 to 3 times. Healthy double-digit margins as against high single digits that the company is posting right now, with offline presence in 600 stores as well. If you look at the fashion business, that's been a bit of a margin drag. Now here, which broke even in the fourth quarter last year, they believe that they can get to high single-digit EBITDA margin by FY30. So that's a big jump from current levels. And they believe sustainable margins here could be over 10%. Two other callouts that really stand out for me, their own brands, the House of Nykaa, which did about 3,100 crores in net sales value in the last year, could go all the way up to 5,000 crores. And if that were to happen, margins increase further. And add to that, we've also seen, their wholesale business, which is outside of the Nykaa ecosystem. They are selling to all the other retailers in the country. That business could do about 3,500 crores in gross merchandise value as against 1,200 crores earlier. They are targeting 1 million retailers in reach by FY30. So across the board, multi-fold opportunity is what the company is targeting, and that's what the street likes. Stock was up 5% yesterday, up another 7% today.
All right. Thanks very much, Mangalam, for that. So that's, consumer right on the top of the program. Two names, Bata and Nykaa, in focus. Well, let's just go back to Mitesh. We had a bit of a technical issue with him earlier. Mitesh, hopefully in a better line. Go on. What would you recommend?
I was giving a buy on Lupin with a stop at 22.90 for targets of 23.75. And the other one is ICICI GI or ICICI Lombard General Insurance. That's a buy as well. Keep a stop below 1800, look for targets of 1890.
Bata, any thoughts? The two names, first Bata and then Nykaa, which Mangalam was talking about?
So Bata, a big breakout, very good pattern over here. I think the stock had made a high of around 774 in April and then corrected all the way down to 650. So that could be a profit-taking point. But eventually, I think the candlestick today, along with the indicator position, suggests that we should be looking at 850 over the next few weeks. So that's, maybe one target we can eventually even get past that, but 850 looks very logical and gettable over here. And Nykaa is something, which again, I also am interested into. The breakout was 282. So if we get a pullback, I think then the Nykaa stock looks like, heading towards levels of around 330, 325, 330. So very positive setup and a good breakout on Nykaa as well. Even if traders want to buy, 10, 11 point kind of decline should invite long positions.
Okay, all right. Got that, Mitesh. Thanks a lot. Well, let's welcome Deven Chauksy onto the show. Hi, Deven. Good afternoon. Good to see you. When can Mr. Rao, who's coming in and taking charge in place of, Gunjan, can he change the fortunes of Bata? As Mangalam said, it was a 2,000 rupee stock that after today's 10% up move is at around 750 rupees. I'm looking at the last few years, they've stagnated at around 3,500 crores. That's around 4-5 years they've done just that. And margins actually have come down from 23% to around 20%. What's your view on the stock from here on?
Yeah, Nigel, good afternoon. Well, I have always seen Bata as a company which has got a fantastic amount of distribution reach, which is probably quite compelling kind of a proposition. If you look at exclusive outlets, I think of the company, they would be somewhere around 2,500 plus. They would have, I think, the merchant-owned outlets, I think, which would be more than 25,000, where multi-brand products are also displayed. More than 25,000 location presence that they have. And in the FOFO segment, that is the franchisee-owned, franchisee-operated segment, they would have about 700 odd kind of outlets. So from a perspective of looking at the reach, Bata has always been a very compelling proposition. Of late, I think one has also studied this particular company and found that they have actually started integrating the entire network of the company, the store network of the company, to suit the local demand and requirements. Up till now, I think they would be operating at a centralized level, and possibly, I think, as a result of which destocking was always being a bigger challenge. I think they have corrected this part as well. Now, with the Nike man coming into the company, what could be the differentiator? The differentiator could be product. If the distribution is right and if the products are compelling, then possibly I think you have prospects lying ahead. And that's what I think one would like to look at. We haven't yet had a chance to understand what kind of different product categories that they would like to bring in. But the fact remains that I think with a strong distribution network and if the product portfolio changes, it could be a good moat, I think, which one would like to look at.
It's a strong theme itself, right, Deven? I mean, not every management change will result in the stock performing, but there have been, and we've done pieces. I think Mangalam has done pieces. Nimesh has we put out data in the past over the last 2 years. Exactly these kind of situations where management changes have resulted in pretty large, which have turned the corner in a pretty substantial way. For a range of businesses. So actually, as a data point, it's a pretty useful data point. starting point. And then, of course, I mean, other things all need to fall in place and has to be the right strategy and all of that. I mean, the market matters, which segment they're in, but I think it's something to pay attention to with regards to when someone new comes in. I think it's happening in the case of Bata. Of course, I mean, here, the business, as Mangalam pointed out, has been suffering. Growth has been low. So there is room to do, at least try to do different things. And we'll see what the new strategy really is. Devin, I mean, the other big story tomorrow is going to be the RIL AGM. Any thoughts?
Well, I think the more importantly, the few announcements which definitely one would like to hear. And one among them would be on the Reliance Intelligence side. They have been putting across the data centers, both I think to offer to their own companies within the group network, and also in partnership with companies like Meta, where they would be offering, I think, a captive facility to likes of Meta by running the complete infrastructure. Back-ended connected with a complete, I think, the energy segment, the renewable energy segment, and in a way, I think becoming more formidable force in this particular space with even the LLMs that they are talking about, including different industry verticals that you'll be providing. So one would like to listen more about how exactly Reliance Intelligence is being positioned in coming times. Their building blocks are in place. Second most important point, which everybody wants to hear, would be, I think, Geo Platform. Again, a large company, probably I think 40-50,000 crore offering in the marketplace at some point of time. And that's where probably would like to hear what kind of preparation that the company has made to roll out this program. In fact, I think the satellites, the LEO satellite that we are talking about, based communication, that is again, I think, going to be a big announcement that we are seeing it. So completely transform business as far as I think the Reliance is concerned in the customer-facing businesses along with the industrial businesses. In my viewpoint, I think these are 2 or 3 main areas where one would like to listen more in detail from the company.
Okay, all right, Deven, I'm going to turn the attention to metals yet again. I'm going to ask you about 2 stocks, Kirloskar Ferrous as well as Shyam Metallics. Let's address the news spaces first. Kirloskar Ferrous is up close to around 10%. The stock has come off a little bit from the top as they bagged a small but clearly an effective order. Now, do note the stock was down close to around 25% from its 52-week high. What's the news flow we got overnight? Well, they received a contract for supply of pig iron. The buyer, well, he has an office in London, UK. That's what they've disclosed. In terms of order details, the order deals with a supply of around 30,000 tons of basic grade of pig iron on a FOB basis. The contracted value, well, close to around $13.5 billion. And this has to be completed by 15th of August 2026. So a small but effective order, 30,000 tons on a capacity of around 7 lakh tons basically means that it's close to around 4%. But they're seeing a big outsized move. So clearly the street is looking at other factors and getting excited about the stock after it corrected from 650 to 450. Next up, Shyam Metallics. That one's buzzing in today's trading session. They have laid out a very, very ambitious 2031 target. To give you the numbers, on revenues for 2031, they're talking about around 42,650 crores. On the EBITDA front, 6,236 crores. So big numbers. Just take a look at it. They're looking at a surge from current levels. On ratios, they're talking about 22%. They'll stay net cash positive, and also they'll be focusing on the value-added downstream products. The key EBITDA drivers for the next few years, talking about such big numbers, what's going to drive that? Stainless steel currently is very small in terms of an EBITDA contribution, but the focus is clearly there because they're talking about the number going to around 1,100 crores. Carbon steel, currently it's, the key part of their business at around 1,700 crores. It'll go up, but not in the manner that stainless steel will go up. So it'll go to around 2,900 crores. And on SBQ, which is special bar quality, that's likely to report close to around 1,000 crores of EBITDA. So that's how they come to that enormous number of around 6,200 crores or thereabouts. They'll require capex. $1.1 billion of capex is what they're looking to deploy over the next 4 to 5 years, which will be funded by internal accruals. They're saying there'll be no debt. And the past record has been pretty good as well. Over the last 20 years, the CAGR has been around 20% on revenue, EBITDA, as well as PAT. But keep in mind, that's on a rather low base. Jefferies, they're enthused post this analyst meet that was held yesterday. They have a buy rating. They have upped their target price. They are factoring in the EBITDA moves up as well as EPS move compound at around 14 to around 16%. They also go on to add that this is one of the best growth potential stocks in the metal space here in India. So stock is up 2.5%. Any view on either of these names, Deven? Do you like either Kirloskar Ferrous or Sham Metallics?
So I think the pig iron and the coke supply, I think, has been always, something which I think we have looked at in Kirloskar Ferrous. Now, due to the war-related issues, I think the coke supply probably was becoming expensive affair, which now, at least I think that part is taken care of in form of, I think, the price is coming down. So that is an important point from the profitability point of view. Second most important point, which I find that with this UK business getting started with effect from next month, it appears that I think many of these particular companies who own their export business are likely to be significantly large beneficiaries. Few of them with whom we have been talking in general, I think they have been extremely optimistic about the FTA business bringing a good amount of collection for them in terms of exports, and at the same time higher amount of profitability. So could be, I think, one of the possibility for this kind of companies to look at from the perspective of seeing the higher amount of growth, both in form of the turnover exported and at the same time, I think, lower amount of input cost because of the ease of the supply chain logistic pressures on the import of coke oil.
Okay, got it. Deven, I wanted to ask you about these kitchen appliance makers. Any view on either of them? You know, Stovecraft, that's been the biggest underperformer among the three listed players. That's TTK Prestige, Hawkins, as well as Stovecraft. But in the last 1 month or so, the stock is up close to 20%, though all these three stocks, they're either down between 25 to around 50% from their peak. Now, valuation-wise, you're getting comfort with Stovecraft, and we spoke to the management, I think, 2 weeks ago. They sounded very optimistic. For the time being, the stock is at the high point of the day. You like any of the three?
Honestly, we don't have any coverage, so I think won't be able to give any specific price, target price, etc. But we have been looking at the space, and probably we have been finding that post GST cut in various cases, the products have become, I think, more affordable, and as a result of which, we are seeing a traction in most of the cases, including in the white goods products case. So frankly, I think that's where many of these companies have been remaining extremely comfortable about the journey going forward. And current year, despite of whatever the first 2 months of current year in which the war-related situation has affected, including on the input side of the activity and even the production side of the activity for some of the companies, still I think the demand scenario is remaining absolutely robust. So yes, I think they are likely to see the better current year in times. Maybe I think valuation-wise, I have not looked at them enough, but maybe slightly priced, I think, as I would like to call it as. They are not completely available at the cheaper levels.
Got it. Okay. All right. Thanks a lot, Deven, for joining in. Valuation's not very comforting, though Deven and team are having a look at it, the kitchen appliance makers. So I think good time to slip into a short break. You come back, we'll have Rahul Veera, who'll be joining in to help us out with his view on the markets. Stay tuned. Hello and welcome, back to Closing Bell. Well, it's that part of the show where Hormuz joins in, and he, as always, will bring us something very, very exciting. High valuations in the Indian market have been a concern for domestic as well as international investors alike. But do higher valuations also imply underperformance? Well, as per Jefferies' note, multiple sectors have seen strong returns over the last few years despite valuations being high. Hormuz joins us to help us out with all of those details. Hormuz?
It's a very interesting analysis that Jefferies has done, and they also are of the opinion when we usually talk of high valuations, we usually talk of it with a tinge of concern. But here they have highlighted 8 sectors over the last 15 years where their valuations have been significantly higher in comparison to normal levels. But despite that, they have managed to deliver strong returns over the next 2 to 3 years. Now, which are those sectors? Well, they have highlighted defense, retail, NBFCs, cement, FMCG, capital goods, hospitals and hotels. I highlight a couple of them for you. Now, for example, defense was analyzed between September of 22 to July of 24, and by September of 22, their 10-year average multiple, the valuations were 41% higher than their 10-year average multiple, and despite that, they still managed to outperform the Nifty by a whopping 229%, and it was led by a 33% EPS CAGR as well. What led to that? The indigenization push, strong order visibility, import substitution, all of them contributed to this defense outperformance despite expensive valuations. Take a look at NBFCs as well. Over a 5-year period between October of 21 to February of this year, the valuations for the NBFC sector as of October 21 had gone up as much as 78% higher than their 10-year average, yet it managed to outperform the Nifty by 40%, and that was led by the rising credit penetration, improved asset quality after the IL&FS incident, and of course scalable digital models as well. And the one sector that continues to be in the spotlight even today is the capital goods space. The first bits of re-rating happened in September of 2022 when the valuations at 32 times were already 28% higher than their 10-year historical average, and yet they managed to outperform the Nifty by 90% along with the 26% earnings CAGR. Now, what led to that? It's a revival in the investment cycle after COVID-19, strong order inflows, better margins, all of them fell into place. Now, there is one more sector that is joining this category, and that is power. Why is that so? Jefferies believes that supply and demand side drivers are aligning, and therefore the power stocks are among the best structural plays in the country currently, as there is a strong demand visibility, the balance sheets of the state electricity boards are improving, and the demand from the data centers is also on the rise. And they have highlighted among their top picks JSW Energy, Adani Energy Solutions, Premier Energies and Siemens Energy going in with their thesis of hard assets. So they have highlighted that despite expensive valuations, sectors have done well in the past and they expect power to follow suit.
All right. Thanks very much, Hormuz, for that. That is interesting, as always. There is news at the bottom of the screen. Lloyds Engineering has made an acquisition. Lloyds Engineering, the stock is... Nigel will have more on this, but the stock basically has doubled in the last 2 months. So from basically 40 to 85, I think it was up 10% yesterday as well. And they're making an acquisition which is about just under 1,100 crores in size. Nigel.
Well, that's right. Just a couple of words with regard to this. I think the Steel Infra Solutions, that's the entity I think that, is owned by Ravi Uppal. Ravi Uppal, as we know, I think he... if I got the name right, he used to be the MD of JSPL. So the acquisition is close to 1,000 crores. But I think, they've also gone ahead and they've done a pref issue as well. There's an issue of shares that should come up for you on the screen. And there are some marquee names in there. I think MK Ventures as well is in there. The issue is done at close to around 70 rupees, And Mr. Ravi Uppal is also part of that issue. So the consideration appears to be around 1,000 crores. Part of that will be via shares. Part of that will be via cash consideration. So the stock, as Prashant mentioned, had run up. But I think, close to a year or 2 years or so ago, it was at the similar levels. Then it saw a sharp correction. Mr. Prabhakaran has come in as, as an investor. And we know that when he came into Lloyd Metal, that's where the big turnaround did start off. So, yeah.
He came in at 49 bucks, right?
Yes.
48, 49 rupees.
Yes.
And that's basically when the move started. And, it's a very, very sharp gains in a very short period of time. But the thing is, I think the deal is financed through some stock and cash.
Yes.
So when, your stock's done so well, the acquisition is... is cheaper. I mean, because you're paying with
Share swap is actually close to 50% of the acquisition. 1,073 crores is what the acquisition is.
Yeah.
And the share swap is around 500 crores or thereabouts. So we'll have to see strategically, the management has put out very, very big guidance for Lloyd's engineering works. So this is part of that as well. Organic, inorganic growth, I think they're going to be putting in another entity as well, merging it into this entity. So we'll have to see how that goes. For the time being, there is some profit taking, big warrants issue, a big acquisition as well. We'll have to see how it pans out.
What's the market cap, Nigel?
It's 12,000 crores.
12,000 crores. Okay. All right. Well, that's the Lloyd's Engineering stock as things stand right now. Half financed by a stock which has doubled in the last 2 months, so which is good. I mean, from an acquirer's point of view. Rahul Veera is with us, fund manager, equity investments, Nippon India AIF. Rahul, good to have you with us here. Good afternoon. Good to speak with you. There is a bull market, and the bull market and the euphoria is in capital goods / industrials, right? That is the one pocket, and then the entire mid and small cap part of the market gets blamed. But actually, the euphoria is in 1, 2, 3 of these pockets, right, Rahul? So what are you doing in that broader space? Because lots of action, lots of opportunities.
Absolutely. So we are seeing the mid cap and small cap doing relatively better going forward. But what we did is we did one very small exercise from 2009 to 2019. We pulled out the data in terms of the valuations for around 800 companies along with the newer listings. So Nifty 500 plus all the newer listings. We found that 66 companies, that's across IT, your FMCG and banking and financial services, are still trading lower than the 2009 to 2019 cycle. Now that cycle also saw some demo on GST, all the NPAs that were happening. So private banks at this point of time looks pretty good to us at this point of time. Capital goods, we have gone on an equal weight. Last year we were overweight. We've been reducing the overall weight in the cap goods side. Beyond that, consumer discretionary is something that we are looking forward to. We believe some of the names have corrected very sharply. There are some decent opportunities there.
Got it. Hi, Rahul. Good to see you in. Name a couple of opportunities, right? If you could disclose, I mean, a couple of stocks that you all have bought into with due disclosures. We'll take it on the screen.
I would avoid refrain from taking the names, but from a consumer discretion, for example, some of the luggage companies are doing very well. We are seeing the competition going off given the PVC prices, the luggage imports that were happening from China. So there is very minimalistic competition going on for one of the large players there. Beyond that, some of the private banks, large private banks are trading between 1.5 times to 1.8 times price to book on a forward basis. Look very attractive to us at this point of time.
Okay, so the luggage player is the one that's got a new promoter or the one that's been growing very fast?
I'll refrain from discussing that.
Or both of them?
I'll avoid any further discussion on this, please.
Okay, got that. But you've been quite, enthusiastic on this space itself, I think. So travel as well as, I think the other stock that y'all had, I mean, if I look through the large trade details, I think Taj GVK is what you picked up a large chunk out there. What about hotels, tourism? You're still bullish on that?
Absolutely. See, from a 3-year perspective, we believe this space is going to continue to grow. Your average room rates are growing at 8 to 9%. The supply is very limited across the tier 1, tier 2, tier 3 cities. And given all the geopolitical issues that are going on, we believe the domestic names will do slightly better than the global names.
Sorry, so you're saying local will do better than the global
yes.
Companies, okay. By the way, the market's seeing a bit of a spike as we speak. If the Nifty will tell you that we're up about a quarter percent. So from 24,100, we've basically added on about 50 odd points in the last. It's come through in the last couple of 2, 3, 4 minutes or so. That sharp spike we're talking about. Maybe just take a look at the Nifty Bank as well. There is a bit of a move, but I think it's more pronounced as far as the Nifty is concerned. But the Nifty Bank has also moved higher as we go into the last 30 minutes or so of trade. So that's that. Just a quick word. I think if you look at the portfolio breakup, Rahul, financials is still the top weighted, right, for you?
Absolutely. So banking and financials, consumer discretionary, pharma is something we are very positive for the next 1 to 2 year perspective.
PFCs. These are banks?
Equal weight or basically reducing weight in the cap goods sector from this point of time. And IT, we continue to remain underweight there.
I see. This bank, the financials is largely private banks, or it's a mix of everything?
It's a mix of everything. So overall BFSI, banks plus capital markets plus your PSU banks. Across the sectors, we have the names in our portfolios.
I see. And industrials, capital goods, etc., you're kind of trimming as you go along.
Yeah, we are continuously trimming the names because some of them are trading at like 60 to 80p. We believe any one blip, or in terms of what we saw recently in one of the names where one of the large order got cancelled and the suddenly stock went off. So these high valuations cannot sustain beyond a point.
Yeah. Within that pack, defense, right? Many of these stocks are back to, I think they are back at Operation Sindoor kind of levels. If that is a marker in that sense, either it's a double top in the making or these are fresh breakouts. What's your sense, Rahul?
See, going forward, we saw the total export data, right? For FY26, almost 1.78 lakh crore was the export from the defense side of it. So government order book will continue to increase. Valuations from a 1 year or 2 year forward basis, it will never make sense. You'll have to play it as a theme. So from a 3 to 5 year perspective, how the cash flows will turn out, how the government is going to see defense as an opportunity. So between 11 lakh crores, the total capex that was allocated in the budget, right? So power and defense is something that will continue. Your road and railway might see some kind of a reduction this year, given the balance sheet of the governments.
I see. Got that. And I see some healthcare names also in the portfolio, Rahul. There's on the hospital side.
Right. So see, they are continuously, if you see the ARPOBs or the margins, again, what are the capex cycle for the hospitals had to, for the past few years that we saw margin compression for some of these names. We believe the businesses will turn around from here on. The newer acquisitions, some of these names have done, improving the margin profile, ARPOB profile. And again, valuations from a 3 to 5 year perspective seems very sustainable at this point of time.
Okay, got that. Rahul, we'll leave it there. Quick conversation. Thank you very much for joining us. Really appreciate your time here on CNBC TV 18. We'll take a break. We are back. We'll get you what's happening in dealing rooms with Nimesh on D Street Chatter and some trading ideas as well. Stay tuned.
Welcome back. Well, keep an eye out on Bajaj Auto because the record date has come, on the exchanges just now. Remember, they'd already announced a buyback, and I think the buyback price was approximately, 12,000 rupees approximately. Yeah, 12,000 rupees per share is what the buyback price is. But what's new is now they've set the record date on the 24th of June. So if you have to be eligible for that, you'll have to buy it on T-1. I think on 23rd, that will be the last date. So that's why you're seeing an additional fillip that's come in there for those that are purely paying it for this particular event. That is the buyback. The record date has just been uploaded on the exchanges, 24th of June. It is, so it spikes up a little bit. But good time to get in Nimesh. He's here to tell us on D-Street Chatter what's going on in dealing rooms. Nimesh?
Well, another strong day for the market as it consolidates with a positive bias and backed by FI buying as well. For the last few days, we're seeing the trend of FI buying has resumed, and that's the case today as well. At the same time, there is a lot of supply of paper coming in. Even today, there were a couple of large blocks. So the trend of large QIPs blocks continue. Today, for instance, the number will look a bit larger because of the large two blocks, which was amounting to close to 1,600 crores. So that's something to watch out for in the institutional data. Having said that, as I said, there is a bit of consolidation with a positive bias. But on the upside now, 24,250 can act as a bit of a resistance. So that's the level to watch on the upside. But broadly, this momentum in the broader markets and in Nifty seems to be backed by a bit of FI buying as well.
Okay, got that, Nimesh. What about individual stocks that are on your radar?
Well, in terms of individual names, the first stock on my list is Shaily Engineering. That's been under pressure today after a large block. Nearly 11 lakh shares got changed hands, and I believe one of the domestic mutual fund was a seller in today's block deal. So disclosures, if any, could be interesting to track in Shaily Engineering. The second name is Bharat Coking Coal. That's been buzzing as well on very large volumes. In general, there has been buy flows at HNI desk, and I believe one of the leading HNI investor has an active buyer as well in Bharat Coking Coal of late. The third name is Jyoti CNC. Even that's been consolidating in a narrow range of late, but I believe the management happened to meet some large investors in the last couple of days, and there is a very strong indication of a large order win as well for the company very soon. And the last is DLF. Even that's been buzzing in trade today on good volumes. I believe there were multiple block deals as well in DLF today, but additionally, some larger HNI seems to be actively buying as well into DLF in the last couple of days.
Okay, thanks a lot for that, Nimesh. Well, let's take a quick check on the F&O markets. Then the India VIX continues to cool off. Remember, the India VIX had gone dancing away to 29.30 when that war was on. So that's cooled off to sub 30 now. That's one of the indicators of the kind of move that we see in the market, and fear is gradually, subsiding in the market. Once it breached that 15-odd mark, from there, I think we have seen another 400-500 points on the Nifty itself. The PCR, that's holding at around 1, so it's more or less in the middle of that range of 0.6 to around 1.6. Put writing is evident. 24,100 put premiums half to around 80 bucks from around 160 rupees. But on the flip side, I think the bears will want to protect this 24,250 mark. The reason I say that is at the 24,100 call, the premium out there is 150 rupees. And if you add that to around this 24,100 call, let's pull up the 24,100 call. It should come up for our viewers on the screen. Yes, that's the one that I'm talking about. That one was around 150 rupees. So if you look at the 200 EMA, that comes in line with around the 24,250 odd mark, which is the next resistance zone from a bullish perspective. The Nifty Bank, that's the one that's leading the way. It continues to outperform. And HDFC Bank, the big underperformer, that's come into play as well. And as we speak, that's at around 800 rupees odd. Individual stocks, Keynes, that's been in the F&O band. That's coming for a bit of a short covering bounce. So good move is what we're seeing out there with the open interest down. I think that one, in fact, could be one of the candidates to come out of the F&O band. Let's see how that goes. Trent is the other one that's seeing a bit of a short covering bounce. But on the flip side, you have Radico that's seeing some fresh buying in today's trading session. So the screen is looking good. The Nifty Bank is leading the way. And you have the big boy, HDFC Bank, that's woken up from its slumber. Will be good times for the Nifty as well as the Nifty Bank from here on, if that can continue with this sort of a momentum. Mitesh Thakkar, those back with us. Mitesh, what are your buy or sell call recommendations that you have?
Last 1 hour, actually, has been very good, and that kind of reaffirms the uptrending movement. So we'll take some BTST calls. MFSL was a BTST with a stop just below 1675.74. Look for a 1705, 1710 kind of a target for tomorrow or day after. And the second stock, which I like, that's Page India BTST with a stop below 39,900, 39,890 and a target of 40,254.
Got it. Okay. All right. Thanks a lot, Mitesh, for that. Well, let's focus on the big IPO. NSE has filed the DRHP with the market regulator. Yash is with us to fill us in with all of those details. Yash?
Well, the largest stock exchange in the country coming out with the largest fundraise through an IPO as far as the history of Indian capital markets is concerned. A closer look at the DRHP document would tell you that the total number of shares that are on offer through an entire offer for sale issue is about 14.89 crore shares. This forms about 6% of the total paid up capital of the National Stock Exchange. We had reported this thing yesterday and we continue that. That is, the IPO size is likely to be expected between 30 to 32,000 crore rupees, and that would value the National Stock Exchange at 5 to 5.33 lakh crore rupees. As I said, it's the largest fundraise in the history of Indian capital market so far. Who's selling out of the NSE's OFS portion? The largest selling shareholder is State Bank of India. They have about 3.23% stake in the National Stock Exchange, and out of the total shares which are on offer, their portion comprises of about 16.6%. The next one is MS Strategic. They have about 1.2% stake and they offer about 10.75% of the total shares on offer as far as the OFS is concerned. These are the companies on the extreme left. You'd see how much they hold and how much they offer. Stock Holding Corporation, GICRE, various other PSU institutions coming together to offer partial stake as far as the OFS itself is concerned. Now, in terms of, as I said, the paid up capital, total about 2,475 crore shares. What is on offer forms about 6% of the equity paid up capital. In terms of revenue and the financials for NSE, FY26 was a weak year in terms of top line growth as well as the operational performance of the National Stock Exchange. But do remember, by the time the company files its RHP, it will release the first half numbers for FY27. So those numbers will be very crucial in terms of how the company has performed in the first half of FY27. As far as the next slide itself is concerned, here in terms of market share, this tells a large story in terms of the domination which NSE has had in Indian capital markets. Cash market segment about 93% market share, equity futures about 99.8, equity options about 74.5, currency futures 99.5, and currency options almost entire market belongs to the National Stock Exchange.
All right. Yes, thank you very much for that. So that's interesting. Well, we spoke with, Mrugang Paranjpai, ex-MCX, on his thoughts on the upcoming NSE IPO. Listen.
Can you imagine that one single stock like NSE, with the amount of foreign holding that it allows, can actually draw in close to the amount that we talked of in the entire deposit mobilization? Maybe $40-50 billion of FPI investments can just come in purely because of one stock of NSE, which will draw lots and lots of foreign investors. I would expect a lot of, sovereign funds, all of that sort of long-term and very, very strong capital flows coming in. So it's not going to take away. In fact, to a lot of people who've been suddenly saying that, hey, India has lost the flavor, etc., we might be able to add back and get the capital allocations coming a little more towards our side with something like this.
Sudeep, welcome to the show. What do you make of this large IPO? We've been hearing about it for a while, and it could probably see the light of day in the next few months. What's your preference? BSE has been a super-duper outperformance. It has good amount of momentum. But now NSE could be coming to the bourses, and it will be at a discount in comparison to BSE. So your preference among exchanges, NSE that could be listed, BSE and MCX that have been big wealth creators?
Well, I think it's a very welcome development, Nigel. And I think, overall, from a capital market point of view, it's a good news. BSE also will gain. Remember, NSE is going to get listed in BSE. And BSE cash market volumes are expected to go up significantly. So one indirect beneficiary will be BSE as well. But if I have to pick one stock amongst the exchange stocks, amongst the listed ones, I've been preferring MCX for quite some time, and I do continue to prefer that. Once NSE gets listed, let us see where the valuation settles. Post that, we can take a call. But at the valuation which is being talked about, at the offer price which is being talked about, it of course is at a discount to BSE's price today and does look attractive compared to BSE. But let's see where it settles post-listing.
Yeah. But you, out of the lot, you like MCX, right, Sudeep?
That's right.
Yeah. Do you own a NetWeb, Sudeep? I think we discussed this earlier, not lately, but I think it's at a new high, 5,100.
Well, Prashant, unfortunately, I don't own it. But the excitement, obviously, this entire AI-related excitement is getting played in India through only a handful of stocks, and NetWeb is one of them. Not sure about whether it's justified or not, whether we can impute an AI valuation to NetWeb, but that's what is happening. I don't think I will recommend a buy in NetWeb at current levels or try to buy this stock at these levels.
Yeah, I think in the case of NetWeb, Sudeep, they are not. I mean, in most of the data centers being built are not AI data centers in India. They will come, but they are more standard data centers. And where NetWeb comes in is basically racks and servers, etc. I mean, GPUs, of course, they have to depend on NVIDIA, but they also are distributors for NVIDIA in India. But they do racks, server racks, etc. But the point is they're a kind of a late cycle player, right? You got to build the data center, you got to do all the wiring, cabling, all the EMP work, and then you put the servers in. So the ordering at some level for a company like NetWeb will only start after all of this. So this will, right now we're hearing these big announcements, but all of this will translate into orders in a big way only, I guess, a little later. So it's not an early cycle play in that sense. I mean, of course, and the play is data centers, there's nothing else for this one. Lots of stuff moving around, and we'll talk more. We'll take a break. Sudeep, stay with us, and we come back with a few more names on the other side.
Welcome back. Well, let's squeeze a couple of, questions into Sudeep. We have some comments coming in from the RBL Bank CEO as well. I think we'll tag the correct stock. India remains the fastest growing major economy driven by rapid digitization. The RBL stock actually should come up for you. We'll get that corrected as well. Sudeep, any view on RBL Bank? The stock ran up in anticipation of the deal. The deal got concluded. The stock ran even more, after the initial news flow got cleared out. Your view?
Well, I've been positive on RBL. I think it's a good deal from an RBL Bank point of view. They needed capital, they needed growth, and they needed certainty as far as promoter is concerned. They've got all through this transaction, and I think it's a long-term positive for the bank. And I expect the stock price to keep moving up. Performance also has been improving. Stability in management will do wonders. That's what I believe. Overall, BFSI, our view has been positive, and we do like RBL, and also we like indices, which I thought I'll mention because it's a turnaround case, and we do like that as well.
Okay, got it. RBL as well as Indocin, got it. What do you were earlier bullish on aluminium, right? On all these players, Nalco, Hindalco, Vedanta Aluminium is just listed, and you have a couple of brokerage calls that have come out. What's your view? Aluminium price was $3,850 per ton around 7-8 trading sessions ago. Now the war is called off, which is good for the globe, good for equity markets, good for humanity. But it may not be so good for aluminium because aluminium was factoring in a war premium. That's come down, though structurally it appears it'll be in deficit. Your take?
Well, I completely agree, Nigel. I think the war premium is gone, but structurally there is a deficit. The 10% of world supply, which comes from the West Asia region, it'll take some time before the supply is restored. Anywhere between 1.5 years is a time which our guess is will be required. And aluminum prices will continue to remain at elevated levels. It may not reach the stratospheric levels it was, but it will remain elevated. And companies like Vedanta Aluminium will continue to gain because of that. Also, look, specifically Vedanta Aluminium is fully integrated. They're expanding production capacity, and they are definitely very well positioned to take benefit of this aluminium, for lack of better word, super cycle.
Sudeep didn't ask you about Bata India. We discussed it earlier. Look at the stock. Oh boy. It's up 16% now. At 230 when we started, it had come off the highs. And it was up some 7%, 6.5%, 7%. It's up 10% from that point on in the last 1 hour or so. It's any thoughts, Sudeep?
Well, Prashant, I think this is one stock which can do wonders. I mean, today's excitement is on the appointment of the new managing director who's coming from Nike. But I think this has got a fantastic potential. They have got an unmatched distribution across India. Every nook and corner, you have a Bata shop. The product and the pricing and positioning was probably not appropriate. That's why they could take the benefit of the massive distribution outreach. Now, somebody with the right skill sets and somebody with the right efficiency coming in can really turn around the company, and it can be a multi-bagger even from current levels.
Yeah. So that's an interesting one. And as I was saying earlier, management changes could be interesting things to look at more deeply, study more deeply, because some of them have turned out to be big winners over a period of time. And Bata, of course, is especially depressed. Price has been depressed because earnings have been depressed for a while now. So 790 on Bata at close. It's clearly the stock of the day. By a mile. And huge volumes, by the way, not small volumes at all today. Okay, so we end about 90, 95 points in the green, and almost all of the 90 points have come in the last, 40 minutes. 255, the Nifty was at about 24,100, and we ended about 24,180. So that's the final thing. Nifty Bank, mid-cap, small-cap indices looking good. And if you want to go sectoral, tourism, top gaining sector, healthcare, the CPSE index, real estate is the index. And perhaps the only loser was the IT index, which was down across the board, cuts coming through today. Now, Max Health was the biggest Nifty gainer by far, 6.5% gain. Adani Enterprises was up at number 2, and there was Indigo, which did well. As I said, Infi, TCS, Wipro, the big losers as far as IT on the Nifty go. And of course, I mean, in the broader space, there is Bata, but there were NetWeb, there was CDSL, and so many else, so much else which did, very well. So KPR Mills was up 14, Keynes and DLF and Astra Micro, Electra, Nelco, Radico. I could go on with enough and more action to see us through this Thursday afternoon. On the other side, I mean, maybe Shaily Engineering was down 5.5%. It's the big volume-led cut. MCX was down a little bit, 1.25%. Walkhard was down 1.5%. Varun Beverages sold off about 2%. And there was a Paytm which was down about 2.33% or so. So that's the picture. That's the day. Sudeep, thank you very much for joining us on closing. But stay tuned. Stay with us in Markets Forward coming up in just a bit. Thank you for staying with us on the show. More on the other side.
Indian markets end higher for a fifth consecutive session, extending their winning streak amid broad-based buying. The Nifty closed above the 24,150 mark, while the Bank Nifty outperformed.
Textile and Alcobev stocks rally after the India and UK move closer to implementing the free trade agreement from July 15. The deal will grant zero duty access to nearly 99% of Indian exports to the UK, raising hopes of stronger export growth and improved competitiveness for Indian companies.
Consumer-facing stocks surge in trade. Nykaa unveils an ambitious FY30 roadmap at its investor day. Target 2 to 3 times revenue growth and 4 to 5 times EBITDA growth. Bata appoints Sanjay Rao as its new MD and CEO for a 5-year term.
Good evening. You're watching us here on Markets Forward. This is your go-to show where we aim to get you all the important updates and key data points that you need to get up for the next trading day while recapping today's session as well. I'm Mangla Malu. With me as always, Sonal Bhutra, doing extremely well for the markets. Sonal, towards the end, we saw that big spike 24,168 is where the Nifty ended, much above 24,150, very close to that 24,200 mark as well. And a large part of that spike came in the last hour of trade, as we can see, and that was led by the Nifty Bank. All through today's trading session, the Nifty Bank did well. There was a bit of a tug-of-war between both the Nifty Bank as well as the IT index, but at the end of it all, it was the Nifty Bank that took the cake away. And then we did see some notable contributions coming in from names like Interglobe Aviation. Reliance too moved off its lows, and some other index heavyweights doing a lot better too.
How did you forget consumption? Because consumption stocks were all we could talk about through the course of the day. Of course, that index did underperform something like a banking index, realty, financials, but did well in trade today. It was up around 0.5%. Most of the sectoral indices ended in the green today. So yes, fifth consecutive day of gains for our own markets. We'll discuss that and a lot more, but let's tell you what we do have as a lineup and what do we have in store for you today. We start with top movers and shakers of the day with Hormuz Fatakia. We break down the rally Nykaa and textile stocks today, along with Bata India's leadership rejig as the company positions itself for its next growth phase. Last but not the least, we delve into the key market events to watch out for tomorrow's trading session. So let's get to the first segment of the day now. Hormuz Fatakia is joining us now from the big wall with the top movers and shakers of the day. Hormuz, over to you.
Another good day for the markets, right? And in the last hour of trade, when the heavyweights pulled the index higher today, the Nifty Bank continuing its outperformance, and that shows in the contributors as well. HDFC Bank, SBI, all of them pulling their hand up and ensuring that the Nifty ended higher in today's trading session. HDFC Bank now back at 800, SBI nearing the mark of 1,050 as well. Some of the other notable contributors today are Max Health and NTPC as well. Max Health ending with gains of 6.5%. The India-UK FTA had its impact across sectors, textiles being the predominant one, of course. KPR Mills ending 13.5% higher. Gokaldas Exports also doing well. Welspun Living of another one that saw double-digit gains in today's session, and among the liquor names, it was United Spirits that did well, 3.5% higher on this one as well. Among the newsmakers, you look at Nykaa, the ambitious growth plans that the company has laid out, the stock ended 6% higher. Lloyds Engineering, the acquisition announced by them in Reddington on reports of Apple looking to raise prices of its products, ending 10% higher in today's session. Some of the high-flying names from earlier in the weeks are seeing some profit booking today. The IFCI ended with losses of around 8.5%. IDBI Bank was up 18% in yesterday's session, ended 6.5% lower today. Some sell-off also seen in Paytm and in Azad Engineering. And the one stock that took the limelight in the last 30 minutes of trade was Bata, and that is after the announcement of its new MD and CEO, 16% higher on the stock. The last time the stock had gained at such a quantum was all the way back in March of 2006. That's the kind of moves you've seen on a day like today for Bata.
All right, take that point. Hormuz, thanks a lot for that. You spoke about Bata and a bunch of other stocks as well. We missed out on consumption at the opening of the show largely because throughout the show we'll be talking about just that itself. And let's kickstart with FSN e-commerce, the parent of Nykaa, where, the company met a lot of analysts and they laid out their ambitious growth plans for FY30 as well. What is it that they're saying? Well, to start with, their overall gross merchandise value would actually jump over 50,000 crores in the next 4 years from now. 50,000 plus crores is the gross merchandise value that they're targeting, nearly $5 billion. And they've broken it down on the revenue, EBITDA and EBITDA margin basis as well. The revenue from current levels could double or triple depending on what the industry does, at least double, and they can also triple. And were that to happen, the EBITDA will grow a step further. 4 to 5 times growth from last year's EBITDA is what they're expecting. Margins, which are currently at 7.5%, will also double to low to mid-teens in FY30 from FY26. And in their two important verticals, the beauty vertical, they are expecting margins to come to healthy double-digit. This compares with the high single-digit that the company is reporting, with the GMV out here as well growing 2 to 3 times. Fashion, which has been the margin drag for the company, broke even just in the fourth quarter last year. That's likely to report a high single-digit EBITDA margin over the next 3 years as well, with the GMV jumping 3 to 3.5 times. Steady state margins here, they see over 10%. More importantly, their other businesses, House of Nykaa, which is their own brands, they expect there too the revenues to be over 5,000 crores. This was about 3,100 crores in FY26. And the B2B superstore business, they expect from about 1,100 to 1,200 crores of gross merchandise value to jump all the way up to 3,500 crore plus by FY30, with a reach of over 1 million retailers in India. So that explains why Nykaa was surging in today's trading session. And this, despite a 5% surge that we saw yesterday. But from makeup, let's go down to footwear, and we do have Bata. That was another stock which did extremely well in today's trading session. One of the biggest intraday moves that we saw on the stock in the last 20 years, and that's largely because the company has appointed Sanjay Rao as the MD and CEO of the company effective October, as soon as the current MD and CEO Gunjan Shah's term gets over in September itself. Importantly, the credentials that Sanjay brings are fairly high, 20 plus years of experience across India, South Asia, China and Europe. What he currently does is, the senior director at Nike Retail for 4 European nations. So obviously footwear experience. And before that, he was with Inditex, established Zara's presence in India with Tata. So across the board, fast fashion and footwear is something that he brings. And if you look at his LinkedIn profile, it says that he's a turnaround specialist. If there were 3 Venn diagrams made for Bata, footwear, fast fashion and turnaround, the stock has done nothing over the last 3 years on a sales basis. 1% CAGR, net profit is down 20%. The last 3 years, the stock has delivered 25% negative returns on a CAGR basis over the last 3 years. From a November 2021 high of over 2,100 rupees, the stock had fallen to sub 700 rupees as well. So needed a turnaround, and you have someone who's worked at Nike, someone who's worked at Zara, someone who's a turnaround specialist coming to the company, and the street is understandably excited about that. That explains why the stock was up 16%.
Okay, 16%. That's a big surge that we have seen in the stock today. Thank you for explaining those moves in the consumer stocks. To take this discussion forward, I'm now joined by Sudeep Bandyopadhyay of IndiTrade Capital and Ruchit Jain of Motilal Oswal Financial Services. Gentlemen, good afternoon. Thank you so much for joining us. Sudeep, let me come to you first. That big surge in Bata, do you think this leadership change is good enough for investor sentiment to turn in the positive direction? What is your take on this particular name and Nykaa as well?
Well, Sonal, investor sentiment definitely has turned. That's the kind of excitement we saw in the market today. And I must say that, Bata is definitely, potential has not been utilized. The kind of distribution network Bata has in India is absolutely unmatched. I think you can hardly get a better network in every nook and corner of India. They need the right products, they need the right pricing strategies, and of course, efficiency needs to significantly improve. Now, if the new MD can do all of that, I think the sky is the limit as far as Bata is concerned. They can give pretty much all the other footwear retailers a run for their money. Nobody has even 10% of the distribution reach which Bata has. So obviously the potential is significantly high. The market is excited and will definitely watch the performance post the new MD taking charge in 1st October. As far as Nykaa is concerned, I think things have been improving in terms of performance over the years, and the kind of roadmap they have laid out for the future is definitely inspiring, and that's why the market is rejoicing. But we'll have to wait and watch how things move. The private level strategy house of Nykaa is doing good. They definitely are aggressively moving in that direction, which will be margin accretive. The target of mid-teen margin for overall company, again, is commendable. And that's why I think the market is kind of excited about Nykaa today.
Take that point. House of Nykaa, some of their important brands, the likes of Dot & Key, K-Beauty, etc., are doing extremely well. Now, there are reports of them going ahead and buying Deepika Padukone's brand as well. So let's see how that pans out in their overall house of brands strategy. But let's talk markets with Ruchit Jain. Ruchit, the last hour spike that we saw, how much of that would you attribute to short covering and how much of that is sustainable from here on? Nifty very, very close to its 100-day moving average now.
Yeah, hi, very good afternoon. Well, it just seems to be a continuation of the uptrend that we have been witnessing since last few days. The good thing is that in this entire last 4 or 5 trading sessions, the market breadth has remained positive. We are not seeing any kind of significant sell-off over there. Major hurdle for the markets is straight around 24,500, 24,600, where the 200 EMA and the previous swing highs are placed. So I think we should see a continuation of this momentum, a gradual up move towards 24,500 in the near term.
Okay, take that point. So that's on the markets. Gentlemen, stay on. Let's talk about textile exporters. The shares of such companies, say Gokuldas, KPR Mills, Pearl Global rallied after India and the UK resolved the remaining issues in their free trade agreement. The pact is now expected to come into force from July 15th, paving the way for zero import duty on Indian textile exports to the UK. Devyani joins us with more details on this one. Devyani.
Well, the textile pack was all buzzing in trade today, and that's because the UK FTA, the much awaited UK FTA, is now going to come into effect from the 15th of July 2026 onwards, while the EU FTA is expected to come in by the end of this year. Now, what that does is it brings free trade access for our Indian exporters to the UK as well as the EU, where we were paying roughly around 8 to 12% in import duties previously. Now, what that does is it helps with bringing in better competitiveness for our products, as well as better margin expansion for the current companies that are already supplying to these particular markets. Now, it's expected that the UK FTA will end up in our textile exporters gaining about a 5% market share over the next 2 years, while the EU agreement is expected to boost EU sales by about 50 to 100% of their current value, which sits at around $5 billion over the next 5 to 7 years. Now, the key stocks to watch out for include Gokuldas Exports, Indocount Industries, KPR Mills, and Raymond Lifestyle, as they all have exposure to these markets and will be looking forward to growing in these markets going forward.
All right, take that point. Sudeep, your view on the textile space. Obviously, the last quarter will be good for them despite the West Asia crisis, and that's largely because of currency-led depreciation. And we saw good numbers coming in from a lot of these companies as well. With this UK-India FTA being signed, do you think textiles warrant to look now? And if yes, what would be some of your preferred picks here?
Definitely, Mangalam, this is a very good development as far as these companies are concerned. Look, it's an extremely competitive industry, and they compete with Bangladesh, Cambodia, Vietnam, and the likes. And this duty relief which they get through the FTA definitely increases their competitiveness in the market and will help them increase their market share and business in these markets. UK starting July 15th and EU hopefully before the end of the year. I think it brings a significant revenue advantage, and that overall should improve the margin as well. So we have been positive on these FTAs, and we have been positive, particularly the FTA benefit for these companies. We will also await finally the USA trade agreement to be signed and executed. I suppose it will take some more time, but as and when that happens, that also will be excellent for all these companies. Amongst these companies, we do like KPR Mills quite a bit, and we have been, recommending that for some time.
All right. So textile companies continue to be in focus on the back of this UK-India FTA. The other pack that was doing well was metals. Shares of Shyam Metallics in particular, they were in focus as the company unveiled an ambitious FY31 roadmap. What did they say? How do they plan to fund it? But how realistic also are these targets? Nigel is joining us with more details on this one. Nigel.
Well, Shyam Metallics had their investor meet here in Mumbai, just yesterday, and they've laid out a very ambitious 2031 target. Let me run you through a few details. They're talking about revenues at around 42,650 crores. The EBITDA number they're talking about is around 6,236 crores. Very, very ambitious if you just look at what they've done and where they believe they're headed. Now, in terms of return ratios, they're going to maintain it healthy at around 20% to around 22%. They also say that the net cash positive number will continue, and the entire focus is going to be on value downstream products. And that's why the EBITDA number in various segments are going to balloon up. A lot of focus is on stainless steel, and from around 77 crores, they're talking about 1,100 crores by 2031. That's extremely ambitious. Now, on carbon steel, from around 1,700 crores, which is bulk of the EBITDA right now, they're saying it moves closer to around 2,866 crores. On special bar quality steel, that's going to move to around 1,019 crores or thereabouts. So that's broadly the breakdown in terms of the EBITDA number. For this, there'll obviously be a capex. They have highlighted that around $1.1 billion of capex will be deployed over the next 4 to around 5 years, which will be funded by internal accruals, and there'll be no external debt. Let's see how that goes, because that's a very ambitious number. The past record was pretty good. In the last 20 years, on a far lower base, they have compounded their EBITDA, their revenue, as well as PAT at around 20% CAGR. But from this base, it'll be interesting to see whether or not they can go the distance. Jefferies, one of the brokerages that were positive, they're even more positive. They have a buy rating. The target price, they've upped to around 1,150 from around 1,040 earlier. What are they factoring in? EBITDA and EPS to compound at around 14 to 16% over the next 3 years. They believe the company is offering one of the best growth potential in India metals. So that's why they're optimistic. Stock as well, reacting positively.
Stock reacting positively. Nigel, thanks a lot for that. Ruchit, how are the charts looking in the metal space in general? Because as the world is looking at more peace coming in. The war premium is ending in the commodities. So as a result of which, we've seen a bit of a slide. Do you think there is tradable chartically?
15-20 sessions, the stock has just consolidated within a range. 940, 950 being a support zone, and 1020 is the resistance. So I think, but if you look at overall structure, then there just seems to be a time-wise correction within an uptrend for Shyam Metallics. So the 20-day MA is a good support for the stock. If that remains intact and we see the stock surpassing that 1020 range, then we could see a broader resumption of the uptrend. So can be on the watch list above 1020. One should look for fresh buying opportunities in the stock. Overall metal space, we think that the index is going to some time-wise corrective phase. We have seen a pullback phase from the highs in many of the base metals, and hence we are not witnessing any kind of relative outperformance in last 4-5 days within the metals. So I think metals as a sector can see some more time-wise correction in the near term.
Okay, all right. Take that point. Thank you, Ruchit, for those thoughts on metals and Shyam Metallics. Thank you, Sudeep, for joining us with your fundamental analysis on some stocks and sectors. With that, we'll slip into a short break. We get you the top corporate voices along with the key market events to watch out for on the other side. Welcome back. You're still tuned into Markets Forward. Let's get you some corporate voices of the day. Federal Bank is expecting strong participation in the RBI's latest foreign currency deposit mobilization scheme. The lender alone expects to attract more than $1 billion and sees an inflow of up to $50 billion for the Indian banking system.
Pune-based Kalyani Steel is also seeing strong demand across its key markets, with the company benefiting from healthy order flows from the automobile sector, exports of auto components. In fact, speaking to CNBC TV 18, the management said they are operating at 100% utilization for nearly a decade, while environmental clearance for their Odisha project is taking longer than expected. The company has around 800 crore rupees in cash reserved for future expansion.
And before we wrap, we bring you some key events to watch out for. Riya Bhatia standing by with that list.
Well, yeah, starting off with the global events first, looking at the economic data, we have the CPI print coming out of Japan to watch out for. And in the UK, the retail sales data will also be closely tracked. Also remember, it is a market holiday in the US, China, Hong Kong, as well as Taiwan tomorrow. And back home in India, we will be keeping an eye on the AGM of Reliance Industries. And in terms of the IPOs, Total Mint Fintech's rupees 883 crore subscription will be opening tomorrow. And in other news, PM Narendra Modi will be disbursing incentives worth nearly 2,400 crores under the PM Viksit Bharat Rozgar Yojana.
Okay, Riya, thank you so much for that list. And with that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening.
This was not easy, I can tell you.
US President Donald Trump signs a 14-point agreement with Iran at the Palace of Versailles in France. Iran's president signs the accord separately in Tehran. The Strait of Hormuz is set to reopen. Iran promises status quo on nuclear weapons. US will lift all sanctions. Both sides have 60 days to work towards a comprehensive peace deal. Brokerages expect oil prices to ease, but the pace of decline will not be rapid. Goldman Sachs, Morgan Stanley and Citi see Brent between $70 to $80 by the end of this year. JP Morgan is an outlier as it pegs Brent near $60 by the end of 2026. Sensex and Nifty gain for the fifth straight session. Mid-caps outperform. Rupee regains more lost ground against the dollar. US Federal Reserve holds rates steady in the first policy under Kevin Warsh as the new chairman. Warsh refuses to submit a rate forecast of his own, even as a majority of other Fed members expect a rate hike later this year. Warsh sets up 5 new task forces to overhaul the Fed communication, balance sheet and data sources. The ball gets rolling for what could be India's largest IPO. NSE files draft papers, looks to sell 6% equity, raise up to 32,000 crore at a valuation of over 5 lakh crore rupees. SBI and Canadian Pension Fund pegged to be among the largest sellers. Shares of textile exporters rally as India and UK announced the free trade deal will be effective from the 15th of July. Government sources say Indian workers in the UK will be exempted from social security contribution for 5 years. The CEOs of Anthropic and Google DeepMind call for a US-led coalition to shape rules and standards for artificial intelligence. CNBC reports the pitch was made at a closed-door meeting with world leaders, including President Trump at the G7 summit. Apple will hike the prices of its products, says outgoing CEO Tim Cook to Wall Street Journal. Cook says a price hike is unavoidable due to semiconductor crunch and rising cost of storage. And Portugal disappoints as DR Congo stuns in its first World Cup in 52 years, holds the Cristiano Ronaldo-led side to a draw and secures its first ever World Cup point. England begins its campaign with a comprehensive win against Croatia. All right, the top story this evening, 111 days after the US and Israel attacked Iran and dragged the entire Gulf region into a conflict and choking global oil supply, we have the framework for a peace deal. Trump and his Iranian counterpart have signed a memorandum of understanding to end the conflict, but the agreement comes with major caveats, including unresolved issues surrounding Tehran's nuclear program. US President Donald Trump said, and I quote, "This was not easy," as he signed the 14-point agreement at the Palace of Versailles in France. Iran's President Pezeshkian also signed the agreement separately in Tehran. Pakistan's Prime Minister Shehbaz Sharif, who mediated the negotiations, also signed the agreement, which is called the Islamabad Memorandum of Understanding. Addressing G7 leaders, President Trump claimed Washington will not have to give anything to Tehran and took a swipe at his former president, Barack Obama. President Trump withdrew the US from an earlier peace deal with Iran, which was signed during Obama's presidency.
Technical discussions on the removal of all stockpiles of enriched materials will begin immediately. We're going to start that immediately. And unlike Barack Hussein Obama, who sent Iran pallets of cash and any relief they receive under this deal, they'll have to get based on merit. And it won't be from us. We don't have to give them anything.
Well, Trump's claim that US will not have to pay Iran anything contradicts the text of the agreement, which includes a $300 billion fund for Tehran. Here's a closer look at the 14-point agreement. The document signed by both leaders is a 60-day truce agreement and not a comprehensive peace deal. Officials from the US and Iran will now begin negotiations for a comprehensive peace deal tomorrow in Switzerland. The 60-day agreement is good news for thousands of seafarers stuck in the Strait of Hormuz. US has agreed to end the naval blockade in the waterway within 30 days. The memorandum also says that Iran will not charge transit fees for 60 days. However, both Iran and Oman will decide the future administration of the strait in discussion with other Gulf countries. Remember, just a month ago, Iran had constituted a body to regulate maritime transit. Iran has also agreed to maintain the current status quo of its nuclear program. Tehran has said that it would not procure or develop nukes and will commit to down-blending of enriched material. Under the agreement, US will terminate all types of sanctions imposed against Iran, including UNSC resolutions. The US Treasury Department is also set to issue waivers for export of Iranian oil until termination of sanctions. The US will also develop a plan with at least $300 billion for the reconstruction and economic development of Iran. This will be undertaken along with Washington's regional partners, and the framework will be developed in 60 days. Iranian officials had initially demanded around $400 billion in reparations and war damages. There's also a clause in the document that allows negotiation timeline to be extended beyond 60 days with mutual consent. But Trump has said that if the deal is not done in 60 days, they will, and I quote, get back to bombing, end of quote. Listen in to President Trump defending releasing Iran's frozen assets.
Can you explain, though, what the difference is between giving Iran U.S. dollars and unfreezing U.S. dollars for
Well, the unfreezing is an easy one to answer. We have taken a lot of their money, and we have their money. We have taken their money. It's not our money. It's their money, and we froze it. At a certain point in time, I guess we're going to have to give it back. You know, if we didn't give it back, nobody would ever invest in the dollar again.
Well, brokerages are largely in sync on oil price glide path after the US-Iran agreement. Goldman Sachs, Morgan Stanley and Citi see Brent crude easing into the $70 to $80 range in the final quarter of this year. As supply risks fade, Manisha Gupta has more. Manisha.
Well, yes, the crude oil prices have declined quite sharply from $120 a barrel off a high during the West Asia conflict to almost $78 a barrel right now, which was the price on the 1st of March as well. So it has been a very volatile journey, but the prices are off by nearly 15% in a matter of last 5 days and down nearly 27% in the last 1 month as well. This is as there is a peace deal now, an interim one between US and Iran, and the expectations that you could be looking at Strait of Hormuz opening, almost 100 ships which are in and around Strait of Hormuz and are carrying anywhere between 20 million barrels of crude would perhaps be available to the global markets. This has brought the prices down, and this also has brought the forecast of crude from the Wall Street banks and brokerages also on the lower side. To name a few, you have Goldman Sachs, which has cut its fourth quarter 2026 Brent forecast now to 80. Earlier it was at 90. For 2027, they believe that the crude prices could average $75 a barrel. And then you have Morgan Stanley talking about $80 a barrel of an average in this year. The most bearish of reports is coming in from Citi. They're talking about $75 a barrel of an average in this quarter, $70 in next quarter, and by the time it's 2027, they're anticipating $65 a barrel of an average price there. JP Morgan, more bearish, $60 an average for the price is what they're anticipating for this year now. And then you have Barclays on the higher side of the range, anticipating $100 in this year and $80 a barrel of an average in the next year as well. So clearly, all these banks and brokerages, which were talking about 90s and 100s and beyond of averages, have clearly cut it to size, and we're looking at lower price moves now.
All right, thank you, Manisha, for that. On the other hand, brokerage firm Citi has raised its GDP growth forecast for India to 6.9% for FY27. The firm has also revised its balance of payments surplus forecast to $45 billion from $5 billion earlier. Citi also sees India's average headline inflation for the fiscal year at 4.7% versus 4.9% from a year ago. All right, on to the day's market action. Sensex and Nifty closed in the green for the fifth straight session. Nifty closed above 24,150 mark with Max Health, Indigo and Trent leading the pack. Nifty IT snapped its 3-day gaining streak, emerging as the top losing sectoral index. Nifty Bank outperformed and 11 out of 14 constituents closed higher. US Federal Reserve has held rates steady in the first policy decision under Kevin Warsh as the new chairman. Warsh refused to submit a rate forecast of his own, even as a majority of other Fed members expect a rate hike later this year. On inflation, he said that the policy would aim for price stability. Further, the new Fed chair also set up 5 new task forces to overhaul the Fed communication, balance sheet and data sources. CNBC's Steve Leisman is here with more.
Hawkish message on rates, reflecting that he inherited an inflation problem and saying the committee is strongly committed to dealing with that inflation problem.
we recognize that inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years. I am pleased to report that members of the FOMC are unambiguous and unanimous. This committee will deliver price stability.
Warsh clearly has embraced, at least for now, the existing hawkish bent of the committee, where 9 officials now project at least 1 rate hike this year and 6 see 2 or more. Only 8 expect to hold rates steady, and only 1 cut is projected. And markets have taken Warsh and the Fed seriously. The 2-year sold off hard, and the first hike is now seen with a 66% probability to happen in September. It had been December. A second hike now has a 55% probability for January, and there wasn't one priced in before the meeting. Warsh also pledged a rethink of how the Fed does business, appointing task forces to review Fed communications, balance sheet policy, data sources, productivity and jobs, and the inflation framework. Warsh stuck to his long-standing view that AI and productivity will be transformative for the U.S. economy. But it seemed as if any incorporation of that into policy would have to await dealing with the current inflation problem and hitting the 2% target.
All right, India's largest stock exchange, the National Stock Exchange, has filed the draft red herring prospectus with SEBI for its upcoming IPO. As per the document, the IPO comprises up to 14.89 crore equity shares, representing approximately 6% of NSE's paid-up capital. It is entirely an offer for sale. Sources have said that the size of the public issue is likely to be between 30,000 to 32,000 crore rupees, which could value the stock exchange at over 5 lakh crore rupees. SBI, Bank of Baroda and New India Insurance are among the key investors who will be selling their stake in the IPO. Tata Motors has announced a price hike of up to 2.5% across its commercial vehicle portfolio effective July 1st. The company says the increase is aimed at partially offsetting rising commodity prices and higher input costs, with the quantum varying across models and variants. This marks Tata Motors' second commercial vehicle price hike in FY27, following an increase of up to 1.5% announced in April. Shares of textile stocks gained in early trade as the India and UK Free Trade Agreement comes into effect from 15th of July. As part of this trade agreement, UK import duties on textile and garments, which were earlier between 8 to 12%, will now become zero. UK's textile imports to India stood at over $28 billion, while Indian textile exports into the UK stood at $1.5 billion. And speaking of the trade deal between India and the UK, sources have said that exporters of labour-intensive and agri-product sectors are expected to benefit from this deal. Abhimanyu Sharma joins us with more. Abhimanyu, please take us through the contours of this trade agreement.
Several benefits are expected to start accruing to Indian exporters in different segments, particularly for agri-products and in labour-intensive sectors, as the India-UK FTA is slated to come into effect from the 15th of July. It remains to be seen what are going to be the new targets which will be set as far as increase of trade between India and the United Kingdom is concerned. Also, the DCC, which has been finalised between both the sides, will mean that Indian workers who are employed by Indian companies and are working in the United Kingdom will be exempt from paying any social security contributions in the UK for a period of 5 years. Now, this move is going to save $500 million per year, as that amount would be paid into Indian social security contribution system itself, instead of the same amount being paid within the UK. Now, currently, over 9,000 Indian companies have employed 75,000 Indians who are working in the United Kingdom. The number is expected to grow in the next few years. So, several benefits are expected to accrue to even India's services sector. Also, speaking about government procurement, British companies have been allowed to participate in India's government procurement system. However, they will be classified as second-class suppliers subject to value addition norms. Now, as far as the UK steel measure is concerned, government sources have indicated that there will be no market loss, no loss in market access to Indian exporters, as over 85% of India's steel exports to the United Kingdom will fall outside the ambit of the steel measure. So, the government is expecting several benefits to accrue, not just to its merchandise exports, but also to India's services exports, and more importantly, to an increase in bilateral trade between India and the United Kingdom.
All right, thank you, Abhimanyu, for that. Prime Minister Narendra Modi is expected to meet French business leaders in Paris in the final leg of his two-nation tour, which included Slovakia. Prime Minister Modi will address Viva Tech 2026 alongside French President Emmanuel Macron. The two leaders are expected to pitch a shared vision for human-centric AI innovation. Right, time for a short break. Coming up, Apple will hike the prices of its products, says outgoing CEO Tim Cook to Wall Street Journal. He says a price hike is unavoidable due to semiconductor crunch and rising cost of storage. Details in a bit. Welcome back. The Indian Met Department has reiterated that widespread rainfall over Maharashtra is unlikely over the next few days. In a statement, the Weather Department said rainfall over most parts of Maharashtra is expected to remain isolated over the next 4 to 5 days. However, forecasting models indicate an increase in rainfall activity over the Konkan region after June 24th. And speaking of delayed monsoons, Mumbai's lake water levels have dipped below the 10% mark. This has raised concerns about drinking water supply in the city. The data by BMC showed that the 7 water supplying lakes were at a critically low level of 9.67% as of 6 a.m. today. Similarly, water levels in over 3,000 dams across Maharashtra dipped to 24%. The CEOs of Anthropic and Google DeepMind call for a US-led coalition to shape rules and standards for artificial intelligence. The pitch was made at a closed-door meeting with world leaders, including President Trump, at the G7 summit. CNBC's Charlotte Reed has more.
AI CEOs attending a lunch and meeting these G7 leaders yesterday. Of course, this came just a few days after Anthropic was banned from rolling out its latest model to non-US nationals. And of course, the Europeans being left in shock on that front. And we heard from President Macron on this, saying that there'd been some fruitful conversations between the G7 leaders on the best way to roll out some of these models, these frontier models of AI. But he warned as well that we should be careful to not on the non-cooperation among democracies on these questions of AI. And he warned against any nationalistic reactions to this.
What is their fear? That these models could be used by others to attack them or us. In response to this, a very strong decision was made by the administration a few days ago. So it's a good thing, an awareness that it can be dangerous. Until now, there was a prevailing discourse that said nothing should ever be regulated. All this is not dangerous. So it's a good thing there is awareness. It's a bad thing, the reaction is somewhat strictly nationalistic.
And as you were saying a little bit earlier, of course, the CEO of Anthropic himself talking about how we must resist the temptation to splinter amongst democracies in the sharing of these models. And Macron saying, you know, the US should be careful in doing this sort of bans, because then the other countries in the world won't be buying US AI if it can be plugged out and plugged off at any moment. So, you know, that was a conversation that was happening.
Right, tech giant Apple said it will hike the prices of its products. In an interview with Wall Street Journal, outgoing CEO Tim Cook said a price hike is unavoidable due to semiconductor crunch and rising cost of storage. Meanwhile, Meta has announced a series of new updates designed to strengthen protections for teens across all its platforms. Rachna Dhanrajani joins us now with more. Rachna, what are you picking up?
Well, Tim Cook has said the quiet part out loud. In an interview with the Wall Street Journal, Apple's outgoing chief executive admitted that price rises on Apple products are now, in his word, unavoidable. He said the company has been trying to shield its customers, but that the situation has become unsustainable now. That is a remarkable thing for Apple to say. The most valuable consumer brand on earth, famous for protecting its margins, is telling you plainly that your next iPhone is now going to cost more. And the reason is a single component, and that's memory. There's a worldwide shortage of the memory chips that go into phones, laptops. And this one is not like the pandemic, because this one is deliberate. The big three makers, Samsung, SK Hynix, and Micron, have shifted almost all their production to premium chips built for AI. The logic is brutal. Every chip that goes into an AI data center is the one that does not go into your phone or laptop, and the data centers are paying more for it. The numbers are pretty staggering. Memory prices have jumped around 90% in a single quarter. Apple has already raised MacBook prices by up to $400, and analysts say that a relief may not come until 2028. For India, one reason is Apple, but the reason that this one hits hardest of all is because memory can be a fifth of what a mid-range phone costs to build. And India is a mid-range phone market. So apart from Apple, the other phones are also expected to take this price hike. A shortage would start off this boom. So what begins in a data center in California ends up on the price tag of the world's most cost-conscious buyers, which is here in India. Now, away from pricing, the same industry is fighting a second battle this week, which is over children. On Monday, Britain announced it will ban under 16s from social media outright. Not restrict, ban. Instagram, Facebook, TikTok, and others must keep under 16s off or face heavy fines. That's what they said. However, this excludes WhatsApp. Prime Minister Keir Starmer called it a line in the sand. But Meta is now pushing back hard. It opposes the ban outright, arguing its own teen accounts already do the job needed. And on cue this week, Meta rolled out a fresh wave of teen safety features globally. Stricter default content settings modeled on movie ratings, AI that scans for underage accounts, alerts to parents. Much of it notably was tested in India first. So now you have two camps forming. Governments who want children banned and the burden placed on the platforms, and thus Meta betting it can self-regulate its way out of a ban. It will be interesting to watch which way Apple leans, because with iOS 27 coming later this year, Apple will also be introducing the age detection tools that could decide who is right here. So two stories, 1 week. One decides what your devices cost, the other who is even allowed to use these devices.
All right, thank you, Rachna, for that update. Shifting focus to the big newsmaker of the day, HCL Tech is doing it right by investing in Sarvam AI. That's the word coming in from Vishal Sikka, founder and CEO of VNI Systems, in an exclusive conversation with Shireen Bhan in San Francisco. Sikka, who also served as Infosys CEO in an earlier capacity, said that India is not far behind in the global AI race.
We've just seen an announcement coming in where HCL Tech has picked up 10.5% in Sarvam, which was India's frontier model company. Will bets like that now have to become stable stakes?
They will, yeah. I think I met Roshni back in February. I think what she has done is exactly right. I think it is. India is too important and India is too big to let go of any of these layers. I think it is a fallacy that we should not work on the foundation models. I think for two reasons. One, you have to have your own foundation models, and we are too big and too important to let go of that. But at the same time, we are still very early. As dramatic as the advances have been, we tend to think of this as, wow, we are so far behind, but we are not. It is still like maybe the second over of a T20 match, maybe the third over, But there are still remaining, 37 overs to go. And I think on power consumption, on hallucinations and understanding of the world, on improving access, there are so many advances that are still to happen in AI that it will be years of work. And I think that we should be working on those. And I see, and of course on the applications of it, what can we do with this continuously? I think all of this has to happen at the same time.
And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18. Thank you for watching.
Microsoft isn't just building AI tools, it's rebuilding the entire software stack for the AI era. At the core of this transformation is Core AI, a startup inside Microsoft led by Jay Parekh, focused on creating the next generation of agentic applications.
So how many times do you get mistaken for Satya?
I was waiting. I was like, I wonder if she's going to ask that question.
Of course I'm going to ask you. So how many times do you get mistaken for Satya?
From weekly iteration cycles to rethinking how humans and AI agents work together, the rules of software are being rewritten in real time. Core AI is building the end-to-end platform to run, manage, and secure agentic applications across enterprises.
Meeting Satya Nadella, joining Microsoft in 2024 to set up the AI startup, if I can call it that. You know, with a 50-year legacy behind the organization, how challenging has it been?
Yeah, so when I got here about 1.5 years ago, really what we want to do in the Core AI team is help not only the company, but also our customers kind of reimagine, rethink what it's going to take to build, to run, to manage all of these like new applications that are being invented, being created out of this technology that is AI, right? So, and that requires an entirely top to bottom kind of systems overhaul of what we've done to build software in the past, right? So in terms of like being able to build the applications with different tools, being able to support and build a new platform where these agents are running because they're interacting with the real world, they're thinking, they're planning with the models. You need different security guardrails around these things. So the entire technology stack needs to be kind of, we need to rethink the whole thing. And that's what we're focused on, is migrating or kind of transforming the way we create this new agentic software stack.
You know, I'll come to the agentic software stack in just a little bit, but let's talk about what's happening with the pace of change that AI has brought upon us. I mean, you know, within 3 months, the world is looking completely different. Now, from your point of view, as you plan out for the future, is this pace of change sometimes overwhelming? I mean, how do you deal with it?
Yeah, it is.
And
absolutely.
how do you plan for it?
Absolutely. Everything's going so fast, right? And sometimes for us, it is where you will come up with a plan or an idea one day and you wake up the next day and you have to scratch it out and try something else. So there's a few things here, which is one is it's really about the way we are working as an organization, because the technology in the world is going to keep changing quickly. So saying, hey, we're going to read more, we're going to like work more hours, we're going to invent more days of the week, like while those things they would be nice, they still probably won't keep up, right? So a lot of it is really making sure we are adapting faster and faster. And so that is a lot of how you kind of change the team dynamic. So one is making sure we do have time to learn, to observe, to be curious with our customers. 2 is making sure our iteration cycles are very fast, right? So we don't do, for example, you know, planning over a really long period of time, because you can go and make a plan for a roadmap for 6 months or a year, and you know within like a few weeks that it's going to be out of date.
Right.
So you want these short iteration cycles of what you're doing. You absolutely want a North Star, but you want to be iterating kind of week by week.
So is it literally week by week?
It's day by day for some teams, you know, at most kind of week by week. Yes.
You know, agentic future that everyone's talking about at this point in time, where are we in that journey? You know, are we close to that inflection point? I'll link that back to what Satya said in his post yesterday, that we have to reimagine the workforce and reimagine work with human capital and token capital coexisting. So what does that mean now as far as the way that organizations are structured? What do you prioritize today?
Yeah, so there's going to be a few things. One is just the overall system that is supporting this new way of working, right? So it's going to be the tools that we use as employees to do our job, whether you're in finance or you're a developer or whether you're a salesperson. There's where these applications and how those applications are going to run within your enterprise, as Satya mentioned in his post, where there is this end-to-end system, right, that has to come together that does allow you to manage kind of your human capital, your tokens, and then really we got to be focused on these different outcomes, right? And knowing what we can do with the power of the technology plus the power of our people. What types of new problems should we go tackle? What is the ROI on that, and what more value can we build? Either stuff that we may be able to do to save, because some organizations and some teams may get the biggest benefit there, but also what else can we tackle together? So it's really bringing those together and not as disparate concepts. But for me, what I focus on in all of the stuff that we do in our team, it's really how do we get to a new cycle of delivering that value, that quantifiable ROI to the customers.
You know, when you came up with the idea of the agent factory, and as you look at where we are today, what is the most exciting aspect of it, and what is it that we should be prepared for as we look at 6-12 months down the line?
Well, I think for us, it is continued change, right? So that is something that is both exciting. It's also hard as a product building organization of how to, one, make sure that you create these very valuable technologies that organizations can be successful with, that they can deliver that ROI, but also making sure that a platform that is adapting over time too, right? Because you can build the platform in a way and the tools in a way that they solve yesterday's problem, and then you're always kind of lagging the technology. So it's exciting to be able to build the flexibility in the platform and how to build the flexibility in the platform. I would also say that for us going forward is how you're going to manage your AI applications, right? And Satya talked a bit about this of how do you manage that. In some ways, the cost of the cost of this estate, and there's a lot of work that we're excited to do and that we'll do around. You have all of these different use cases. You can imagine in an enterprise, you may have thousands, tens of thousands of these AI agents and use cases. Some of them may need the premier tokens, like the premium tokens, I should say. And then over time, as these things are doing different types of workflows and tasks, you can optimize that with your data in your tenant, with your kind of compliance and guardrails. And then you can use kind of model choice, framework choice, tool choice to really make sure you have the right quality for the job, but you also have the right cost efficiency for the same job.
Which also means that you need to have an open ecosystem.
Yes.
You know, what have been the results in terms of efficiency and optimization that you've been able to drive through the work that you've done so far?
So this is an area of constant work for us, right? So for example, in GitHub Copilot, we have work and science work that goes into modes that developers, builders can use where they defer to an automatic picker. So based on your task, based on what you're trying to do, we locally can classify that and pick the best model, right? So it doesn't always have to be the premium model. It can say, hey, you're going to use this for this complex planning task or this complex refactoring task, but these other things, we can pick a cheaper, faster model for that, right? So we want to take some of that burden of having to pick off the end user and make that just part of the platform, part of the product. But that's also requiring you have model diversity, right? So both in GitHub and in our productivity M365 Copilot, as well as in Foundry, we offer that choice of the wide range of choice, right? Big models, small models, open, closed, but also multimodal, image, voice, video, etc. Those are all part of that builder creation process.
Were you surprised by what we've seen recently with companies saying we've blown through our budgets? Did that surprise you?
Yeah, I don't know.
Token maxing is now almost an insult.
So, as somebody who's been in tech for a long time and led, supported kind of technical product organizations, I think it's easy to, I think, get over-rotated on these activity metrics, right? And a long time ago, it would be like, you would have lines of code or these types of things. These are activity metrics, right? And if you're in sales, it's like, okay, how many leads do I have, right? And you could have lots of leads, but if none of them are qualified or none of them are real, that doesn't turn into, that's activity, right? It's not actually revenue. So it's not that it's a new thing to me. It's actually, again, businesses needing to separate kind of these activity metrics versus these output metrics that are important to the business, right? Or because the activity doesn't always translate into the outcomes. One of the things that we work on in our team here is equating, okay, if we're going to invest X dollars, some number of people and some amount of tokens, what is that, what is the output, the impact to the business that we get? And thinking about that time from an idea that somebody has to when it ends up in our customer's hand, what can we do to shrink that time, but also make that experience more valuable, more delightful, et cetera, right? So these are the metrics that actually move the needle for our customers, for our business, versus these activity metrics, right? It's easy, you can imagine, everybody should use a lot of tokens, right? We all see what happened in the news about that. But now we have to just be wiser, smarter, and kind of come together with the right controls, with the right visibility into how these token resources are being used.
Speaking of ROI, I think what has worried the street is that this massive capex spend being announced by each of these companies, including of course Microsoft, $190 billion in 2026, and is this real? Is this going to lead to an unraveling? I'm sure you get a lot of those questions as well, but how do we make sense of this, of the kind of spends, what it's eventually going to lead to, what it means as far as an ROI perspective is concerned?
Yeah, absolutely. So I think just staying focused on what value we're delivering to customers, right? When we see kind of the evolution of how people are using the products, right? So you could even go back a couple years ago and say, okay, Copilot, what was the typical use case? It was ask a question, get an answer back, right? Now today, people are launching very big, elaborate research projects like competitive research or product research or ways to kind of maybe think about a business model analysis where they're bringing in different artifacts, maybe a spreadsheet, presentation, outside research, other information that may be in your flow of work, right? Stuff that's in your Teams or email or other documents. That corpus and being able to think about it, reason about it, do more sophisticated kind of planning or outcomes, that is where I think the flow of work is just picking up the pace, right? So doing a question, getting an answer back, that was, a year or two ago.
Yeah.
But now if I can use this technology to do what would take, days, weeks, months with a lot of people, and I can do that in hours or minutes now, then I think there's tremendous demand. And that's what we see in how we're building our products and how we generate our ideas for our roadmap too, right? Which is to really be able to have the tools and the platform support these more complex and just higher ROI or just more valuable outcomes, right? And I think then the spend will flow from that. Now, we obviously continue to match, our spend is based on our demand, right?
Yeah.
So but the demand comes from working backwards and working closely with our customers.
Let's talk a little bit about India, because you've said previously that it's not just about the models. It is going to be about how those models are deployed at scale, how they're used, and of course that's where the talent aspect comes into play. How do you read the India story in an AI landscape?
Yeah, so India is it's a really exciting community in India, right? In GitHub, we have 27 million developers that are in the GitHub community in India. Just this year, we've seen more than 2 million new developers join the GitHub platform, right? So it is an incredibly fast growing and very, very vibrant community of developers. And it is one of the most activated, I would say, in terms of thinking about using AI and actually building ambitious product solutions to serve the world, right? So very exciting to see the range of what people are doing from the big multinational companies in terms of what they're doing to help even other companies around the world do transformation, as well as the startups and how small teams moving fast with this technology are building some of the most valuable startups in the India startup ecosystem of all time, right? So very, very fast moving. It's a community that's contributing a lot to open source in AI as well. And it is an area where we continue to invest. Obviously, Microsoft all up is investing in data centers and skilling. We have a big presence there for our own product development in the different offices as well.
The debate on whether India should do frontier models or not, we do now at least have one. And we've just announced a big deal where HCL Tech, one of the services companies, has decided to pick up a little over 10% stake in Sarvam. Do you believe that that is going to be crucial? It's going to be imperative as India builds out its AI ecosystem, this kind of ecosystem building?
I think it's important for where there is the talent and the dollars to continue to invest in as much of the stack as possible. Like there's an incredible amount of investment going into building out the infrastructure. There is obviously a vibrant startup community. The larger, I would say, the companies that are doing work for all the multinationals, like we work with, Wipro, Infosys, all of them in terms of what they're doing to drive that transformation. So it is very good, in my opinion, for investment to be happening at all of these layers of the stack, because so much is still yet to be invented and to be decided. And having having folks work on what may be specific needs of the Indian market, I think is great. It's a valuable part of the ecosystem.
Sovereign AI and a national strategy as far as AI is concerned, that's gotten a lot of play on account of what we're seeing happen on the geopolitical front. With the Trump administration telling Anthropic what it can or cannot do as far as Claude is concerned, does that become an emerging concern for the industry? And, and how do companies like yours look at it?
So the way I think about it is, again, we have defined and we are working on this end-to-end system in terms of how organizations all around the world can build these AI applications, how they can contextualize it or connect it with their data, right, their proprietary business data, how they can run this in this platform, how they can govern these applications for their compliance, their governance, their whatever sovereign constraints or requirements they may have, and then how we can make this whole thing continually improve over time, right? And so that really is the notion of the platform that we're trying to build. And so that over time, this should be able to meet whatever requirements, because it does, as a platform, allow you that flexibility. It does allow you that choice. So you can lean into one model, you can lean into lots of models. If something happens in the geopolitical landscape, you have choice, right? And that's where the extensibility, the flexibility of this end-to-end system, this end-to-end platform, I think is super important as we see the world continue to change.
The anxiety is also coming from is that what is this technology going to do to people in the workforce, in the workplace? How do you address that
and I'm sure that, a lot of young people who come to you, or startups who come to you, or even employees who talk to you about that. How do you address that question, the short-term, medium-term dislocation that is expected, but in the long term, what do you believe is likely?
Yeah, I think for us it's a journey. And I'd say that one, we have to think about the type of people that we need for different problems, different projects, right? And I think some ways you see maybe the specialization in an organization is starting to blur, right? You're starting to see folks in our legal team or our finance team using our developer tools to help them do their jobs. You're seeing people in maybe in product and engineering being able to think about maybe marketing strategies, because they're able to like brainstorm with these tools, right? And give it context in work and other documents they may have. So in some ways it's really neat because the functions are blurring, which means one, people are learning things that maybe they, in the past, because they were specialized inside of a function, they couldn't learn, right? Or it was hard for them to learn. Now you're able to kind of, I would say, expand your knowledge across the function and really think about, okay, I have this product, I have this feature. I'm not just going to be responsible for the code or for the spec or just for the design of it. I'm going to think about it with a couple of other colleagues, how we think about the idea, how we vet the idea, how we iterate on it, how we build it, how we get it into customers' hands, how we position it against the competitors. So we're not going to have all of these handoffs where we go slow. But now if I can have employees actually gain way more experience because they can understand these different functions that may have been separated from them, then I think that is a huge learning opportunity for the organization. And then I'd say the other thing for us is just continuing to learn and gain new skills about how to use these tools, right? And that I think is something we invest a ton in terms of how we drive those programs, those learning programs. And, frankly, the other thing that we see a lot of is there's a lot of work that is, I would say we classify it as toil. It's like repetitive, mundane work that isn't, and goes kind of in your face of when you're trying to create and deliver value to customers. There's a lot of work that we can automate away that then saves time. You get time back to then go work on those higher ROI or higher value or higher ambition problems.
Well, we look forward to hearing more from you, and we look forward to seeing you in India. Jay, thanks so much for joining us here on Voices from the Valley. Appreciate your time.
Thank you.
And wish you the very best of luck.
Thank you for having me.
Well, with that, it is time for us to take a quick break, but the headliners and newsmakers will continue. We're right back with you after this short break. Stay tuned.
Hello and welcome to News Center. I am Ashmit Kumar. Now, the much-awaited suspense around the Iran agreement has finally come to an end. The US President Donald Trump and Iranian President Masoud Pezeshkian digitally sealed an agreement to bring to an end the West Asia conflict, at least as of right now, temporary truce. Now, Trump acknowledged that the deal was not easy to achieve as he signed the 14-point agreement with Iran at France's historic Palace of Versailles. Commenting on the deal, Trump said that it helped avert what could have become a worldwide depression. He also said that the removal of all nuclear stockpiles from Iran would begin immediately, while claiming that Washington would not have to give Tehran anything in return. Meanwhile, initial talks between the United States and Iran are scheduled to take place in Switzerland on Friday, following the ceasefire agreement between Tehran and Washington. Now, the Swiss Foreign Ministry has said that as of right now, the plan remains for the US and Iran, along with mediators Pakistan and Qatar, to meet tomorrow in Switzerland to finalize this deal.
Technical discussions on the removal of all stockpiles of enriched materials will begin immediately. We're going to start that immediately. And unlike Barack Hussein Obama, who sent Iran pallets of cash and any relief they receive under this deal, they'll have to get based on merit. And it won't be from us. We don't have to give them anything.
Can you explain, though, what the difference is between giving Iran U.S. dollars and unfreezing U.S. dollars for
Well, the unfreezing is an easy one to answer. We have taken a lot of their money, and we have their money. We have taken their money. It's not our money. It's their money, and we froze it. At a certain point in time, I guess we're going to have to give it back. You know, if we didn't give it back, nobody would ever invest in the dollar again.
Well, a lot of moving parts as far as this temporary truce is concerned. To help us understand this further is with us Turkish professor Omer Anas, as well as joining us now is former Foreign Secretary, Mr. Shashank. And joining us in a bit will be Mr. Ajay Dua, the former Commerce Secretary as well. Gentlemen, thank you so much for joining us. Mr. Shashank, let me come to you first. Again, a difficult situation, but we finally see some light at the end of the tunnel, a truce between the two sides. But the question that many are asking is that, has Iran come out on top? They get control of Hormuz, no sanctions, they get to keep their nuclear material, nothing as far as their ballistic missile program is concerned, and cherry on top, $300 billion fund.
Well, I don't look at it that way. I look at it that G7, which was becoming more and more irrelevant, has again come back into prominence, and President Trump has been able to sign this rather than giving threats to Iran. Now he has finally agreed to sign this agreement, memorandum of understanding, and start the talks immediately for the final agreement. That's number one. Secondly, there is some certainty already that now there is no immediate prospect of a bombing campaign in Iran, and even perhaps as Lebanon is included, that there is a possibility that the countries involved in G7 and other major powers all over in the region and all over the world will help out in making sure that West Asia gets peace rather than more confrontation and war. So I would look at it, the whole thing from this angle, that it has brought about peace in the region. It has brought a deal which is acceptable to both sides. There will be many difficult issues to resolve, and we wish them all the best to resolve these issues, because after all, this is not the first agreement. We all talk about JCPOA, and so the Democrats also can't say. They can discuss whether their agreement was better or this is better, but I think this is more comprehensive, and this is a continuing process, which is much more important. And this will help Iran also get its frozen assets, get more reconstruction assistance. And once they move from the very principled approach to get rid of Israel from that continent, I'm sure that they will move towards a more prosperous area and to have a better relationship with the neighbors, whether Arabs or the others. So there will be hope for President Trump's Abraham Accords in the region. I think that may not be an immediate demand, but I think ultimately that would be also expected by President Trump, that he would be able to do something better before the midterm elections.
Right, so some stability in the region, perhaps, in light of this temporary truce that the two sides have reached for now. Let me come to you, Mr. Umair Anas. From the region, from the Persian Gulf, tell us, what do the optics of this 14-point MOU look like for a person on the ground?
Thank you very much for having me on your show. Let me say that this deal is being seen as a victory for Iran, because Iran has made this crisis so very complicated that the Israelis and Americans found very difficult to have a safe and honorable exit from this crisis. And Iran had effectively made this crisis as an international, in which every single country, the neighbors, the extended neighbors, the European countries, the big powers, the big economies of India and China, everyone was affected. So Iranians have used this kind of a strategy, and finally they have got the best of the result. So on the ground, I would say that there is a sense of fear as well, that this deal has also given Iran a stature and a superiority in the region that sometimes Saudis and Iran's rivals fear. So, of course, the Iran's gain have come sometime at the cost of the regional rivalry. So, the regional countries, especially Saudi Arabia and Egyptians, would be seeing this deal very carefully, and they would like to have a balance between Iran and regional powers. So, this is the sense which is going on. And Iranians have made it sure that this crisis is being resolved completely bilaterally between Iranians and the Americans. In this way, what I have been thinking for a long time, that there is a greater possibility, increasing possibility, that Americans and Iranians would be coming together, maybe to normalize their bilateral relations as well in coming months or years.
Well, that is the hope, Mr. Anas. But let me then ask you another follow-up question. An issue that will affect the region, that will affect the Gulf countries, control of Hormuz. Now, let's break down the 14-point MOU. One of the points very clearly says that within the 30-day period, the U.S. will withdraw its forces, as far as the blockade is concerned, will withdraw its forces from the Strait of Hormuz. Does that, in effect, give the control of Strait of Hormuz back into the hands of Tehran?
At the same time, these 40 points also include an interesting point, that Iranians would be working with Oman. So what does it mean? It means that there will be, they have been talking about the maintenance of the Hormuz. So in the name of maintenance, they would be taking minimum charges from many of the ships, and this will be distributed between Oman and Tehran. So even though it has not been said clearly in the document, but there will be some maintenance things, and it will be collaborated between Iran and Oman. So Iran is not alone in control of the Hormuz, but also one of the Gulf countries will be there. So in this way, Hormuz has been partially internationalized.
Sure. Mr. Dua, let me come to you again. Let me make a reference to what Mr. Anas was referring to, that as a part of this MOU itself, there is a mechanism that it seeks to develop between Oman and Iran for maintenance as well as administration of the Strait of Hormuz. So while Donald Trump says no charge right now, there is some kind of administrative mechanism that Oman and Iran are likely to deploy. Once that happens, should we take it as a given that there will be some fee levied? You can call it whatever, maybe not a toll, but maybe some kind of administrative fee that tankers will have to pay in the region?
Thank you, Ashwat, for having me in this discussion. I fear that could happen. Otherwise, under the international law, as we all know, the Strait of Hormuz has to be free beyond the waters of the 12 nautical miles of the border state, or the bordering landmass. But in this case, to say that two countries will jointly administer it, and knowing that how critical this waterway is, and the fact that it is only 40 miles wide, which means about 60 odd kilometers wide, does make me look like there could be a fee to which the United States has obliquely agreed. How desirable it is altogether a different matter. considering that the countries east of it, which includes India, are heavily dependent upon movement of their essentials as well as non-essentials through those waterways. And second is the fact, and again an apprehension, I hope it's not true, that other straits in the world, including closer home, the Malacca Strait, Malaysia as well as Singapore could start talking about it. There are then, why not the Suez Canal? Suez Canal, luckily, because it's a man-made lake, already is allowed to charge. Panama Canal is similarly on that ground allowed to charge. But we are beginning to commercialize such straits which can be constrictions, as they have proven recently.
That's an interesting perspective as to how this could serve as a precedent for some other critical waterways. We have two more questions I need to quickly address. Mr. Shashank, let me come to you. The nuclear question. Iran has conceded that it will not pursue nuclear weapons. It has not conceded that it will not be pursuing nuclear power. It still maintains control as far as the nuclear material is concerned. Is this likely to come as a setback for the US and a win as far as Iran is concerned in the longer term?
So long as Iran does not move away from NPT, I presume that they have retained full right to civil nuclear power. And I think that was accepted also in JCPOA. And Iran did go up to 60% enrichment, but that was only after the United States withdrew unilaterally from JCPOA in 2016. Therefore, Iran never had any interest, as far as I can make out, with a fatwa issued by the late Ayatollah Khamenei. And they could have changed it if the war had continued, conflict had continued for more time, then perhaps some hotheads in Iran might have decided to go for a nuclear weapon thing and follow the example of North Korea. But I think otherwise they would respect their late Ayatollah, and there is no question of any nuclear weapon program, and the Americans will make sure of that. G7 would make sure, and I hope that other countries in the region would also help in that process, because we want to move towards peace and economic growth in this area, not towards the kind of uncertainty and conflict which has been plaguing this area for a long time.
Sure. Let me take on one final issue with Umair Anas. Anas, I just want to read out the very first point of this MOU. It says, both the sides will undertake from now on not to initiate any war or any military operation against each other and to refrain from threat or use of force against each other, and ensuring territorial integrity and sovereignty of Lebanon. Now, this is the very first point. Israel, meanwhile, says we are not bound by this MOU. In fact, just hours back, we saw strikes being conducted in southern Lebanon. Is this something that could potentially lead to unraveling of whatever little truce that we have in the region?
Yeah, first of all, I would like to add one more point to Mr. Shashank's discussion, that Iran has effectively used its enriched uranium for its advantage, and that's why it has got that big deal in its favor. Had it not been having this much enriched uranium, perhaps the deal wouldn't have come at all. Secondly, your point that Lebanon has been included as an important point. It means that, in my understanding, there is a window, there is a possibility that Iranian and Israeli conflict may continue for some time from now, maybe a month or so. Limited strikes and limited escalation may continue. So Trump administration has left that impossibility, but officially Trump has included Lebanon and its territorial sovereignty as part of this deal. And Saudi Arabia especially has wanted this Lebanon clause to be there.
Right, that's an interesting way of looking at it. Lebanon is mentioned in the MOU. Israel and Hezbollah are not mentioned as far as that 14-point MOU is concerned. But I'd like to thank all of our panelists for joining us. I'll request, in fact, Mr. Shashank and Mr. Dua to stay on with us. We're heading into a very short break, but up next, we'll focus on the bilateral meeting that we witnessed only hours back between Prime Minister Modi as well as President Donald Trump. what that entails, what those comments mean. We'll focus on that on the other side. Welcome back to News Center. Now, another big development from the G7 summit was the bilateral meeting between India and the United States. Prime Minister Narendra Modi held talks with US President Donald Trump, their first formal bilateral meeting in 16 months. Now, ahead of these talks, the two leaders briefly met and were seen exchanging a handshake. The meeting comes just days ago after just an incident involving commercial shipping in the region that claimed the lives of 3 Indian sailors. New Delhi subsequently summoned the US envoy. During the discussions, Modi underscored the importance of freedom of navigation and raised concerns over the safety of seafarers following the deaths of 3 Indian nationals in the US strikes. Meanwhile, Prime Minister Modi praised Trump's leadership efforts. Trump returned the compliments, describing Modi as calm under pressure and a tough negotiator. Trump also said that if India were to face an attack in the future, the United States would stand by its side. On the India-US interim trade deal, Trump said that an agreement is very close and added that he looks forward to visiting India soon.
How close are you to a U.S.-India trade deal?
Very close. We've been there for a little while, and he's a very tough negotiator. He's one of the toughest, actually. So you look at this man. I'll give you a lesson. He's the most beautiful-looking man. He looks so nice. He's like an angel. But actually, he's as tough as he's a killer. I don't want to. He's a killer. He's as tough as they come. But he looks so good. So he gets you by surprise. But there's few people like this. People say he's such a nice man. I said no, he's very tough. He's a tough trader. And he loves the Indian people, but he also loves the USA. We had Howdy Modi in Houston, remember? And the stadium was full. Right, remember that?
He did Namaste Trump in
That was great. And we'll be going to India sometime in the future.
Do you expect India to play any role in West Asia? I'm Siddhant from
Say it.
Do you expect India to play any role in West Asia?
Yeah, I do. I think India plays a big role in everything. As long as he's the leader, India's going to play a big role.
And you said many times that India has a great friend in United States, in Washington, D.C., in White House, till the time you are president. But some of your decisions recently caused trouble, concern in India. How would you like to assure people of India?
Well, I said it. As long as I'm president, we have a great. They have a great friend in the White House.
Well, to discuss this further, we still have with us former Commerce Secretary, Mr. Ajay Dua, as well as former Foreign Secretary, Mr. Shashank. Gentlemen, thank you for staying on with us. Mr. Dua, let me ask you that again. From the visuals before us, we could tell that the two leaders seem to have a very close chemistry. They share a close bond. They've shared pleasantries publicly with each other when it comes to personal situations that they have in between them. Is it really yielding the kind of results that India would be hoping for? The last time that the US trade delegation was here, we were met with Section 301 tariffs. Now with this exchange of pleasantries, do you think it will yield any results for the upcoming Jameson Greer visit to India? He's, of course, coming next week.
I hope so, that the warmth which the two leaders expressed towards one another would now turn into something more substantive, something more productive for India. And the nearest where it would get tested is in signing of the first tranche of the US-India trade deal. Hopefully, Mr. Greer, who visits us on 23rd and 24th, meets his counterparts in India, including the Commerce Minister, Mr. Piyush Goyal, would not insist any longer on opening up of the Indian agriculture, Indian dairy, as well as the high-end almonds and walnuts, which they've been insisting upon for quite some time. Because for us, as I always been explained, agriculture is a way of life. It's a vocation for most people of India, and not just it's not commercial farming. And we have stood by that in every forum, including the two agreements recently signed by us, one with New Zealand and second with Australia a little earlier. So that is one I'm hoping. Second, I'm hoping that the visit to India by the trade delegation would be to say that 301 would not be applied if there is a trade pact signed just prior to it, maybe the first tranche, maybe whatever has been signed. Because otherwise, the United States administration under their Trade Act, Section 301, the 1974 Trade Act, has such wide powers that if they suspect anything is happening, so if they suspect that a country is creating excess capacity, structural, or is trying to dump goods on another, they can investigate and then start levying duties, maybe for limited time, but those are additional tariffs that could neutralize whatever would get agreed in the pact. So the two need to be separated if necessary, an assurance given at this stage saying we would not apply 301 on the items which are being covered in the first tranche. It's not saying that the US administration abdicates its power under that, but on whatever the two sides are bilaterally agreeing, rest assured, we would not impose 301. The rest still remains, and the US president would continue to have that decision to make use of that.
Well, India, of course, will be pushing hard for that. But in short, Mr. Dua, if I can ask you, do you expect a deal? We've had the US TR now visiting India. He'll be calling on the Indian Commerce Minister. Donald Trump has met Prime Minister Modi. Do you expect some kind of deal, maybe by the mid of July?
I think so. In fact, I've been saying that the last time President Trump imposed duties, it was on us, and he called it the Liberation Day. That was in April 2025. Now, July 4th, which is the American National Day, he would this time show the gesture and sign this agreement. With this, all that we are saying is it would have been legally drafted, etc. All those scannings would have taken place because the US, if you would recall, Just 2 weeks ago, the ambassador of US had said 99% of the agreement has been reached. Only on 1% certain items remain. I'm sure they met earlier for 3 days in India when the US trade delegation was here. He would have now the ministerial level 2 days visit here. That scrubbing being over, they can enter into an agreement, whether it's the 4th of July or sometimes during the
private sector has been batting hard for it. Mr. Dua, private sector has been saying that at least some kind of deal is better than no deal at all. Let me also get Mr. Shashank in on this. Mr. Shashank, I want to get you on a slightly different dynamic. Donald Trump there, as a part of that bilateral meeting, was heard saying that while we may not have a NATO-like pact with India, but if India is attacked, we will be there to support. United States will be there to support India. Was that a message for us? Or was that a message for someone else, like China?
I think the United States is really riled with the position taken by China. While they were happy that China was willing to let them have a deal with Iran and not support Iran to the extent that the war could continue. So that was welcomed by the Americans. But on the other hand, on Taiwan, the Chinese had made it very clear that there could be direct conflict in case America continued to support Taiwan. So therefore, America is now trying to, they have delayed giving weaponry to Taiwan and various other equipment. But they are now trying to see how they can change their attitude a little bit towards India. I'm not very sure whether in India there is a great amount of welcome to this kind of a generous offer. What we would like is to have better relations even with China, to have peace in the region, and to make sure that the Chinese do not flex their muscles over their smaller neighbors, and India would be willing to tie up relationships with the other neighbors of China to make sure that all of us put together kind of a peaceful atmosphere. And in case there is a China plus one technology transfer from the West or from any other country, then we should all be prepared to help in that, and India would be very much there. So I think we are not looking at this in the terms of NATO or Quad becoming NATO or AUKUS, but I think we have a completely different viewpoint. Americans in the last 1 year specifically thought that they could either treat Pakistan in a very mollycoddling and then making sure that Indians would also fall in line. That did not happen. And I think now they are thinking that India would perhaps become like a NATO power against the countries in the region. I think that will also not happen.
Right. Well, interesting dynamics at play here. We'll, of course, see it all play out. Next week, of course, we'll be keeping an eye. Jameson Greer, USTR, will be here to negotiate what is often referred to as the final 1% of the India-US trade deal. I'd like to thank both Mr. Dua as well as Mr. Shashank for joining us. But with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Vishal Sikka helped build SAP, one of the world's most powerful enterprise software companies. Sikka spent nearly a decade at SAP, rising to become its first non-German board member. In 2014, Infosys made a historic hire, bringing in Sikka as the first non-founder CEO to transform the company. His 3-year stint was marked by bold ambition and a bitter public fallout with the founders. Since then, Sikka has turned entrepreneur. In 2019, he founded BNI Systems, a Silicon Valley AI company built around one big idea, that enterprise leaders shouldn't need a data scientist to talk to their own data. The company has filed 30 patents, raised nearly $200 million, and counts TCS, Google Cloud, SAP, and KPMG among its partners.
Hello and welcome to Voices from the Valley. I'm Shireen Bhan, and joining me today is a guest that I had with me exactly 10 years ago here in the Valley. Palo Alto is where we were, and today we're in the Stanford backyard in Menlo Park. Vishal, it's great to see you back on the program. Thanks so much for joining us. So much has changed, not just in the last 10 years, but in the last few months. I mean, artificial intelligence is coming at us like a juggernaut. You know, from where you are sitting today, Vishal, what's the most transformative change that you are witnessing?
One is in the technology itself, the rate at which around here, you know, I was reading somewhere that 91% of the unicorns are in the Valley, in the startup unicorns. All the rest of the world, including the rest of the United States, is 9%. So the amount of work that is going on in the technology itself is just astounding. And every day you see something new. But what I am even more excited about is what can you do with it? And the great problems that we can solve with it. And somehow it is the nature of our minds that we tend to think about, when we see a new technology, we tend to think about the problems that we already know about, you know, the past. But what is really exciting is the things that we will do with this. And that is what I am really psyched about. To give you an example, drug discovery is on the minds of a lot of people. I serve on the board of GSK. And when AlphaFold discovered 200 million proteins, that really boosted the whole drug discovery process. Of course, there's a lot more to drug discovery than protein finding, but that protein folding, the 200 million proteins that AlphaFold found would have taken humanity more than 400 million years. So the thing is, what is it that we can today think that would take decades to do that you can now do in days or hours or even minutes? And I think those problems are just so exciting to go after.
So what is exciting you at this point in time specifically? What are the kinds of problems that you intend to go after?
Of course, you know, problems that humanity faces that are of a really, really complex nature, problems that businesses face that are of a really complex nature that are, so drug discovery is one example of those, but every company, you know, that works in different industries has problems of that magnitude, of that scale. And I want to go after those. And so I'm here.
You just set up a new office to do exactly that.
To do exactly that. Yeah, this is what I'm doing here. And you will be the first one that I'll talk to about this. But really, my team is inside there. We are all very fired up about it. And I will soon be ready to talk about this.
Okay, we look forward to that. But, you know, since we're talking about things that are firing up imagination, but also firing up conversation. You know, Satya Nadella wrote a post yesterday, which has evoked a fair degree of response. I think the reason why it's evoked so much response is because it captures how people are feeling at this point in time, especially those who are not on the AI bus. Have you missed the AI bus? If you have, what happens to you next? The concentration of power, have we become a tech oligarchy almost? How do you respond to some of that, Vishal?
The asymmetry problem is real, and you and I have talked about this over the years. It is getting worse. I've been talking about this for a long time, more than a decade, and it is getting much worse. So just to put some numbers in perspective, out of 8 billion people in the world, only about 2 million could build an AI application. That's it. And this is not people who are building the models. These are people who would apply them to do something, to find if this roof is going to fall, or when a machine is going to fail, or if something is fraud, or to approve a loan. Those kinds of problems, that's 2 million. Out of those, the ones who could operate a machine learning model, an AI model, is about 250,000.
Wow.
The number of people who can build a frontier model is about 5,000.
5,000, that's it?
Yeah. In the whole world, the number of people who can build a foundation model, so like one of the 100 or so big models that are on the various leaderboards, is about 5,000 people building them. And out of those, the ones working in the frontier labs are about 1,000, 1,100. So this is an unbelievably asymmetric situation. So you have essentially a bulk of the world who is completely blind to this, completely oblivious to this. And yet here in the valley, we get excited on a daily basis that, oh my God, this dropped and that dropped and what happened here. And so I think that fixing that asymmetry is a very, very important problem. That is something also for India, that is something I have spoken to folks in India about a lot. That needs to be fixed.
From your vantage point, as a former insider, what happens now to the services model? What happens now to SaaS companies? And I think that is the question that's being asked. And I don't know if we have any definitive answers on the way forward. As you look at it, is it all gloom and doom? Are we already prematurely writing obituaries? Or do you believe that the path forward could see these companies make the pivot, make the transition into an AI world?
No, that's a very important question. The answer is multifold. It is not a simple, straightforward answer. Does AI make it possible to do the work that we have done before dramatically faster and easier and cheaper? Yes, it does. I have examples where not just things happen 30% faster, but like work that would have been done by teams of people over years can be now done.
You were giving me an example where you were sitting outside on a bench quite literally and creating something that would have otherwise taken you years.
It was a very shocking personal example because that was years of my own life that I was able to recreate basically within less than an hour. And I just could not get over it for many days, that what the hell just happened. Because I built a system that I had a large organization that painfully built over years, that more or less a kind of a low fidelity version of it I was able to build in less than 1 hour.
In less than 1 hour, what had taken you several years to build previously?
An elite team that had taken 2.5 years of over time 500 people. Initially 100, going up to 450, 500 people, 2.5 years of our lives. Painful 2.5 years of working 15-hour days that I could basically redo in 1 hour.
By yourself?
By myself, sitting by myself, and it worked, and I showed it to people and they could not believe it. And so what does that mean, right? And I think we can look at it in these two ways, back to your question. All the work that we do today, that armies of people do today, could be done in minutes by people who understand what they are doing. But at the same time, there are completely new kinds of things that this technology can enable. And you could get on that bandwagon and say, you know what, I'm going to solve the most important problems for you. And so whether the companies survive or not, or thrive or not, is more a function of, can we transform ourselves in time to help everybody who needs help with these kinds of things? Or will the wave come and destroy our prior way of working? And I think both of these are very, very likely possibilities. The wave is here. It is not like...
Yeah, it's not, the wave has hit us.
The wave has hit us. It's not Vishal Sikka saying, oh, look, the wave is coming. This wave is, the water is in our living room. The wave is here. And so it will wipe out the prior way of doing things. There will be single people, small teams of people who will do these things. And therefore, how quickly can we move to the new kinds of things that are possible to do where the skills are not there yet? And we just talked about the vast gap in skills. So I think that to me is the big divide, is how quickly do you go over to that other side? And if you see a sense of urgency. I was talking to a friend of mine about and said the whole company now is the streaming company. At the time, it was a radical decision that the entire operation, they said, is the past. So something like this, I think, has to be done probably. But I'm very glad I'm not doing it.
That you're not there to have to do it, right?
Yes, exactly.
I was just having a conversation with somebody that Dheeraj Pandey.
Dheeraj,
And he said, I wouldn't be surprised, or he believes that it would be the right thing for some of these companies to do is to in fact go private. Because he said, as a public company, you just will not be able to make this kind of a transition.
Yeah, you would think that now people would be much more open to it because this is here. There are thousands of examples, and what the technology is capable of is already known. But I think Dheeraj is right. Being private would afford a lot more independence and freedom to do the radical changes that would be necessary.
But speaking of radical steps and radical actions, we've just seen an announcement coming in where HCL Tech has picked up 10.5% in Sarvam, which was India's frontier model company. Will bets like that now have to become stable stakes?
They will, yeah. I think I met Roshni back in February. I think what she has done is exactly right. I think it is. India is too important and India is too big to let go of any of these layers. I think it is a fallacy that we should not work on the foundation models. I think for two reasons. One, you have to have your own foundation models, and we are too big and too important to let go of that. But at the same time, we are still very early. As dramatic as the advances have been, we tend to think of this as, wow, we are so far behind, but we are not. It is still like maybe the second over of a T20 match, maybe the third over, But there are still remaining, 37 overs still to go. And I think on power consumption, on hallucinations and understanding of the world, on improving access, there are so many advances that are still to happen in AI that it will be years of work, and I think that we should be working on those. And I see, and of course on the applications of it, what can we do with this continuously? I think all of this has to happen at the same time.
One of the other developments, of course, has been the US government basically coming and saying that pull the plug on Claude Fable and Mythos and don't give access to anybody else but US citizens. Now, and to your point, that you believe that it is going to be a sovereign priority, a national imperative to actually have your own foundation model, because this is the world that we're going to live in. And increasingly so.
And we are so important as a country, not only for our own citizens, but for the world, that we have to have control of our destiny on this front. And I also think that we have to be prepared that any of these kinds of decisions, any of these lightning bolts can drop anytime. And so having independence there, having our own Atmanirbharta would be absolutely critical. So that's why it's a good thing that Sarvam is doing what they are doing. We need a lot more of that. A lot more of that.
Well, how do we get a lot more of that is the question. The criticism is that, look, the private sector hasn't done the heavy lifting when it comes to R&D, when it comes to R&D spends. The government has done the heavy lifting as much as is possible at this point in time. We've just got the first tranche of the research RDI fund going into more space tech ventures. But what more can and should be done for us to be able to play, successfully this long test match if we're only in the first few innings?
I think that in India we are fortunate that we have a government which is not only aware of the state of AI and the issues with AI, but is frankly ahead of that. When you listen to the Prime Minister, when you listen to Mr. Vaishnav, when you listen to Abhishek used to do it, now it is Rajiv, the leaders in India know the stakes and what needs to be done. So beyond what the government is doing, one of the key things that is missing is that, there was a great ice hockey player, Wayne Gretzky. He used to say that I skate to where the puck is going to be, not where it has been. And so you have to have people who understand where these trends are headed and put 2, 3, 4 year out bets.
The question though is, you're speaking about taking that moonshot. Now, what is it going to cost to be able to take that moonshot? Who's going to foot the bill of that moonshot?
That is an extremely important question. I believe, and I come from, this is my 5th decade in AI. I come from a world where I believe that much better approaches are still in front of us. I think this idea that every time you write a prompt and these thousands of GPUs burn and then you make a minor change to the prompt and then thousands of GPUs burn, I think this is complete nonsense. There are going to be much better AI approaches that are going to come in our future. So we have to build those. So I think we have to be pragmatic about it.
Is there a sense of urgency now? I mean, this trip, all I've heard from everybody is, the token maxing is over and efficiency is in. Is there a sense of urgency on that?
Absolutely. This is the most important thing, and the Chinese models already do this. If you look at DeepSeek and Minimax and all these models that are coming out of China, they already have their #1 priority as their efficiency of model execution. I think you will see more and more of that. NVIDIA itself is working on that, on their own models, but also on, of course, that's unbelievable engineering that they do. And you were at AMD earlier today. So all these people are working on it, but the model technology itself has to go through improvements. And I hope that we can sponsor some of those.
You're talking about OpenAI and you're talking about Anthropic. You've known OpenAI for as long as the company has existed, Vishal. But as both these companies go public, what do you believe, forget the market and what it eventually gets valued at and so on and so forth, what could both these companies going public actually mean for the AI ecosystem? Will it put in more discipline and rigor into how things are approaching this and this whole business of burning through stuff, or do you think that what could the impact be?
I think it will be very, very positive. My instinct is that it will be very positive. It will be, of course, liquidity moment for the employees who have built these companies. I think it will also be the scrutiny that public markets bring, the responsibility that public markets bring will be a very good thing. And I think that exit will propel dozens of other companies, hundreds of other companies into going after that. So the valley, you know, we are on Sand Hill Road. The valley has always been like that. I have been here now, this is my 36th year in the valley. And it's always been Sand Hill Road. There is a mindset here that people innovate, people build new things. There is a sense of purpose around that. Of course, the funding and the financial success and all of that. I think that these companies going public, especially Anthropic and OpenAI going public, will have a very positive impact. Not only on the valley, but on the world at large. It will also force a lot of rigor in the way they operate. I hope that they can continue to be bold and continue to invest in the future, which of course Silicon Valley companies do, even when they go public, you know, like Google. Google is actually raising money.
Yes, as is NVIDIA, by the way. Who would have thought?
Who would have thought, you know? So I think that it's going public, getting the regular public involved in these companies is going to be very positive.
What does that signal to you? The fact that Google is raising money, the fact that NVIDIA is doing bonds to raise money, what does that tell you?
I think these are companies that understand the future, the power of the future. They don't live in the past. They don't look backwards. They look forward. I think this is what, more than anything else, what AI is teaching us to do, is to free ourselves from the known. If you put yourself in the mindset that, let us say we get to models which are 100% accurate. We are not there today, but let's say in the near future we get to models where at any moment in time they have a perfect capture of everything that happened before. What do we do then? In that situation, what happens? Let's say all of humanity's knowledge is embodied in these models, maybe with a 1 minute delay. And now you're able to ask this model anything. I think in that situation, I've thought about it. One of my friends in India asked me about this. You know, when I came to this country, I was the age of a little bit older than your nephew. I was 19. And my uncle gave me a book by Krishnamurti, the Indian philosopher. The book was called Freedom from the Known. Because I had walked in from Western India to like Syracuse, New York.
Yeah,
where it was
Baroda to Syracuse.
Baroda to Syracuse. It was minus 22 Celsius on the day that I arrived there. Minus 22. And I was wearing the North Star shoes, and my brother came to pick me up, and he was like, have you lost your mind? You will get a frostbite, they'll have to cut your leg off. So I had to go through this exercise of freeing myself from what was known. And I think, and Krishnamurti's point was that when we free ourselves from the known, we liberate ourselves. Our mind can think freely, we can create new things, we can create completely new worlds. So I think that in the time ahead, that's what I tell my own sons, that's what I tell the youngsters, that you will soon approach a point where AI will be so empowering that you will have no limits to what you can imagine and what you can build. And so what would you build in this kind of a situation? I think that these companies understand the power of that, that there is a great future in front. And they are not beholden to the past. They are willing to sacrifice the past in order to get there, to attack the future. I think if we had 1 billion people, you know, the Prime Minister thinks this way, if we had 1 billion people who are able to be entrepreneurial, this would be an amazing thing. So that's what I am working on. By the way, that's what Vandana is working on. Her company is working on this. And I think that is what the future is calling for.
You know, speaking of the future, Vishal, human capital and token capital and how the two will coexist, I think again is the big question. What does it mean in terms of the workforce? What is it also going to mean in terms of pricing, how you do contracts and so on and so forth? You know, Chandra at the TCS AGM said that for every employee you'll have an agent. So, you know, if you have 3 million people in the workforce across the IT, or 5 million or whatever the case, maybe you'll have as many agents as well. Do you see that as the future?
100%. Actually more. You will have hundreds of agents. My nephew, he lives here in San Francisco, he's building a world model. He has an agent that he uses to run his entire household and his work. But it is not one agent. There are like something like 150 agents that he has to manage his music, to the lighting in his house, the locks, the security, his car, and his work, his Slack channels, what the people are doing, have they checked in their code in GitHub. dozens of these agents that run constantly doing this thing. It is shocking. So it's not only one agent per employee, we'll have hundreds of agents per employees. And I think that is a very good thing. I'll give you one example. Over the weekend, I counted how many photos I have in my phone.
Physically?
Yeah, I mean, there is a way that you can count that. And I am not an avid photographer. I am not a heavy-duty photo capturer. I, on average, do 6,000 pictures in a year on my iPhone. And I was calculating in the days before the iPhone, how many pictures did we do? And probably in my case, it would have been 250 or so in a year. And of those, maybe 20 were taken by me. So what does that tell you? I think that we tend to not take into account the dramatic possibilities that these new mediums offer to us. And this is what is going to happen. We are, instead of 300 times as many pictures, you will have 300 times as much work happening and we won't even know it. We will get used to it. I just hope that India thrives in that transition, that we manage this transition, and that people manage themselves through this transition. But if we do, there is no doubt that this will be a great enabler. And token capital is a good way to think about it. That's a present way to think about it, the way we have AI today. It may not be, tomorrow's models may not be like these token generators, there might be other things. But today, I think for sure, this is a very good way to think about. Like you have people who are generating certain amount of work, and then you have these agents that are generating a certain amount of work, and you have to find a way to maximize both.
Well, speaking of exciting possibilities and exciting opportunities, with what you're building here, and this is in a sense a fresh startup innings for you. What can we expect? I mean, what are the kinds of things that you intend to chase after?
My dream is to help businesses thrive. This is a huge wave that we have created, that AI is a huge wave. I think businesses have to learn to ride this wave. I want to help them ride this wave. And in the process, I want to create a culture where large numbers of people can thrive. And if I manage to do this in the years to come, I'll be very happy.
Best of luck with that, Vishal, and may you thrive, and may all those who you hope will thrive along with you find their success as well. But always a pleasure. Thanks so much for joining us here on Voices from the Valley. It's great to have you back on the program. That's it then on this edition of Voices from the Valley. Keep your comments and your feedback coming in. We'll be back with more newsmakers and headliners. Till next time, thanks very much for watching.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening.
This was not easy, I can tell you.
US President Donald Trump signs a 14-point agreement with Iran at the Palace of Versailles in France. Iran's president signs the accord separately in Tehran. The Strait of Hormuz is set to reopen. Iran promises status quo on nuclear weapons. US will lift all sanctions. Both sides have 60 days to work towards a comprehensive peace deal. Brokerages expect oil prices to ease, but the pace of decline will not be rapid. Goldman Sachs, Morgan Stanley and Citi see Brent between $70 to $80 by the end of this year. JP Morgan is an outlier as it pegs Brent near $60 by the end of 2026. US Federal Reserve holds rates steady in the first policy under Kevin Warsh as the new chairman. Warsh refuses to submit a rate forecast of his own, even as a majority of other Fed members expect a rate hike later this year. Warsh sets up 5 new task forces to overhaul the Fed communication, balance sheet and data sources. The ball gets rolling for what could be India's largest IPO. NSE files draft papers, looks to sell 6% equity, raise up to 32,000 crore at a valuation of over 5 lakh crore rupees. SBI and Canadian Pension Fund pegged to be among the largest sellers. Shares of textile exporters rally as India and UK announced the free trade deal will be effective from the 15th of July. Government sources say Indian workers in the UK will be exempted from social security contribution for 5 years. The CEOs of Anthropic and Google DeepMind call for a US-led coalition to shape rules and standards for artificial intelligence. CNBC reports the pitch was made at a closed-door meeting with world leaders, including President Trump at the G7 summit. Apple will hike the prices of its products, says outgoing CEO Tim Cook to Wall Street Journal. Cook says a price hike is unavoidable due to semiconductor crunch and rising cost of storage. And Portugal disappoints as DR Congo stuns in its first World Cup in 52 years, holds the Cristiano Ronaldo-led side to a draw and secures its first ever World Cup point. England begins its campaign with a comprehensive win against Croatia. All right, to the top story this evening, 111 days after the US and Israel attacked Iran and dragged the entire Gulf region into a conflict and choking global oil supply, we have the framework for a peace deal. Trump and his Iranian counterpart have signed a memorandum of understanding to end the conflict, but the agreement comes with major caveats, including unresolved issues surrounding Tehran's nuclear program. US President Donald Trump said, and I quote, "This was not easy," as he signed the 14-point agreement at the Palace of Versailles in France. Iran's President Pezeshkian also signed the agreement separately in Tehran. Pakistan's Prime Minister Shehbaz Sharif, who mediated the negotiations, also signed the agreement, which is called the Islamabad Memorandum of Understanding. Addressing G7 leaders, President Trump claimed Washington will not have to give anything to Tehran and took a swipe at his former president, Barack Obama. President Trump withdrew the US from an earlier peace deal with Iran, which was signed during Obama's presidency.
Technical discussions on the removal of all stockpiles of enriched materials will begin immediately. We're going to start that immediately. And unlike Barack Hussein Obama, who sent Iran pallets of cash and any relief they receive under this deal, they'll have to get based on merit. And it won't be from us. We don't have to give them anything.
Well, Trump's claim that US will not have to pay Iran anything contradicts the text of the agreement, which includes a $300 billion fund for Tehran. Here's a closer look at the 14-point agreement. The document signed by both leaders is a 60-day truce agreement and not a comprehensive peace deal. Officials from the US and Iran will now begin negotiations for a comprehensive peace deal tomorrow in Switzerland. The 60-day agreement is good news for thousands of seafarers stuck in the Strait of Hormuz. US has agreed to end the naval blockade in the waterway within 30 days. The memorandum also says that Iran will not charge transit fees for 60 days. However, both Iran and Oman will decide the future administration of the strait in discussion with other Gulf countries. Remember, just a month ago, Iran had constituted a body to regulate maritime transit. Iran has also agreed to maintain the current status quo of its nuclear program. Tehran has said that it would not procure or develop nukes and will commit to down-blending of enriched material. Under the agreement, US will terminate all types of sanctions imposed against Iran, including UNSC resolutions. The US Treasury Department is also set to issue waivers for export of Iranian oil until termination of sanctions. The US will also develop a plan with at least $300 billion for the reconstruction and economic development of Iran. This will be undertaken along with Washington's regional partners, and the framework will be developed in 60 days. Iranian officials had initially demanded around $400 billion in reparations and war damages. There's also a clause in the document that allows negotiation timeline to be extended beyond 60 days with mutual consent. But Trump has said that if the deal is not done in 60 days, they will, and I quote, get back to bombing, end of quote. Listen in to President Trump defending releasing Iran's frozen assets.
Can you explain, though, what the difference is between giving Iran U.S. dollars and unfreezing U.S. dollars for
Well,
you?
the unfreezing is an easy one to answer. We have taken a lot of their money, and we have their money. We have taken their money. It's not our money. It's their money, and we froze it. At a certain point in time, I guess we're going to have to give it back. You know, if we didn't give it back, nobody would ever invest in the dollar again.
Well, brokerages are largely in sync on oil price glide path after the US-Iran agreement. Goldman Sachs, Morgan Stanley and Citi see Brent crude easing into the $70 to $80 range in the final quarter of this year. As supply risks fade, Manisha Gupta has more. Manisha.
Well, yes, the crude oil prices have declined quite sharply from $120 a barrel off a high during the West Asia conflict to almost $70 to $80 a barrel right now, which was the price on the 1st of March as well. So it has been a very volatile journey, but the prices are off by nearly 15% in a matter of last 5 days and down nearly 27% in the last 1 month as well. This is as there is a peace deal now, an interim one between US and Iran, and the expectations that you could be looking at Strait of Hormuz opening, almost 100 ships which are in and around Strait of Hormuz and are carrying anywhere between 20 million barrels of crude would perhaps be available to the global markets. This has brought the prices down, and this also has brought the forecast of crude from the Wall Street banks and brokerages also on the lower side. To name a few, you have Goldman Sachs, which has cut its fourth quarter 2026 Brent forecast now to 80. Earlier it was at 90. For 2027, they believe that the crude prices could average $75 a barrel. And then you have Morgan Stanley talking about $80 a barrel of an average in this year. The most bearish of reports is coming in from Citi. They're talking about $75 a barrel of an average in this quarter, $70 in next quarter, and by the time it's 2027, they're anticipating $65 a barrel of an average price there. JP Morgan, more bearish, $60 an average for the price is what they're anticipating for this year now. And then you have Barclays on the higher side of the range, anticipating $100 in this year and $80 a barrel of an average in the next year as well. So clearly, all these banks and brokerages, which were talking about 90s and 100s and beyond of averages, have clearly cut it to size, and we're looking at lower price moves now.
All right, thank you, Manisha, for that. On the other hand, brokerage firm Citi has raised its GDP growth forecast for India to 6.9% for FY27. The firm has also revised its balance of payment surplus forecast to $45 billion from $5 billion earlier. Citi also sees India's average headline inflation for the fiscal year at 4.7% versus 4.9% from a year ago. All right, on to the day's market action. Sensex and Nifty closed in the green for the fifth straight session. Nifty closed above 24,150 mark with Max Health, Indigo and Trent leading the pack. Nifty IT snapped its 3-day gaining streak, emerging as the top losing sectoral index. Nifty Bank outperformed, and 11 out of 14 constituents closed higher. US Federal Reserve has held rates steady in the first policy decision under Kevin Warsh as the new chairman. Warsh refused to submit a rate forecast of his own, even as a majority of other Fed members expect a rate hike later this year. On inflation, he said that the policy would aim for price stability. Further, the new Fed chair also set up 5 new task forces to overhaul the Fed communication, balance sheet and data sources. CNBC's Steve Leisman is here with more.
Hawkish message on rates, reflecting that he inherited an inflation problem and saying the committee is strongly committed to dealing with that inflation problem.
We recognize that inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years. I am pleased to report that members of the FOMC are unambiguous and unanimous. This committee will deliver price stability.
Warsh clearly has embraced, at least for now, the existing hawkish bent of the committee, where 9 officials now project at least 1 rate hike this year and 6 see 2 or more. Only 8 expect to hold rates steady, and only 1 cut is projected. And markets have taken Warsh and the Fed seriously. The 2-year sold off hard, and the first hike is now seen with a 66% probability to happen in September. It had been December. A second hike now has a 55% probability for January, and there wasn't one priced in before the meeting. Warsh also pledged a rethink of how the Fed does business, appointing task forces to review Fed communications, balance sheet policy, data sources, productivity and jobs, and the inflation framework. Warsh stuck to his long-standing view that AI and productivity will be transformative for the U.S. economy. But it seemed as if any incorporation of that into policy would have to await dealing with the current inflation problem and hitting the 2% target.
Right, India's largest stock exchange, the National Stock Exchange, has filed the draft red herring prospectus with SEBI for its upcoming IPO. As per the document, the IPO comprises up to 14.89 crore equity shares, representing approximately 6% of NSE's paid-up capital. It is entirely an offer for sale. Sources have said that the size of the public issue is likely to be between 30,000 to 32,000 crore rupees, which could value the stock exchange at over 5 lakh crore rupees. SBI, Bank of Baroda and New India Insurance are among the key investors who will be selling their stake in the IPO. Tata Motors has announced a price hike of up to 2.5% across its commercial vehicle portfolio effective July 1st. The company says the increase is aimed at partially offsetting rising commodity prices and higher input costs, with the quantum varying across models and variants. This marks Tata Motors' second commercial vehicle price hike in FY27, following an increase of up to 1.5% announced in April. Shares of textile stocks gained in early trade as the India and UK free trade agreement comes into effect from 15th of July. As part of this trade agreement, UK import duties on textile and garments, which were earlier between 8 to 12%, will now become zero. UK's textile imports to India stood at over $28 billion, while Indian textile exports into the UK stood at $1.5 billion. And speaking of the trade deal between India and the UK, sources have said that exporters of labour-intensive and agri-product sectors are expected to benefit from this deal. Abhimanyu Sharma joins us with more. Abhimanyu, please take us through the contours of this trade agreement.
Several benefits are expected to start accruing to Indian exporters in different segments, particularly for agri-products and in labour-intensive sectors, as the India-UK FTA is slated to come into effect from the 15th of July. It remains to be seen what are going to be the new targets which will be set as far as increase of trade between India and the United Kingdom is concerned. Also, the DCC, which has been finalised between both the sides, will mean that Indian workers who are employed by Indian companies and are working in the United Kingdom will be exempt from paying any social security contributions in the UK for a period of 5 years. Now, this move is going to save $500 million per year, as that amount would be paid into Indian social security contribution system itself, instead of the same amount being paid within the UK. Now, currently, over 9,000 Indian companies have employed 75,000 Indians who are working in the United Kingdom. The number is expected to grow in the next few years, so several benefits are expected to accrue to even India's services sector. Also, speaking about government procurement, British companies have been allowed to participate in India's government procurement system. However, they will be classified as second-class suppliers subject to value addition norms. Now, as far as the UK steel measure is concerned, government sources have indicated that there will be no market loss, no loss in market access to Indian exporters, as over 85% of India's steel exports to the United Kingdom will fall outside the ambit of the steel measure. So the government is expecting several benefits to accrue, not just to its merchandise exports, but also to India's services exports, and more importantly, to an increase in bilateral trade between India and the United Kingdom.
All right, thank you, Abhimanyu, for that. Prime Minister Narendra Modi is expected to meet French business leaders in Paris in the final leg of his two-nation tour, which included Slovakia. Prime Minister Modi will address Viva Tech 2026 alongside French President Emmanuel Macron. The two leaders are expected to pitch a shared vision for human-centric AI innovation. Right, time for a short break. Coming up, Apple will hike the prices of its products, says outgoing CEO Tim Cook to Wall Street Journal. He says a price hike is unavoidable due to semiconductor crunch and rising cost of storage. Details in a bit. Welcome back. The Indian Met Department has reiterated that widespread rainfall over Maharashtra is unlikely over the next few days. In a statement, the Weather Department said rainfall over most parts of Maharashtra is expected to remain isolated over the next 4 to 5 days. However, forecasting models indicate an increase in rainfall activity over the Konkan region after June 24th. And speaking of delayed monsoons, Mumbai's lake water levels have dipped below the 10% mark. This has raised concerns about drinking water supply in the city. The data by BMC showed that the 7 water supplying lakes were at a critically low level of 9.67% as of 6 a.m. today. Similarly, water levels in over 3,000 dams across Maharashtra dipped to 24%. The CEOs of Anthropic and Google DeepMind called for a US-led coalition to shape rules and standards for artificial intelligence. The pitch was made at a closed-door meeting with world leaders, including President Trump, at the G7 summit. CNBC's Charlotte Reed has more.
AI CEOs attending a lunch and meeting with G7 leaders yesterday. Of course, this came just a few days after Anthropic was banned from rolling out its latest model to non-US nationals. And of course, the Europeans being left in shock on that front. And we heard from President Macron on this, saying that there'd been some fruitful conversations between the G7 leaders on the best way to roll out some of these models, these frontier models of AI. But he warned as well that we should be careful to not on the non-cooperation among democracies on these questions of AI. He warned against any nationalistic reactions to this.
What is their fear? That these models could be used by others to attack them or us. In response to this, a very strong decision was made by the administration a few days ago. So it's a good thing, an awareness that it can be dangerous. Until now, there was a prevailing discourse that said nothing should ever be regulated. All this is not dangerous. So it's a good thing there is awareness. It's a bad thing, the reaction is somewhat strictly nationalistic.
And as you were saying a little bit earlier, of course, the CEO of Anthropic himself talking about how we must resist the temptation to splinter amongst democracies in the sharing of these models. And Macron saying, you know, the US should be careful in doing this sort of bans because then the other countries in the world won't be buying US AI if it can be plugged out and plugged off at any moment. So, you know, that was a conversation that was happening.
Right, tech giant Apple said it will hike the prices of its products. In an interview with Wall Street Journal, outgoing CEO Tim Cook said a price hike is unavoidable due to semiconductor crunch and rising cost of storage. Meanwhile, Meta has announced a series of new updates designed to strengthen protections for teens across all its platforms. Rachna Dhanrajani joins us now with more. Rachna, what are you picking up?
Well, Tim Cook has said the quiet part out loud. In an interview with the Wall Street Journal, Apple's outgoing chief executive admitted that price rises on Apple products are now, in his word, unavoidable. He said the company has been trying to shield its customers, but that the situation has become unsustainable now. That is a remarkable thing for Apple to say. The most valuable consumer brand on earth, famous for protecting its margins, is telling you plainly that your next iPhone is now going to cost more. And the reason is a single component, and that's memory. There's a worldwide shortage of the memory chips that go into phones, laptops. And this one is not like the pandemic, because this one is deliberate. The big three makers, Samsung, SK Hynix, and Micron, have shifted almost all their production to premium chips built for AI. The logic is brutal. Every chip that goes into an AI data center is the one that does not go into your phone or laptop, and the data centers are paying more for it. The numbers are pretty staggering. Memory prices have jumped around 90% in a single quarter. Apple has already raised MacBook prices by up to $400, and analysts say that a relief may not come until 2028. For India, one reason is Apple, but the reason that this one hits hardest of all is because memory can be a fifth of what a mid-range phone costs to build. And India is a mid-range phone market. So apart from Apple, the other phones are also expected to take this price hike. A shortage would start off this boom. So what begins in a data center in California ends up on the price tag of the world's most cost-conscious buyers, which is here in India. Now, away from pricing, the same industry is fighting a second battle this week, which is over children. On Monday, Britain announced it will ban under 16s from social media outright. Not restrict, ban. Instagram, Facebook, TikTok, and others must keep under 16s off or face heavy fines. That's what they said. However, this excludes WhatsApp. Prime Minister Keir Starmer called it a line in the sand. But Meta is now pushing back hard. It opposes the ban outright, arguing its own teen accounts already do the job needed. And on cue this week, Meta rolled out a fresh wave of teen safety features globally. Stricter default content settings model on movie ratings, AI that scans for underage accounts, alerts to parents. Much of it notably was tested in India first. So now you have two camps forming. Governments who want children banned and the burden placed on the platforms, and thus Meta betting it can self-regulate its way out of a ban. It will be interesting to watch which way Apple leans, because with iOS 27 coming later this year, Apple will also be introducing the age detection tools that could decide who is right here. So two stories, 1 week. One decides what your devices cost, the other who is even allowed to use these devices.
All right, thank you, Rachna, for that update. Shifting focus to the big newsmaker of the day, HCL Tech is doing it right by investing in Sarvam AI. That's the word coming in from Vishal Sikka, founder and CEO of VNI Systems. In an exclusive conversation with Shireen Bhan in San Francisco, Sikka, who also served as Infosys CEO in an earlier capacity, said that India is not far behind in the global AI race.
We've just seen an announcement coming in where HCL Tech has picked up 10.5% in Sarvam, which was India's frontier model company. Will bets like that now have to become stable stakes?
They will, yeah. I think I met Roshni back in February. I think what she has done is exactly right. I think it is, India is too important and India is too big to let go of any of these layers. I think it is a fallacy that we should not work on the foundation models. I think for two reasons. One, you have to have your own foundation models, and we are too big and too important to let go of that. But at the same time, we are still very early. As dramatic as the advances have been, we tend to think of this as, wow, we are so far behind, but we are not. It is still like maybe the second over of a T20 match. maybe the third over, you know. But there are still remaining, whatever, 37 overs still to go. And I think on power consumption, on hallucinations and understanding of the world, on improving access, there are so many advances that are still to happen in AI that it will be years of work, and I think that we should be working on those. And I see, and of course on the applications of it, what can we do with this continuously? I think all of this has to happen at the same time.
And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18. Thank you for watching.
Microsoft isn't just building AI tools, it's rebuilding the entire software stack for the AI era. At the core of this transformation is Core AI, a startup inside Microsoft led by Jay Parekh, focused on creating the next generation of agentic applications.
So how many times do you get mistaken for Satya?
I was waiting. I was like, I wonder if she's going to ask that question.
Of course I'm going to ask you. So how many times do you get mistaken for Satya?
From weekly iteration cycles to rethinking how humans and AI agents work together, the rules of software are being rewritten in real time. Core AI is building the end-to-end platform to run, manage, and secure agentic applications across enterprises.
Meeting Satya Nadella, joining Microsoft in 2024 to set up the AI startup, if I can call it that. You know, with a 50-year legacy behind the organization, how challenging has it been?
Yeah, so when I got here about 1.5 years ago, really what we want to do in the Core AI team is help not only the company, but also our customers kind of reimagine, rethink what it's going to take to build, to run, to manage all of these like new applications that are being invented, being created out of this technology that is AI, right? So, and that requires an entirely top to bottom kind of systems overhaul of what we've done to build software in the past, right? So in terms of like being able to build the applications with different tools, being able to support and build a new platform where these agents are running because they're interacting with the real world, they're thinking, they're planning with the models. You need different security guardrails around these things. So the entire technology stack needs to be kind of, we need to rethink the whole thing. And that's what we're focused on, is migrating or kind of transforming the way we create this new agentic software stack.
You know, I'll come to the agentic software stack in just a little bit, but let's talk about what's happening with the pace of change that AI has brought upon us. I mean, you know, within 3 months, the world is looking...
Temple for RCB fans, which is RCB Bar and Cafe.
I like the way you call it a temple.
It is. People come and just enjoy being there.
16,600 crores, $1.78 billion. What kind of projections are you building in?
Currently, if you look at the profitability, may not go up by maybe tenfold, but it will go up.
4 wins down the line. I don't want to say 2 because you actually do have 2 on the women's side as well.
When we started our RCB WPL team, the first thing was, Smriti's point was, I want to win the trophy before the men's do. And they did. And they did. Telling you, in the next 3 to 5 years, this will be maybe at least 50 to 60% of IPL.
What are you most excited about?
No, we want to go where no other team has gone, which is
A hat-trick.
Hat-trick win.
Back-to-back champions, $1 billion franchise sale, record-breaking viewership, and a fan army that refuses to quit. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Just a year ago, Royal Challengers Bengaluru finally ended an 18-year drought for that elusive IPL trophy. Today, they're not just defending champions, they are building a sporting empire. From becoming only the 3rd team in IPL history to win consecutive titles, to creating a brand so powerful that every 400 million plus viewed match this season featured RCB, the franchise is hoping to live up to the jaw-dropping sale price of over $1.7 billion. At the center of this transformation is a man who wasn't scoring runs or taking wickets, but was busy building something equally valuable, a cult brand, a brand powered by Virat Kohli's enduring appeal and a fiercely loyal fan base. And now, after becoming the most expensive cricket franchise ever sold, RCB enters a brand new era. So how do you turn heartbreak into championships, a cricket team into a lifestyle brand, and fans into a movement? Joining me is the CEO of Royal Challengers Bengaluru, Rajesh Menon. Rajesh, congratulations, and it's great to have you join us here on Young Turks Reloaded.
Thank you, Shireen, for having me here.
You know, so let's look at the business of IPL today, and I want to put this in the context of the jaw-dropping numbers that RCB was sold for, netting Diageo a very, very handsome sum. You know, 16,600 crores, $1.78 billion. That was the sale price. And the questions people are asking now is, what kind of projections are you building in as far as profitability and revenue is concerned?
When I created the strat plan, I could see that trajectory going in. Right from the media rights cycle, number of games going up, the WPL becoming a main factor growth lever, merchandising business going up, the ticketing revenue going up, and multiple gaming as a business going up. So there are multiple levers which we can unlock to arrive at that value. See, currently, if you look at the profitability, may not go up by maybe tenfold, but it will go up. Because if you look at the model is so different from any other model globally. Where
is it easier to build a profitable franchise in India because of the way that we're structured?
Exactly, because the purse is structured. The purse is not infinite. So purses, the player purses, we know the expenses. So that's the biggest expense there. So we know what the expense is. And media, right, we know what the money is coming in. So when the expense and the revenue, we know maybe at least 60% of what it is, then it's easier to build other pieces.
What the next 3 to 5 years potentially could look like, the businesses that you and the verticals that you've already started and you're focusing on, how much can you build them out?
Our athleisure range, our clothing range. In India, we are still scratching the surface. And with the global franchise, RCB becoming a global franchise, the demand is all across the globe, right? From Middle East to UK to US, there's huge demands. How can we expand that business?
How large is that business today for you?
1 or 2%.
Okay.
But I can see a huge headroom there. Then RCB Bar and Cafe, we can expand. Currently, we have 2. Can we do maybe 12 in next 3 years' time? Gaming. I mean, gaming is huge. We have not even touched that. I can envisage a parallel ecosystem like an IPL to e-gaming coming in.
Okay.
Proper cricket e-gaming. That is big. And these are a couple of growth levers which we have, and WPL. If I'm talking about IPL, WPL is a huge, growth lever which we need to unlock there.
So speaking of plans, you've now got new owners in place. And the question being asked is, what does it mean in terms of transition? What does it mean in terms of change in plan or strategy? Or is it likely to be more continuity that we should expect? What are the conversations that have happened so far on that front?
So it's too early because I think so we have not completed the transaction. So all the regulatory and it's happening. So maybe it'll take a couple of months. So currently, it is continuity is what we are looking at.
And how excited are you about the fact that you will have somebody in the lead who's an actual cricketer, not just interested in cricket, but an actual cricketer, Aryaman Birla?
I mean, they all come with different strengths. For example, Aryaman also was a cricketer. ABG comes with its own strength. Bolt owns somewhere around 27 to 38 teams. And Blackstone, we all know what they bring with. So if you look at the consortium, it's a strong consortium with different, strengths coming from. I think so. This will be a brilliant setup for RCB.
And a strong consortium with a global footprint. I mean, there's Blackstone. The Birla Group is also a big global investor. Does that now accelerate your global plans? What can it potentially mean as far as RCB going global is concerned? A lot of your peers have decided to put one step outside already.
I know. It's too early. We have not sat together as a team because the transaction is not complete, as I mentioned, but the regulatory process is still going on. Once that is done, we will have a clear understanding what 3 years and 5 years look like.
So what metrics do you look at? I know that there are different metrics that different people look at to define what is success and what is not success. But as far as the IPL is concerned, what are the metrics that you obsessively look at?
I mean, PNL is one.
Happy about the PNL today?
PNL, I've always been happy. We have been number one. Irrespective of win or loss, we have been number one in PNL. One is that. One is interaction, fan interaction, and how many communities are we creating? Because my next vector of growth for me is planting a fan platform in every district in India. So that is the entire, and we are the first team, I think, in IPL to have a fan engagement team itself. Only looks at fans. So that is my next endeavor. Saying, how can we bring all the fans, create more fan clubs across India, and bring all of them under one platform?
Give us a snapshot of what the PNL could look like from here on, given all the bets that you've spoken about and all the opportunities that you intend to focus on.
It will be much healthier than what.
No. You gotta give me numbers, Rajesh. That is not gonna work. This is CNBC.
It will be much healthier than what we have. Because currently, see, we are still with Diageo, and Diageo is a listed company, so I can't talk numbers.
So I'm not asking you to guide us for the next quarter. I'm saying, let's say the next 5 years.
I mean, we will be at 45 gross margin. That is a healthy number to
aspire to. As you step back and look at the last 18 years, why was the cup elusive? What did you do differently to clinch the title the last 2 times?
That's exactly the question which even I asked when I joined this business. When I joined in 2018, I think so, we finished 6th, and 2019 we finished 8th, the last in the table. For 18 years, we've not won. There's something structural issue. The issue is not with on-field, but something happening off-field which we need to correct. So that is where the systems and organization we looked at. And if you look at, it was not from a talent angle, it's more of structure angle which we need to correct.
Okay.
So what we did was looked at what is working elsewhere. If you look at globally, there is long-term and short-term completely different. Long-term is handled by a director, short-term is handled by the coach. And what the role encompasses. A director's role is to look at pathway, talent ID, strategy, a culture. And whereas a coach's role is from a tactical angle, coaching, on the day result and stuff. So it is about getting clear about who's accountable for what.
And responsible for
what. And that is what I did first. To create a structure which is completely different, which is not there in Indian cricket. With that, I looked at and asked, who is the best person to join that? Looked at outside in, and if you look at most of the director, coaches, all comes from the cricketing background.
Right.
But I wanted someone who has done it elsewhere. Looked at Mo was there, and it was not easy to get Mo on board. So I asked Mo, met him, and I asked Mo, can you join RCB as a consultant for 2 years?
Okay.
So that you will understand. Even I'll understand you better, and you will understand us better. You'll understand what the culture is. And the philosophy was very clear. My philosophy and Mo's philosophy were very clear, saying that it is not the big players which we need to handle, but it's the structure and the process which we need to get it right. And that started the journey.
Okay.
saying what we wanted to do, how we wanted to do, and rest was history.
Well, the rest is history now, 18 years on. What would that matrix look like on the back of the lessons and the learnings that you've now had?
See, one is structure before talent, brand before marketing, culture before performance, and community before monetization. This is how I've looked at this. The 4 pillars on this brand RCB has been built completely. I'm talking about business, cricket, and performance. Take, for example, culture before performance. Here, we created this philosophy called Play Bold. And Play Bold is not a marketing slogan, but it is a framework of decision making.
Okay.
What we do, how we do. And everything goes through that.
Give me an example.
The player recruitment, the style of play, the kind of play RCB wants to bring around the park is to play the philosophy of Play Bold. And hence, for that to be demonstrated on the field of play, we know the right kind of players. So again, the kind of players is filtered through Play Bold.
What is the boldest bet that you've made when it comes to player recruitment?
Recruitment, I may not say recruitment, I will say that decision of captainship.
Okay, responsibility. So Patidar,
The
biggest bet you've taken.
Yeah.
Why?
We had Faf captaining 2 seasons. And then there was a mega auction. We had to take the right decision, keeping the organization in mind. Not just the short term, but the long term. What does it mean for RCB for next 3 years, 5 years? And hence we have to start looking beyond the existing resources what we had from a captainship.
So don't take the safe bet.
Exactly. But again, look at the organization as a bigger picture, saying that where we want the organization to land in next 2 to 3 to 5 years. And we debated. And we understood and we dimensionalized what Rajat is all about. And because we knew what Rajat was. He was with us for a couple of years. And we also requested Rajat to captain the MP side in Syed Mustaq Ali. So there was a process which we went through. And when we completed the process, we were very clear, saying this is the man. And again,
the rest is history.
I don't want to tell that, but yeah, it's just history, yeah.
But, going back to not taking the safe choices, not making the safe bets, but playing bold, which, as you point out, is really the framework, the matrix within which RCB operates. Take me through some of the other bold decisions that you've taken, which coincide with the pillars that you outlined. Community before monetization. And typically people think of it the other way around. What are some of the bold choices there?
See, here, I believe people don't join teams or franchise. People join communities. They don't. Even we as a human being, we don't join any, franchise or stuff. We join a community where we believe that what we believe in.
But how did you create a community when you were not even winning the big matches?
See, it's going back to the philosophy of Play Bold. See, what is Play Bold? We don't know what on the other side until you go and play bold. So hence, if you look at the kind of players we recruited, right from Chris Gayle, A.B. de Villiers, Virat Kohli, Maxwell, Rajat Patidar, who epitomized the philosophy of Play Bold. Until maybe last 2 to 3 years, we had the highest score in our innings. Until now, Virat Kohli holds 900 plus runs for the IPL in 2016 IPL. Chris Gayle, 175 not out. So all this, it's not just, again, it's not a slogan. It's exactly what we did on a field of play. And that had translated on the marketing front also, on brand building. Any other team, even globally, if you want to announce something, maybe a captainship change or a jersey drop, they may use the social media and just announce it on social media. No, we created a event called Unbox, an experience for the fans. And the first Unbox, I still remember, we put a 40-foot container on MG Road. We don't want to do 10 things. We'll do 5 things, and that should be at scale. At scale. Now, Unbox has become a property. One is that. The second one is we created a temple for RCB fans, which is RCB Bar and Cafe. How do you make the brand sustain?
I like the way you call it a temple.
It is. People come and just enjoy being there with all the memorabilia there. But it's a temple for them, because if you see the first contract of Virat Kohli, signed contract is there.
Yes.
A.B. de Villiers' bat is there. The entire trophy
Cricketing
is there.
gods.
Yeah, exactly. So you can just go see there and you can just enjoy that entire premise. And all this are coming from the philosophy of Play Bold.
Microsoft isn't just building AI tools, it's rebuilding the entire software stack for the AI era. At the core of this transformation is Core AI, a startup inside Microsoft led by Jay Parekh, focused on creating the next generation of agentic applications.
So how many times do you get mistaken for Satya?
I was waiting. I was like, I wonder if she's going to ask that question.
Of course I'm going to ask you. So how many times do you get mistaken for Satya?
From weekly iteration cycles to rethinking how humans and AI agents work together, the rules of software are being rewritten in real time. Core AI is building the end-to-end platform to run, manage, and secure agentic applications across enterprises.
Meeting Satya Nadella, joining Microsoft in 2024 to set up the AI startup, if I can call it that. You know, with a 50-year legacy behind the organization, how challenging has it been?
Yeah, so when I got here about a year and a half ago, really what we want to do in the Core AI team is help not only the company, but also our customers kind of reimagine, rethink what it's going to take to build, to run, to manage all of these like new applications that are being invented, being created out of this technology that is AI, right? So, and that requires an entirely top to bottom kind of systems overhaul of what we've done to build software in the past, right? So in terms of like being
WPL, and while it took 18 years for you to be able to clinch the IPL title, you did that in year one as far as the WPL is concerned. I mean, what has the WPL meant for you personally?
I mean, when we bid, the Diageo board, led by Ivan, when this entire WPL tender came up, there was only one message from the board: please go get the team. Because everybody believed in this women's Premier League story, and we wanted to, as a Diageo, as a team, wanted to participate in that. And when we bid 1901, it was a complete surprise for everybody, saying, how will a company like Diageo bid, which is a non-core business, and bid? And we felt very, very encouraged from this entire Diageo board to go get it. If you look at, if you ask any of our WPL support staff or players, everything what was given to the IPL team, right from the team room, everything was equal. And for me, it was more empowering and making a dent in the ecosystem. It was not just about WPL as a cricket. By participating in WPL, it opened up avenues for entire generation of women sports person. And also people who believe, saying that I can also do this. When Smriti is holding a bat, Richa is holding a bat, and performing and taking something to next level. That is a belief which I felt I have unlocked in millions.
How different are the two teams though?
The men's and women?
Yes.
Her mindset wise, no different. Absolutely no different.
Equally hungry?
Hungry, yeah. Hungry like I can tell, for example, when they started, when we started our RCB WPL team, the first thing was, Smriti's point was, I want to win the trophy before the men's do it. And they did. And they did that.
You know, I want to talk about the key man risk. And that is obviously a question that must come your way very often. How do you deal with that? And while you talked about one of the boldest bets that you've made is to back Patidar as captain. But in your own words, RCB is Virat Kohli is RCB, and that's really the RCB story. How do you imagine a future where you fortify yourself from Virat Kohli not likely to be there?
RCB and Virat in the different sides of the same coin. He's been the constant factor for RCB throughout. We have not seen him not being part of RCB, even if he moves out of his cricketing career. So we need to figure out that. But having said that, we have not seen that. Next 3 to 4 years, I'm sure he'll be playing for At least 4 years.
At least 4 years.
4
Has there
years.
been a conversation on this front?
I mean, he's fit. You have seen him. He's fit.
Yeah.
He's the hunger never dies.
But he's not playing T20 anymore.
But that's when you saw him this IPL season. What was he bringing on the field of play? Energy, runs, attitude, everything was there. So I don't see it. Now 3 to 4 years, absolutely no problem.
I want to go back to the scouting aspect a little bit and understand from you what the learnings have been on that front and how the scouting network operates for RCB. So how does your scouting network operate?
Yeah, the philosophy, what we believe is multiple eyes, multiple times. Because there's no bias coming in there. So if someone has to scout me, I mean, it's not like one guy looking at me and saying that, oh, this is a best guy. Multiple eyes, multiple times. So a person has to see me multiple times and multiple people have to see me.
So how many people, how many times do you actually check out a person before you decide to sign them up or not? Give us an example of...
Minimum, no, at least minimum 3 to 4 times. Someone has to, multiple people has to see. And then there is a system in place where we have our own technology where every scout rates that person. Then it goes to coach and the other support staff and more. Then they call the player. And then they assess, what they see. Apart from that, what we check is what is the background. We speak to their coaches, their friends, parents. So it's a 360-degree understanding of that player. So then we figure out saying that, okay, this player fits in with our philosophy, fits in with our role, what is required, and then we go in.
What is the mood like once a match is over? Assuming it goes your way, and sometimes it doesn't go your way. You're not there to win all the time. Is it different then? To get the team to rally behind the vision, behind let's dust ourselves up, pick ourselves up, and go. After having lost a match?
No, as a team, we don't have our mood doesn't go up and down. That's one strength of this entire unit is we don't, and we have a clear process even in that. I'll give you example. That talks about the culture. Who will go for a press con if we lose? Who will go for a press con if we lose 2 times, twice or 3 times in a row? Who will go for a press con when we win? Very, very clear. Because our philosophy is we don't want to put anybody under the bus. So for a simple example, if the going is brilliant and we are winning, then young player will go and face the media. The going is tough, the coach goes or the data cricket goes. So that's a culture which we have built very clearly. And that gives confidence and strength to the players.
That you're watching their back.
Exactly. And whatever happens, we are there. 2 seasons back, we were 6 down. And then we played and we won 7 and we go to the playoff. There's absolutely no difference when we were 6 down and maybe won 7 and even last 2 seasons. Absolutely no difference.
It's easier said than done. How do you build the confidence? And I was reading Andy's comment saying that the difference between the 24 win and the 25 win was that this is a team that's feeling much more confident. How do you build that confidence over time?
You are not playing for anybody else other than the fans. To keep that in mind. You're not playing for anybody else. You're not playing for the owner. You're not playing for the corporate. You're playing for them. So when you're on the park, do that.
Speaking of fans and the unfortunate incident that happened after the IPL win, and there were, of course, the committee set up to look into it, and there were questions raised on the lack of preparedness, the lack of coordination. When you look back at it, what is the biggest regret on how that transpired and what you could have done differently?
No, I don't want to get into that detail because it's still sub judice. I don't want to do that. But it's unfortunate we lost 7 of our close fans, or like our family. And this year we have 11 seats only for them, which will be forever there in Chinnaswamy Stadium. Having said that, this year with the Bangalore City Police, the government of Karnataka, all departments came together. And this year we were like, along with their help, it was a clockwork. And it was a case study where Bangalore City Commissioner was talking to me and he was like telling, other cities were like, they were like asking us, how can we replicate that? I mean, all this helped. And if you look at the feedback, we started getting feedback also. We started taking feedback. And this match day experience was the best ever experience in the last 19 years. In terms of traffic, in terms of smooth operation, inside, outside, and from a safety angle also.
Was that the darkest day of the last 18 odd years?
Absolutely. Absolutely.
How do you recover from something like that?
Still not. Still not. That's not easy.
As a franchise, what is the way forward in terms of making changes to ensure that something like that never happens again?
I mean, from that day onwards, we started working back, saying that along with the Bangalore City Police and the government, saying that what is it required to make it much more safer. But it's not just RCB. Everybody has to come together. Because it's not a small event. It's an event of where multiple fans come in and multiple organizations involved. So it is not about just us, KSCA, the event agency, Bangalore City Police, PWD, the Greater Bangalore Association, and the government of Karnataka. So we all came together. We had multiple committees. And the committee is still active. Now the committee is all about chatter there. So we came together and we had a clear SOP and timeline and responsibility. And that helped us. And I think so that will become a case study and we will embed that in anything what we do.
So what are you most excited about now? Four wins down the line. I don't want to say two because you actually do have two on the women's side as well. 4 wins down the line. What are you most excited about?
No, we want to go where no other team has gone, which is a hat-trick win.
Well, we wish you the very best of luck for all that you've laid out for you as far as opportunities as well as new challenges that you intend to take up. But thanks very much for dropping in.
Thank you.
And we wish you the very best of luck. We hope that it is a hat trick the next time around as well. And we look forward to having more conversations with you. Well, that is a wrap on this edition of Young Turks Reloaded. If you enjoyed the conversation, write to us. We always like to hear from you. Send us your feedback and your comments. We'll see you again next week. Till then, from all of us here on the team, goodbye. Many thanks for watching.
The build.
Microsoft isn't just building AI tools, it's rebuilding the entire software stack for the AI era. At the core of this transformation is Core AI, a startup inside Microsoft led by Jay Parekh, focused on creating the next generation of agentic applications.
So how many times do you get mistaken for Satya?
I was waiting. I was like, I wonder if she's going to ask that question.
Of course I'm going to ask you. So how many times do you get mistaken for Satya?
From weekly iteration cycles to rethinking how humans and AI agents work together, the rules of software are being rewritten in real time. Core AI is building the end-to-end platform to run, manage, and secure agentic applications across enterprises.
Meeting Satya Nadella, joining Microsoft in 2024 to set up the AI startup, if I can call it that. You know, with a 50-year legacy behind the organization, how challenging has it been?
Yeah, so when I got here about a year and a half ago, really what we want to do in the Core AI team is help not only the company, but also our customers kind of reimagine, rethink what it's going to take to build, to run, to manage all of these like new applications that are being invented, being created out of this technology that is AI, right? So, and that requires an entirely top to bottom kind of systems overhaul of what we've done to build software in the past, right? So in terms of like being able to build the applications with different tools, being able to support and build a new platform where these agents are running because they're interacting with the real world, they're thinking, they're planning with the models. You need different security guardrails around these things. So the entire technology stack needs to be kind of, we need to rethink the whole thing. And that's what we're focused on, is migrating or kind of transforming the way we create this new agentic software stack.
You know, I'll come to the agentic software stack in just a little bit, but let's talk about what's happening with the pace of change that AI has brought upon us. I mean, you know, within 3 months, the world is looking completely different. Now, from your point of view, as you plan out for the future, is this pace of change sometimes overwhelming? I mean, how do you deal with it?
Yeah, it is
and
absolutely.
And how do you plan for it?
Absolutely. Everything's going so fast, right? And sometimes for us, it is where you will come up with a plan or an idea one day and you wake up the next day and you have to scratch it out and try something else. So there's a few things here, which is, one is, it's really about the way we are working as an organization, because the technology in the world is going to keep changing quickly. So saying, hey, we're going to read more, we're going to work more hours, we're going to invent more days of the week, while those things they would be nice, they still probably won't keep up, right? So a lot of it is really making sure we are adapting faster and faster. And so that is a lot of how you kind of change the team dynamic. So one is making sure we do have time to learn, to observe, to be curious with our customers. Two is making sure our iteration cycles are very fast, right? So we don't do, for example, planning over a really long period of time, because you can go and make a plan for a roadmap for 6 months or a year, and within a few weeks that it's going to be out of date.
Right.
So you want these short iteration cycles of what you're doing. You absolutely want a North Star, but you want to be iterating kind of week by week.
So is it literally
adjusting.
week by week?
It's day by day for some teams, at most kind of week by week, yes.
You know, agentic future that everyone's talking about at this point in time, where are we in that journey? Are we close to that inflection point? I'll link that back to what Satya said in his post yesterday, that we have to reimagine the workforce and reimagine work with human capital and token capital coexisting. So what does that mean now as far as the way that organizations are structured? What do you prioritize today?
Yeah, so there's going to be a few things. One is just the overall system that is supporting this new way of working, right? So it's going to be the tools that we use as employees to do our job, whether you're in finance or you're a developer or whether you're a salesperson. There's where these applications and how those applications are going to run within your enterprise, as Satya mentioned in his post, where there is this end-to-end system, right, that has to come together that does allow you to manage kind of your human capital, your tokens, and then really we got to be focused on these different outcomes, right? And knowing what we can do with the power of the technology plus the power of our people. What types of new problems should we go tackle? What is the ROI on that, and what more value can we build? Either stuff that we may be able to do to save, because some organizations and some teams may get the biggest benefit there, but also what else can we tackle together? So it's really bringing those together and not as disparate concepts. But for me, what I focus on in all of the stuff that we do in our team, it's really how do we get to a new cycle of delivering that value, that quantifiable ROI to the customers.
You know, when you came up with the idea of the Agent Factory, and as you look at where we are today, what is the most exciting aspect of it, and what is it that we should be prepared for as we look at 6-12 months down the line?
Well, I think for us, it is continued change, right? So that is something that is both exciting. It's also hard as a product building organization of how to, one, make sure that you create these very valuable technologies that organizations can be successful with, that they can deliver that ROI, but also making sure that a platform that is adapting over time too, right? Because you can build the platform in a way and the tools in a way that they solve yesterday's problem. and then you're always kind of lagging the technology. So it's exciting to be able to build the flexibility in the platform and how to build the flexibility in the platform. I would also say that for us going forward is how you're going to manage your AI applications, right? And Satya talked a bit about this of how do you manage that, in some ways, the cost of the cost of this estate. And there's a lot of work that we're excited to do and that we'll do around, you have all of these different use cases. You can imagine in an enterprise, you may have thousands, tens of thousands of these AI agents and use cases. Some of them may need the premier tokens, like the premium tokens, I should say. And then over time, as these things are doing different types of workflows and tasks, you can optimize that with your data in your tenant, with your kind of compliance and guardrails. And then you can use kind of model choice, framework choice, tool choice to really make sure you have the right quality for the job, but you also have the right cost efficiency for the same job.
Which also means that you need to have an open ecosystem.
Yes.
What have been the results in terms of efficiency and optimization that you've been able to drive through the work that you've done so far?
So this is an area of constant work for us, right? So for example, in GitHub Copilot, we have work and science work that goes into modes that developers, builders can use where they defer to an automatic picker. So based on your task, based on what you're trying to do, we locally can classify that and pick the best model, right? So it doesn't always have to be the premium model. It can say, hey, you're going to use this for this complex planning task or this complex refactoring task, but these other things, we can pick a cheaper, faster model for that, right? So we want to take some of that burden of having to pick off the end user and make that just part of the platform, part of the product. But that's also requiring you have model diversity, right? So both in GitHub and in our productivity M365 Copilot, as well as in Foundry, we offer that choice of the wide range of choice, right? Big models, small models, open, closed, but also multimodal, image, voice, video, etc. Those are all part of that builder creation process.
Were you surprised by what we've seen recently with companies saying we've blown through our budgets? Did that surprise you?
Yeah, I don't know. And
token maxing is now is almost an insult.
So, as somebody who's been in tech for a long time and led, supported kind of technical product organizations, I think it's easy to, I think, get over-rotated on these activity metrics, right? And a long time ago, it would be like, you would have lines of code or these types of things. These are activity metrics, right? And if you're in sales, it's like, okay, how many leads do I have, right? And you could have lots of leads, but if none of them are qualified or none of them are real, that doesn't turn into, that's activity, right? It's not actually revenue. So it's not that it's a new thing to me. It's actually, again, businesses needing to separate kind of these activity metrics versus these output metrics that are important to the business, right? Or because the activity doesn't always translate into the outcomes. One of the things that we work on in our team here is equating, okay, if we're going to invest X dollars, some number of people and some amount of tokens, what is that, what is the output, the impact to the business that we get? And thinking about that time from an idea that somebody has to when it ends up in our customer's hand, what can we do to shrink that time, but also make that experience more valuable, more delightful, et cetera, right? So these are the metrics that actually move the needle for our customers, for our business, versus these activity metrics, right? It's easy, you can imagine, everybody should use a lot of tokens, right? We all see what happened in the news about that. But now we have to just be wiser, smarter, and kind of come together with the right controls, with the right visibility into how these token resources are being used.
Speaking of ROI, I think what has worried the street is that, you know, this massive capex spend being announced by each of these companies, including, of course, Microsoft, $190 billion in 2026. And is this real? Is this going to lead to an unraveling? I'm sure you get a lot of those questions as well, but how do we make sense of this, of the kind of spends, what it's eventually going to lead to, what it means as far as an ROI perspective is concerned?
Yeah, absolutely. So I think just staying focused on what value we're delivering to customers, right? When we see kind of the evolution of how people are using the products, right? So you could even go back a couple years ago and say, okay, Copilot, what was the typical use case? It was ask a question, get an answer back, right? Now today, people are launching very big, elaborate research projects like competitive research or product research or ways to kind of maybe think about a business model analysis where they're bringing in different artifacts, maybe a spreadsheet, presentation, outside research, other information that may be in your flow of work, right? Stuff that's in your Teams or email or other documents. That corpus and being able to think about it, reason about it, do more sophisticated kind of planning or outcomes, that is where I think the flow of work is just picking up the pace, right? So doing a question, getting an answer back, that was, you know, a year or two ago.
Yeah.
But now if I can use this technology to do what would take, you know, days, weeks, months with a lot of people, and I can do that in hours or minutes now, then I think there's tremendous demand. And that's what we see in how we're building our products and like how we generate our ideas for our roadmap too, right? Which is to really be able to have the tools and the platform support these more complex and just higher ROI or just more valuable outcomes, right? And I think then the spend will flow from that. Now, we obviously continue to match, you know, our spend is like based on our demand, right?
Yeah.
So that's, but the demand comes from working backwards and working closely with our customers.
Let's talk a little bit about India, because you've said previously that it's not just about the models. It is going to be about how those models are deployed at scale, how they're used, and of course that's where the talent aspect comes into play. You know, how do you read the India story in an AI landscape?
Yeah, so India is just it's a really exciting community in India, right? In GitHub, we have 27 million developers that are in the GitHub community in India. Just this year, we've seen more than 2 million new developers join the GitHub platform, right? So it is an incredibly fast-growing and very, very vibrant community of developers. And it is one of the most activated, I would say, in terms of thinking about using AI and actually building ambitious product solutions to serve the world, right? So very exciting to see the range of what people are doing from the big multinational companies in terms of what they're doing to help even other companies around the world do transformation, as well as the startups and how small teams moving fast with this technology are building some of the most valuable startups in the India startup ecosystem of all time, right? So very, very fast moving. It's a community that's contributing a lot to open source in AI as well. And it is an area where we continue to invest. Obviously, Microsoft all up is investing in data centers and skilling. We have a big presence there for our own product development in the different offices as well.
the debate on whether India should do frontier models or not. We do now at least have fun. And we've just announced a big deal where HCL Tech, one of the services companies, has decided to pick up a little over 10% stake in Sarvam. Do you believe that that is going to be crucial? It's going to be imperative as India builds out its AI ecosystem, this kind of ecosystem building?
I think it's important for where there is the talent and the dollars to continue to invest in as much of the stack as possible. Like there's an incredible amount of investment going into building out the infrastructure. There is obviously a vibrant startup community. The larger, I would say, the companies that are doing work for all the multinationals, like we work with, Wipro, Infosys, all of them, in terms of what they're doing to drive that transformation. So it is very good, in my opinion, for investment to be happening at all of these layers of the stack, because so much is still yet to be invented and to be decided. And having having folks work on what may be specific needs of the Indian market, I think is great. It's a valuable part of the ecosystem.
Sovereign AI and a national strategy as far as AI is concerned, I mean, that's gotten a lot of play on account of what we're seeing happen on the geopolitical front. With the Trump administration telling Anthropic what it can or cannot do as far as Claude is concerned, does that become an emerging concern for the industry? And, and how do companies like yours look at it?
So the way I think about it is, again, we have defined and we are working on this end-to-end system in terms of how organizations all around the world can build these AI applications, how they can contextualize it or connect it with their data, right, their proprietary business data, how they can run this in this platform, how they can govern these applications for their compliance, their governance, their whatever sovereign constraints or requirements they may have, and then how we can make this whole thing continually improve over time, right? And so that really is the notion of the platform that we're trying to build. And so that over time, this should be able to meet whatever requirements, because it does, as a platform, allow you that flexibility. It does allow you that choice. So you can lean into one model, you can lean into lots of models. If something happens in the geopolitical landscape, you have choice, right? And that's where the extensibility, the flexibility of this end-to-end system, this end-to-end platform, I think is super important as we see the world continue to change.
The anxiety is also coming from is that what is this technology going to do to people in the workforce, in the workplace? How do you address that? And I'm sure that, a lot of young people who come to you or startups who come to you or even employees who talk to you about that. How do you address that question, the short-term, medium-term dislocation that is expected, but in the long term, what do you believe is likely?
Yeah, I think for us it's a journey. And I'd say that one, we have to think about the type of people that we need for different problems, different projects, right? And I think some ways you see maybe the specialization in an organization is starting to blur, right? You're starting to see folks in our legal team or our finance team using our developer tools to help them do their jobs. You're seeing people in maybe in product and engineering being able to think about maybe marketing strategies, because they're able to brainstorm with these tools, right? And give it context in work and other documents they may have. So in some ways it's really neat because the functions are blurring, which means one, people are learning things that maybe they, in the past, because they were specialized inside of a function, they couldn't learn, right? Or it was hard for them to learn. Now you're able to kind of, I would say, expand your knowledge across the function and really think about, okay, I have this product, I have this feature. I'm not just going to be responsible for the code or for the spec or just for the design of it. I'm going to think about it with a couple of other colleagues, how we we think about the idea, how we vet the idea, how we iterate on it, how we build it, how we get it into customers' hands, how we position it against the competitors. So we're not going to have all of these handoffs where we go slow. But now if I can have employees actually gain way more experience because they can understand these different functions that may have been separated from them, then I think that is a huge learning opportunity for the organization. And then I'd say the other thing for us is just continuing to learn and gain new skills about how to use these tools, right? And that I think is something we invest a ton in terms of how we drive those programs, those learning programs. And, you know, frankly, the other thing that we see a lot of is there's a lot of work that is, I would say we classify it as toil. It's like repetitive, mundane work that isn't, and goes kind of in your face of when you're trying to create and deliver value to customers. There's a lot of work that we can automate away that then saves time. You get time back to then go work on those higher ROI or higher value or higher ambition problems.
Well, we look forward to hearing more from you, and we look forward to seeing you in India. Jay, thanks so much for joining us here on Voices from the Valley. Appreciate your time.
Thank you.
And wish you the very best of luck.
Thank you for having me.
Well, with that, it is time for us to take a quick break, but the headliners and newsmakers will continue. We're right back with you after this short break. Stay tuned.
A computer science engineer from IIT India Kharagpur, Vamsi Bopanna is the Senior Vice President of the Artificial Intelligence Group at AMD. Bopanna is looking at all things AI in this role, from the data center AI GPU business to cross-company AI strategy. He is driving AMD's AI roadmap across client, edge, and cloud. A big believer in open source, Bopanna says he has lived through the browser era. The current pace of change is nothing like he's seen before. A tech optimist with half a dozen patents to his credit, we talk about how the compute game is being rewritten, why every product generation will see a significant improvement in cost, and why he believes in an open source future, and how India is contributing to AMD innovation and IP.
Hey, Vamsi, thanks so much.
Hi, Shireen.
Appreciate it.
Good to see you.
Good to see you here at AMD.
Yeah.
So, what a journey it's been for you, Vamsi. I mean, you know, from IIT Kharagpur to the University of Illinois, then your own startup, and of course, 2022, courtesy of merger at AMD.
Yeah, it's been incredible. You know, I feel like I've had one of the greatest privileges having the career here. And, you know, just even within AMD, I keep joking, right? You know, I have one of the best jobs there is in the industry. One of the real privileges of my career also here is to be at the tip of the spear of innovation, as they say.
The engine of growth.
And you know, every week I have the privilege of meeting people doing incredible things, people that are you know, creating new medicine, you know, solving, you know, new math that hasn't been solved before, and just, you know, tackling, you know, really difficult real world problems. And it's just been so exciting to be in the middle of all this innovation here in the Valley. And, you know, even more exciting is that more and more of this innovation is actually happening on AMD platforms. So it's been amazing.
You know, and I want to talk about the AMD platform and, of course, everything that you're doing, which is exciting and interesting here at AMD.
Yeah.
And we've got a sampler of everything that you're doing in the AMD Technology Showroom. That's right. But, you know, you talked about transformation. You talked about the real-world complex challenges that are hopefully being addressed courtesy AI.
Yeah.
How confident do you feel at this point in time of real breakthroughs in healthcare, in medicine? You know, what are you hearing from people that you work with and that you talk to?
Well, I mean, like I said, right, given the interactions that I have with people that are absolutely at the bleeding edge of innovation, I feel like there are a few things going on. Number one is the future of computing is being rewritten as we speak. And it's just such a wonderful time for us to be in the space right at this moment. And because such innovation is happening in computing, there's just incredible gains across disciplines, right? Whether it's healthcare or producing new materials or solving new math, it's just across the fields. It's a Cambrian explosion, so to say. I can quote one of my good friends who was the creator of one of the largest AI capabilities existing today. He said, in the next few decades, there'll be more medicines that will be produced because of AI advances than we were ever been able to produce.
Wow.
Right? And that's exciting, right? It's just, the capabilities of AI are advancing to a space where explosive gains are being had right today.
Well, speaking of the fact that, as you said, computing is being rewritten.
Yeah.
From the AMD vantage point, you're the challenger. You're up against the giant, but it's been a David or Goliath story that's been playing out over the last few years. How do you address this market where you're with the challenger mentality? What has that been about for you in the last few years?
From Bihar to Silicon Valley and two unicorns along the way. Dheeraj Pandey grew up in one of India's poorest states and earned a degree from IIT Kanpur. He landed in the US in 1997 with less than $1,000 in his pocket. After stints at Oracle and a series of enterprise software startups, he co-founded Nutanix in 2009, right in the middle of a global financial crisis. The bet paid off. The company went public in 2016 and generates annual revenue of nearly $2 billion today. But Pandey wanted to start over once again. He stepped down as CEO in 2020 and co-founded Devrave, an AI-native platform that hit unicorn status in 2024.
Hello and welcome to Voices from the Valley. I'm Shireen Bhan. Joining me on the program today is somebody who did a startup in 2009, took it public and then decided to quit and start up all over again. Dheeraj Pandey, it's great to have you on Voices from the Valley. Thanks very much for joining us. Let's get started with exactly that. 2009 is when Nutanix happened. You took it public in 2016. You quit in 2020 and then decided that you wanted to start up all over again. What made you?
First of all, great opportunity, and thank you, Shireen, for doing this. 2020, I turned 45, and I'm like, I have another 20 years to give to this industry. And that meant a new problem statement, because the old problem statement that I had was competing with public cloud.
Right.
And I'm like, if we're going to stream more infrastructure from the internet, like what happened to music, we were owning music for a long time, and then Spotify happened and Apple Music happened. And that was what was happening with infrastructure. People are willing to own less and rent more and lease more and stream more of the infrastructure. So I'm like, I need to now diversify into something that is a bigger problem statement. Happened to be AI. Back in the day, we didn't call it AI, but it was convergence. So how do you really take all these silos of business software and converge them? Which is what I had done at Nutanix as well, is take a lot of these siloed infrastructure and converge them. So some great inspiration from iPhone, like what happened with gadgets in our personal lives. We converged a lot of that.
Yeah.
And what in many ways Nutanix did, but also what the public cloud did. And public cloud was converging a lot of experiences, and business software was highly fragmented.
Yeah.
And I'm like, if there's a new problem statement for the next 20 years, that has to be around business software.
But driven by AI.
And eventually by 2022, when ChatGPT happened, so we were doing a version of AI, but you can still call it machine learning before that.
Right.
But real conversational AI happened when LLMs grew with us. And only honestly in the last 9 months have they truly come to bear, But we grew with LLMs. LLMs grew on us as well. And now convergence and, synthesizing a lot of the business is what AI's job is.
Right.
And LLMs are a tool to that. But what we've come to realize is that you have to use the CPU and the GPU.
Yes. Yes.
Not just one or the other to really make AI come together.
So let's talk a little bit about what you are doing now as far as Devrave is concerned. You've raised a significant amount of capital, already a unicorn. What, 186 million in funding so far?
We've raised about close to 300, yeah.
300 now, okay. And so what do you intend to do with all of this money? And, who are you up against at this point in time?
The real sort of architectural thing that we're going after is that you got to really bring all the data of the enterprise together. There is another way of doing it, which is going after existing systems like Salesforce and ServiceNow and Atlassian and Jira and all these other companies. So you could go after a lot of siloed systems and see if at inference time, when a question is being asked, do you want to go and join them and order them and sort them and all that stuff? And that's extremely prone to errors. So AI becomes very imprecise. It burns a lot of tokens as well. In fact, in our experiments, it's showing 20 times more tokens than otherwise, And also it's not safe because agents, if they go rogue, they'll make a lot of mistakes. So, and then finally, AI has to be multiplayer. The fact that it's single player only goes so far. So you've got to really place AI in teams. So we look at these pillars and say, look, there's nobody who's really figuring out precision of AI, efficiency of AI, safety of AI, and finally collaboration with AI. And that's an underserved market. And we're like, if we can actually use data, which is enterprise memory, the shared memory of the enterprise, and then use that to power a lot of AI within the enterprise, including with customers, not just within the employees of an enterprise, but also their customers. No other company is doing that, where the same technology is being used to really power self-service needs of the employees, but also the self-service needs of the customers themselves,
Okay.
And to make it all come together, it's not just about data, but knowing how to cleverly use the old Intel architecture and the new NVIDIA architecture and mix and match them. It's like what happened with hybrid cars. When we thought that it's all about EVs and electric vehicles, we realized it's not affordable by the common masses.
Subsidies were out.
Exactly. And right now the subsidies are with VCs and subsidizing tokens and GPUs and stuff like that. But if you were to really make AI into a mass market solution, you got to make it hybrid, where there's enough CPUs, enough GPUs, enough databases, enough neural networks. They're all working in conjunction.
Okay, so if 9 months has sort of been the breakout moment as far as the company is now concerned, what are we talking about in terms of customers? What are we talking about in terms of revenue?
So we have very large customers now, which I think even at Nutanix terms, to get to this kind of scale with our large enterprise customers, probably took 6-7 years of selling. So this time around, obviously AI is obviously a big bubble. We'll see when it bursts. But
so you do think it's a bubble?
You know what? I think given how fast it's grown, like all things physics and nature, it'll probably also come down and then it'll stabilize. This happened with the .com era as well. This happened in the housing bubble as well. So there's something we said about that too.
No, but I think the quantum of or the second order impact of what's likely to happen if this bubble were to burst and it were to start unraveling, I think that's what everybody's worried about, because just the size of the money that's being spent.
Yeah, no, absolutely.
So what are you most worried about? Because everybody else I've spoken to so far has said, we don't believe it's a bubble. Demand visibility is very strong at this point in time. In fact, supply can't catch up with the demand.
Well, again, going back to history of the .com bubble, there was a need for China to actually end up in manufacturing. We needed a touchscreen, we needed Samsung, we needed 3G network. So we needed a lot of technology and a manufacturing powerhouse like China to really make the internet investments come true. This time around, the applications are there, the use cases are there. We're not waiting for an unlock with a new tech. So in some ways, I do agree with those people who are saying this could actually be self-fulfilling. But at the end of the day, there is going to be these companies going public. And now once you go public, NVIDIA cannot buy into you. You cannot do circular investments and things of that nature, which has happened as they've stayed private. But I feel like then the public demand, the Wall Street demand start to come. And then, one disappointing quarter and there you have it, So it all starts with Wall Street, and then whether Main Street actually gets affected, time will tell. I mean, in many ways, I think the bus for what AI needs to be and should be for companies, I think that bus has left the station, In many ways, people have come to realize that being conversational, believing in self-service, really elevating people to do bigger, better things than being involved in manual work, all that stuff is real. And the unlock of language and code generation and what it means to really write software now, all that stuff is basically real stuff, So I feel like there will be a dip on Wall Street. What it means to Main Street, I actually can't tell you.
So it's interesting. You think that Wall Street is going to trigger the unraveling?
Yeah, which always has been, because it's always ahead. Remember, the idea of a stock market is that it's about second derivatives.
Right.
It's about what's the rate of change of growth. And many a time, these things actually are speculative. And, but what happens on the ground on Main Street, I think AI is real. It's not waiting for any technology unraveling to happen. Unlike the first time during the .com bubble, we had to wait for mobile apps and mobile phones and 3G networks to arrive before the internet pipes could have been used to the hilt. This time around, I think there's a real supply crunch, and demand is here because the apps are real. ChatGPT is real, Claude is real, computer, our app is actually real. We're seeing the real benefits of computer, not just within Devra, but with our customer base as well.
Right.
So I think a lot of these things are actually here to stay.
But how does all of this impact companies like yours? Every time you see price changes or pricing changes being announced by some of these model companies, what does it mean to somebody like you?
Well, the good thing is that I just was mentioning about the hybrid cars, that fuel injection and batteries go together. So for us, CPU and GPU go together. Databases and neural networks, they go together. And we believe that's the only way to build a highly precise AI. Computer, as our product is called, uses databases and different kinds of databases, not just one SQL-like database, but also graph databases, vector databases. So you need to use modern architectures to do this. And many of those things also run on the CPU. Now, the GPU has a friend in the CPU, so you actually know when to use the GPU to actually call the CPU out. But we probably are one of the rare companies that won't be as much affected by what's happening in terms of the pricing shenanigans that's going on in the GPU world itself. This can be done way better than what most companies are doing.
Speaking of shenanigans, I mean, what we've seen as far as the stock market is concerned, when we talk about SaaS companies, I mean, significant erosion of market cap at this point in time. From your vantage point, as you look at this market and you're trying to solve for this market, do you believe the SaaS apocalypse is real or not?
See, every 15 years, Shireen, like if you go back to 1990s, the risk was all with customers compared to IBM, the seller. So IBM was selling big honking mainframes. And company said, you want me to go buy for 20 years or 15 years in advance? So people said, give me smaller things. And that's when Cisco happened, Microsoft happened, client server happened. And the idea of smaller things is shared risk. So people said, oh, Microsoft is better at this than IBM was, or Cisco is better at this than IBM was. And then another 15 years later, we were doing box software. This is pre-subscription. And everybody's like, why is everything perpetual? And why do I own all the risk on my books about perpetual software? And then the company said, okay, let's respond to this, especially the new companies. They said, let's respond to this and give them subscription. 3-year terms, 2-year terms, 1-year terms. So there was a shared risk again. And I think in the last 15 years, a lot of complexity has emerged. Too many system integrators, too many partners going and selling complexity, time and material, and the market is revolted again. So I think this happens every 15 years. There's a notion of, okay, how are we going to share the risk? Because you sell me 100 seats of subscription, I barely use 30 of them. The other 70 are wasted. So consumption and outcomes-based pricing is basically the answer to that. Like, hey, can we come and give you a pricing model which actually shares the risk between the provider and the customer? And that's why a lot of SaaS companies have to change again. SaaS is now looking like perpetual software one more time, or like IBM mainframes. They have to go and change their pricing models. And many companies won't do this as a public company. They probably might have to go private, really go make this transition.
So what is it going to mean in terms of pricing models changing? And, we're starting to hear a lot more in terms of companies moving to outcome-based pricing. But, especially from a system integrator's point of view, and I ask you this in the context of what is likely to happen to Indian IT services companies, what could it mean? What are we talking about?
Well, it's massive. Not all of them might be able to do this as a public entity, for example. Why do I say that? Because time and material was their way of really pricing a lot of things. They did have some fixed cost things which you can call outcome-based. There'll be probably a lot of fixed cost things going forward. What does it mean for companies like us? We become suppliers to them then. Because if they have to be on the hook for fixed cost and they have to deliver the outcomes come what may, they'll need to use better technologies. Companies like us will need to get involved. I mean, in fact, I'm already hearing that from law firms. They're like, now our clients are telling us you can do more with less. Why should I give you money on time and material? So that billing every hour, every 10 minutes, and every email is probably going to be a thing of the year. That means that they have to, in the supply chain, use better AI. And the SIs in India probably have to do exactly the same thing. And many of them will probably have to think about whether it means taking bigger risks with their customers. And fixed cost is a way to do that, actually. But they cannot have 500,000 people employed and basically selling time and material and doing time logging. Because the real logging now is tokens. You need to meter tokens in and tokens out. Now, that's a measure of inputs. It's not a measure of outputs or outcomes. But it's a good proxy for work. And in the process, people will probably burn a lot of tokens. So that's why tech like ours will be useful. But the real time and material sort of equivalent now is tokens in, tokens out. And I don't think many SIs in India will actually be able to really figure this out as a public entity. They probably might have to go private. Like Tata's might have to take TCS private.
You really think that's a possibility?
Because it's a model change. It's a big model change. And if you can explain to the street that this is what it's going to look like in the next 3 years, well and good, like Adobe did this, like 15 years ago. We did this at Nutanix, almost 8-9 years ago. But the markets don't have that kind of a patience. They'll say, well, I'll be out on the stock for the next 3 years. Maybe I'll come back when you're ready for that, So I think there is a reckoning coming for a lot of public companies that have to change their business model.
What's the biggest challenge as you grow the business out today in comparison to when you were growing Nutanix? I mean, the world, of course, has changed. AI is completely sort of dislocated many industries, many sectors. But what, as somebody leading the business today, what is the biggest challenge that you are dealing with?
You know, there is, so if AI means smaller companies, which is true, you'll probably not have as many people doing data collection and data analysis. Basically, what has AI done figuratively? It's like when we went from horse-drawn carriages to automobiles, we could physically move faster, maybe 5 times faster. Today, that automobile is AI. We can mentally move faster, 5 times than what it was to be with doing meetings and having data analysts and all sorts of people collecting information that can be done. So companies are going to be smaller. But we still need to have people employed, which means we'll have more companies, which will have more products. Now, that also means that the cycle of creative destruction shrunk one more time. So products will not last 10 years. They'll probably last 5 years or less, So what we have to do as product thinkers and managers and sellers and packagers and pricers is to really think hard about how do you really do life cycle management of a product and not think of a product that's 10, 15, 20 years.
But 5 years.
5 years maybe, And that is how you have to really start thinking about a next product or the next adjacency. And, agents have become that. In many ways, the idea of an agent is a new product. Every agent is a new product. So, and how they still share and leverage a common company's infrastructure and its tech is where the real design is then. Like, shared memory for us, for example, is that design that, hey, we help you build your own shared memory. And we give you a UI, which is multiplayer. And by the way, this is where collaboration happens with AI, but between your own people. These two things are fixed. Everything else in the middle is churn. You will keep building new agents. You'll have to benchmark and evaluate and keep thinking about new roles, new responsibilities that can be virtualized. Because effectively, what is AI? What we did with machines in the last 20 years or gadgets, like iPhone virtualized a music player and a GPS device and an email device and all that stuff. It virtualized now, they just became apps.
Yeah.
I think we're virtualizing human roles, right? We're virtualizing all that. And they still be called agents, not like one monolith of AI or something. We'll still call them agents. But in the process, hopefully we elevate humans to do bigger, better things like go to Mars or solve for cancer or climate change and many other problems that we just not, water preservation, conservation in Bangalore, like somebody's got to go solve those problems, So we can let the chores be in the hands of machines, So I feel like the cycle of creative destruction is shrinking and it's going to keep a lot of companies like us on the toes, really keep innovating in.
Well, speaking of keeping people on their toes and innovating, what about India and how significant is India as far as DevRev's plans are concerned?
So I'm an optimist on India. I've always been. I feel like there's a young workforce that knows how to be Darwinistic, which means that they have to find their way.
Yes.
Now, there's a lot of doomsayers who are like, man, what happens to IT and what happens to people working in IT-enabled services? I feel like there might be some disruption, dislocation with going private and then, really morphing and transforming. But the individual who is the CEO of their own careers will figure this out because they're part of a billion plus Anglosphere world, and they speak English. And English is the new programming language. So on one hand, you could say, will it churn more programmers in India? Because we used to only have 50 million developers in the world. And the world of 8 billion people was at the mercy of these 50 million people because they were the only ones who would instruct the machine to do things. That 50 million could look like 500 million. So there might be a 10x growth because the new programming language is English. And India has a ton of English-speaking people. So they'll know how to instruct the machine to do things. So I feel like it's a promise, and it's not just a promise, it's the potential of the new programming language really cultivating more programmers in India than ever before.
But, the concern and the worry also is that the work that's being done in global capability centers, every company based here in the Valley has a door and a foot in India as well. What happens to those seats? What happens to the talent working for companies like yours out of India? Will that be replaced now by agents?
Yeah, every company was its sort. So there's two kinds of companies. There's those that deal with bits, and there's those that deal with atoms. So if you look at companies like oil and gas, they own a lot of atoms. It's like they have to dig, they have to drill, they have to do a lot of things, geophysically and all that stuff. And they move at a certain pace. They're also less AI savvy. And then there's a company that deal with bits. They have no real estate. There's no real sort of assets they own other than people and technology and data. I feel like there is a little bit of a distance between these two kind of worlds, and this world, which deals with atoms, will still take another 10, 15 years to figure a lot of AI out. And then there's this world that will probably just have to churn out bigger, faster, better software as well, I think India has a combination of both. Europe, in the meanwhile, is still using India a lot, especially the last 2 years. I think for the next 5 years, there is a saving grace for India, which is Europe, maybe even Japan. All aging economies, they can't introduce robots and agents fast enough. Until then, there is a gap that India has to fill. And we'd better figure out its course after 5 years.
You didn't talk about the US.
Yeah, US at the very least has always been innovative, I think, and we'll figure out how to introduce robots and agents. Could see Elon Musk and, Jeff Bezos and all of us who are here saying, look, we got to move faster. It's a very risk-taking culture here, and now what happens to the have-nots here is the dislocating piece when it comes to elections, and you've seen this in the last 10 years alone. But I feel like, by and large, Wall Street drives a lot of people's ambition as well, including the people who don't have a job here. They feel good about buying into SpaceX IPO, for example. So there's a way to make money on someone else's dream that doesn't happen in every other country. So we've got to figure out US by itself, but there's a lot of other countries that need to figure this out as well.
It's been an absolute pleasure, Dheeraj. Thanks so much for joining us here on Voices from the Valley. Appreciate your time. Look forward to seeing you in India and, talking about what's next as far as the AI chapter and the AI journey is concerned. But thanks very much for joining us today.
Thank you.
Well, with that, it is time for us to wrap up this edition of Voices from the Valley. But do stay tuned. There's a lot more conversations coming up right after this short break. Stay tuned.
Hello and welcome to India Business Hour. I'm Ashmit Kumar. Here are the headlines that we're tracking this evening.
This was not easy, I can tell you.
US President Trump signs a 14-point agreement with Iran at the Palace of Versailles in France. Iran's president signs the accord separately in Tehran. The Strait of Hormuz is set to reopen. Iran promises status quo on nuclear weapons. US will lift all sanctions. Both sides have 60 days to work towards a comprehensive peace deal. Brokerages expect oil prices to ease, but the pace of decline will not be rapid. Goldman Sachs, Morgan Stanley and Citi see Brent crude between $70 to $80 by the end of this year. JP Morgan is an outlier as it pegs Brent near $60 by the end of 2026. Ukraine attacks Moscow in the biggest air raid on Russia's capital since the start of the war. An oil refinery has been set on fire, forcing evacuations at Russia's largest airport. Ukraine's Zelensky says the attack is in retaliation to Russian strikes on a monastery complex in Kyiv last week. Sensex and Nifty gained for the fifth straight session. Mid-caps outperformed. Rupee regains more lost ground against the dollar. Accenture's revenue growth misses estimates in Q3, narrows its growth outlook for the full year, sending the stock plunging on Wall Street. American depository receipts of Infosys and Wipro also tumble in trade. Accenture also announces 3 acquisitions for a combined value of over $4 billion. Newsbreak confirmed HDFC Bank extends interim chairman K.K. Mistri's tenure by another 3 months. The extension comes as the bank's search for a permanent part-time chairman continues. Sources tell CNBC TV 18 the nomination committee has identified 5 candidates and will narrow the shortlist down to 2 names by the first week of July. US Federal Reserve holds rates steady in the first policy under Kevin Walsh as the new chairman. Walsh refuses to submit a rate forecast of his own, even as a majority of other Fed members expect a rate hike later this year. Walsh sets up 5 new task forces to overhaul the Fed communication, balance sheet, and data sources. The CEOs of Anthropic and Google DeepMind called for a US-led coalition to shape rules and standards for artificial intelligence. CNBC reports the pitch was made at a closed-door meeting with world leaders, including President Trump, at the G7 summit. Apple will hike the prices of its products, says outgoing CEO Tim Cook to Wall Street Journal. Cook says a price hike is unavoidable due to semiconductor crunch and rising cost of storage.
How do you imagine a future where you fortify yourself from Virat Kohli not likely to be there?
Next 3 to 4 years, I'm sure he'll be playing for at least 4 years.
The CEO of Royal Challengers Bengaluru expects Virat Kohli to be playing for at least another 4 years. Rajesh Menon also says that making Rajat Patidar the captain was one of the boldest bets made by the franchise. DR Congo holds Portugal to a draw in its first World Cup game in 52 years as Cristiano Ronaldo struggles. England begins its campaign with a comprehensive win against Croatia. Well, the top story this evening, 111 days after United States and Israel attacked Iran and dragged the entire Gulf region into a conflict and choked global oil supply, we have a framework for a peace deal. Trump and his Iranian counterpart have signed a memorandum of understanding to end this conflict. But the agreement comes with major caveats, including unresolved issues surrounding Tehran's nuclear program. US President Donald Trump said, and I quote, "This was not easy," as he signed the 14-point agreement at the Palace of Versailles in France. Iran's President Pezeshkian also signed this agreement separately in Tehran. Pakistan's Prime Minister Shehbaz Sharif, who mediated this negotiation, also signed the agreement, which is called the Islamabad Memorandum of Understanding. Addressing G7 leaders, President Trump claimed that Washington will not have to give anything to Tehran and took a swipe at former President Barack Obama. President Trump withdrew the US from an earlier peace deal with Iran, which was signed during Obama's presidency.
Technical discussions on the removal of all stockpiles of enriched materials will begin immediately. We're going to start that immediately. And unlike Barack Hussein Obama, who sent Iran pallets of cash and any relief they receive under this deal, they'll have to get based on merit. And it won't be from us. We don't have to give them anything.
Well, Trump's claim that US will not have to pay Iran anything contradicts the text of the agreement, which includes a $300 billion fund for Tehran. Here's a closer look at the 14-point agreement. The document signed by both leaders is a 60-day truce agreement and not a comprehensive peace deal. Officials from US and Iran will now begin negotiations for a comprehensive peace deal tomorrow in Switzerland. This 60-day agreement is good news for thousands of seafarers stuck in the Strait of Hormuz. US has agreed to end the naval blockade in the waterway within 30 days. The memorandum also says that Iran will not charge transit fees for 60 days. However, both Iran and Oman will decide the future administration of the strait in discussion with other Gulf countries. Remember, just a month ago, Iran had constituted a body to regulate maritime transit. According to shipping data from Kepler, 6 ships have transited from the strait so far. Iran has also agreed to maintain the current status quo of its nuclear program. Tehran has said that it will not procure or develop nuclear weapons and will commit to downblending of enriched material. Under the agreement, US will terminate all types of sanctions imposed against Iran, including UNSC resolution. The US Treasury Department is also set to issue waivers for export of Iranian oil until termination of sanctions. The Iranian ambassador to India has also said that if sanctions lift, Iran could once again become India's principal oil supplier. The US will also develop a plan with at least $300 billion for the reconstruction and economic development of Iran. This will be undertaken along with Washington's regional partners, and the framework will be developed in 60 days. Now, Iranian officials had initially demanded around $400 billion in reparations and war damages. There is also a clause in this document that allows negotiations timelines to be extended beyond 60 days with mutual consent. But Donald Trump has said that if the deal is not done in 60 days, they will, and I quote, get back to bombing, end of quote. Here is President Trump defending the concessions US has made, including the release of Iran's frozen assets.
Can you explain, though, what the difference is between giving Iran US dollars and unfreezing US dollars for
Well, the unfreezing is an easy one to answer. We have taken a lot of their money, and we have their money. We have taken their money. It's not our money. It's their money, and we froze it. At a certain point in time, I guess we're going to have to give it back. You know, if we didn't give it back, nobody would ever invest in the dollar again.
Well, as the war appears to wind down in one battlefield, a fresh escalation in another. Ukraine has struck multiple locations in Russia's capital, Moscow, with a barrage of drone attacks. An oil refinery has been set on fire, along with forced evacuations at Russia's largest airport. This is the biggest air raid by Ukraine since the war began more than 4 years ago. Ukraine's President Zelensky said that the attack was in retaliation to Russian strikes on a monastery in Kyiv last week. Meanwhile, the world's largest oil cartel, OPEC, has maintained its forecast for robust global oil demand over the next 4 years. OPEC expects oil demand to grow from the current 105 million barrels per day to 113 million barrels by 2030. OPEC also increased its longer-term forecast, citing a worldwide shift towards more supportive policies. It now expects global demand to hit 124 million barrels a day by 2050. Well, speaking of oil, brokerages are largely in sync on oil price glide path after the US-Iran agreement. Goldman Sachs, Morgan Stanley and Citi see Brent crude easing to about $70 to $80 range in the final quarter of this year. As supply risks fade, Manisha Gupta is joining us now with more details. Manisha.
Well, yes, the crude oil prices have declined quite sharply from $120 a barrel off a high during the West Asia conflict to almost $78 a barrel right now, which was the price on the 1st of March as well. So it has been a very volatile journey, but the prices are off by nearly 15% in a matter of last 5 days and down nearly 27% in the last 1 month as well. This is as there is a peace deal now, an interim one between US and Iran, and the expectations that you could be looking at Strait of Hormuz opening, almost 100 ships which are in and around the Strait of Hormuz and are carrying anywhere between 20 million barrels of crude would perhaps be available to the global markets. This has brought the prices down, and this also has brought the forecast of crude from the Wall Street banks and brokerages also on the lower side. To name a few, you have Goldman Sachs, which has cut its fourth quarter 2026 Brent forecast now to 80. Earlier it was at 90. For 2027, they believe that the crude prices could average $75 a barrel. And then you have Morgan Stanley talking about $80 a barrel of an average in this year. The most bearish of reports is coming in from Citi. They're talking about $75 a barrel of an average in this quarter, $70 in next quarter, and by the time it's 2027, they're anticipating $65 a barrel of an average price there. JP Morgan, more bearish, $60 an average for the price is what they're anticipating for this year now. And then you have Barclays on the higher side of the range, anticipating $100 in this year and $80 a barrel of an average in the next year as well. So clearly, all these banks and brokerages, which were talking about 90s and 100s and beyond of averages, have clearly cut it to size, and we're looking at lower price moves now.
Right, Manisha, thanks a lot for that. So clearly JP Morgan, the outlier there, with a call of 60 by the end of 2026. Now, brokerage firm Citi has raised its GDP growth forecast for India to 6.9% for FY27. The firm has also revised its balance of payment surplus forecast to $45 billion from $5 billion earlier. Citi also sees India's average headline inflation for the fiscal year at 4.7% versus 4.9% from a year ago. Now on to the day's market action. Sensex and Nifty closed in the green for the fifth straight session. Nifty closed above the 24,150 mark with Max Health, Indigo and Trent leading the pack. Nifty IT snapped its three-day gaining streak, emerging as the top losing sectoral index. Nifty Bank, meanwhile, outperformed, and 11 out of the 14 constituents closed higher. Well, speaking of IT, the services major Accenture has lowered its full-year guidance despite revenue increasing 5.6% to $18.7 billion in the third quarter. The company narrowed its full-year revenue growth to be in the range of 3 to 4% against earlier expectations of 3 to 5% in constant currency terms. Accenture shares are plunging on Wall Street by about 19%, which is the biggest decline on record. The American depository receipts of Infosys, Wipro are also declining on Wall Street. Now, Accenture has also announced 3 acquisitions worth a combined value of $4 billion. It has agreed to buy a majority stake in industrial cybersecurity company Dragos. Accenture will also fully acquire asset intelligence company RunZero and device security specialist NetRise. The 3 companies together generated an estimated annual revenue of over $200 million as of June. Now, U.S. Federal Reserve has held rates steady in the first policy decision under Kevin Warsh as the new chairman. Warsh refused to submit a rate forecast of his own, even as a majority of other Fed members expect a rate hike later this year. On inflation, Warsh said that the policy would aim for price stability. Further, the new Fed chair also set up 5 new task forces to overhaul the Fed communication, balance sheet, and data sources. CNBC's Steve Leisman is here with more.
Hawkish message on rates, reflecting that he inherited an inflation problem and saying the committee is strongly committed to dealing with that inflation problem.
We recognize that inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years. I am pleased to report that members of the FOMC are unambiguous and unanimous. This committee will deliver price stability.
Warsh clearly has embraced, at least for now, the existing hawkish bent of the committee, where 9 officials now project at least 1 rate hike this year and 62 or more. Only 8 expect to hold rates steady, and Only one cut is projected. And markets have taken Warsh and the Fed seriously. The 2-year sold off hard, and the first hike is now seen with a 66% probability to happen in September. It had been December. A second hike now has a 55% probability for January, and there wasn't one priced in before the meeting. Warsh also pledged a rethink of how the Fed does business, appointing task forces to review Fed communications, balance sheet policy, data sources, productivity and jobs, and the inflation framework. Warsh stuck to his long-standing view that AI and productivity will be transformative for the U.S. economy. But it seemed as if any incorporation of that into policy would have to await dealing with the current inflation problem and hitting the 2% target.
Well, back home, India's largest stock exchange, the National Stock Exchange, has filed the draft red herring prospectus with SEBI for its upcoming IPO. As per the document, the IPO comprises of up to 14.89 crore equity shares, representing approximately 6% of NSE's paid-up capital. It is entirely an offer for sale. Sources have said that the size of the public issue is likely to be between 30 to 32,000 crore rupees, which could value the stock exchange at over 5 lakh crores. SBI, Bank of Baroda and New India Assurance are among the key investors who will be selling their stake in the IPO. Now, we told you first, it's now official. HDFC Bank has extended interim chairman K.K. Mistri's term by 3 months more as the hunt for Atanu Chakrabarti's successor continues. Furqan Muharkan brings us all the details. Furqan, tell us.
So the HDFC Bank has extended the tenure of its interim chairman, K.K. Mistry, by 3 more months. This was something we at CNBC TV18 had broken a month ago. Mistry was appointed as the interim chairman of the bank after his predecessor, Atanu Chakrabarti, had quit abruptly, citing ethical and governance concerns. Mistry's extension was necessitated because the bank's nomination and remuneration committee had failed to finalize a candidate for the chairman's post for past 3 months. CNBC TV18 reported last week that the NRC of the bank has identified 5 different candidates for the post. These include a recently retired RBI deputy governor, a retired bureaucrat, a former head of a public sector bank, a former India CEO of a multinational company, and a technology veteran. The NRC is in the process of meeting these people individually, and 2 will be shortlisted for the consideration by the bank's board. Sources indicate that this process is likely to be completed by the first week of July. Back to you.
Well, Tata Motors has announced a price hike of up to 2.5% across its commercial vehicle portfolio, effective July 1st. The company said that the increase is aimed at partially offsetting rising commodity prices and higher input costs, with the quantum varying across models and variants. This marks Tata Motors' second commercial vehicle price hike in FY27, following an increase of up to 1.5% announced in the month of April. Now, shares of textile stocks gained in early trade as the India and UK Free Trade Agreement comes into effect from the 15th of July. As a part of the trade agreement, UK import duties on textile and garments, which were earlier between 8 to 12%, will now become zero. Meanwhile, sources have said that Indian workers in UK will be exempt from social security contributions for a period of 5 years. Sources also tell us that exporters from labor-intensive and agri sectors will benefit from the trade deal. Now, Prime Minister Narendra Modi met French business leaders in Paris in the final leg of his 2-nation tour, which included Slovakia. The discussions focused on strengthening cooperation across sectors from shipping and logistics to railways. Speaking at Viva Tech 2026, Prime Minister Narendra Modi said that India is going through a rapid transformation powered by technology.
This year, France is serving as an important bridge that is bringing the tech ecosystems of India and Europe closer.
And coming up on India Business Hour, the upsets continue at the FIFA World Cup as DR Congo holds Portugal to a draw in its first World Cup game in 52 years. Details on that when we return. And you can also catch all CNBC TV18's news and updates on YouTube, Facebook, Instagram, X, and Jio Hotstar. Do subscribe to CNBC TV18 Access for exclusive stories. Well, the CEOs of Anthropic and Google DeepMind have called for a US-led coalition to shape rules and standards for artificial intelligence. The pitch was made at a closed-door meeting with world leaders, including President Trump, at the G7 summit. CNBC's Charlotte Reed has this report.
AI CEOs attending a lunch and meeting with G7 leaders yesterday. Of course, this came just a few days after Anthropic was banned from rolling out its latest model to non-US nationals. And of course, the Europeans being left in shock on that front. And we heard from President Macron on this, saying that there'd been some fruitful conversations between the G7 leaders on the best way to roll out some of these models, these frontier models of AI. But he warned as well that we should be careful to not on the non-cooperation among democracies on these questions of AI. He warned against any nationalistic reactions to this.
What is their fear? That these models could be used by others to attack them or us. In response to this, a very strong decision was made by the administration a few days ago. So it's a good thing, an awareness that it can be dangerous. Until now, there was a prevailing discourse that said nothing should ever be regulated. All this is not dangerous. So it's a good thing there is awareness. It's a bad thing, the reaction is somewhat strictly nationalistic.
And as you were saying a little bit earlier, of course, the CEO of Anthropic himself talking about how we must resist the temptation to splinter amongst democracies in the sharing of these models. And Macron saying, you know, the US should be careful in doing this sort of bans, because then the other countries in the world won't be buying US AI if it can be plugged out and plugged off at any moment. So, you know, that was a conversation that was happening.
Well, staying with the world of big tech, tech giant Apple has said that it will be hiking the prices of its products. In an interview with Wall Street Journal, outgoing CEO Tim Cook said that a price hike is unavoidable due to semiconductor crunch and rising cost of storage. Cook also said that Apple has been trying to shield customers, but the situation has become unsustainable. However, Tim Cook declined to offer details on timing or scale of the hikes across Apple products. Royal Challengers Bengaluru is on a purple patch, back-to-back trophies and a new owner in the Aditya Birla Group consortium. But through 18 years of IPL heartbreak, Virat Kohli was their only constant. Can RCB then imagine a future without him? Well, CEO Rajesh Menon tells CNBC TV 18 not anytime soon. Menon also called handing Rajat Patidar the captaincy one of the boldest bets in the franchise's history.
How do you imagine a future where you fortify yourself from Virat Kohli not likely to be there?
RCB and Virat in the different sides of the same coin. And he's been the constant factor for RCB throughout. We have not seen him not being part of RCB even if he moves out of his cricketing career. So we need to figure out that. But having said that, we have not seen that next 3 to 4 years. I'm sure he'll be playing for at least 4 years.
At least 4 years? Has there been a conversation on this?
I mean, he's fit. You have seen him. He's fit.
Yeah.
The hunger never dies.
But he's not playing T20 anymore.
Well, that's when you saw him this IPL season. What was he bringing on the field of play? Energy, runs, attitude, everything was there. And I don't think many can match that on the field of play.
I want to go back to the scouting aspect a little bit and understand from you what the learnings have been on that front. So how does your scouting network operate?
Yeah, the philosophy, what we believe is multiple eyes, multiple times, because there's no bias coming in there. I mean, it's not like one guy looking at me and saying that, oh, there's a best guy. Multiple eyes, multiple times. There is a system in place where we have our own technology, where every scout rates that person. Then it goes to coach and the other support staff and more. Then they call the player and then they assess what they see. Apart from that, what we check is what is the background. We speak to their coaches,